Oh, yeah.
Yes, it's there. It's just a question of what are you?
Well, as well, we're adding more and well, this guy.
My phone, that's the it's also good question. Well, great. I will get there. Yeah, later, right after this also. But not too much later. Yeah. There it is. Yeah. That's good. That's good. Actually, some reason like Reddit, really? I've been unable to subscribe from next to us. Yeah, never. Hey, you're in.
I was living in Berkeley, it was happy. Yeah, so. Yeah, just like for household or. How are you going to say it?
Oh, I was saying, 19 house today, and we had a delivery.
Okay, yeah, I was trying to figure out how old. Oh. Your lady is younger than.
My kid is
Yeah, right. Okay, so you're in between, okay. You were at Stanford was like this. Oh.
It's my debut.
Okay. Awesome. So we haven't. Hey, good to see you again. All right. Right? Different. Sorry. That was good. That was the deal. I was asking Ness how come she could present. She said she's that's her paper was very successful. Remember, she's also this up. Oh, the great. Yeah, I was like, oh, are we going to present? I don't think they're doing that, but she is going like that. That's what I was trying to think about. That particular we're not live, but it's. Yeah, it's like. I like that too much.
You have an organ.
Where did you participate?
Okay, and I'm going. Okay, let's talk about that now.
Something pretty weird is somehow they always. Me, like on the. But somehow.
Yeah, I forgot about that.
Oh my gosh, it's such a mess. Oh my god. And the price is so cute. We have like.
Maybe,
Like,
why do I do a little day in this? Now, here's started. Great.
But then you eventually. Mine was much, and there was a.
Yeah, yeah, yeah. Like really.
Or whatever, right?
Somehow it's a little insulated.
No. You want to flip and I'll do this. All right.
I also see what else.
Yeah. And I'm kind of like super. Yeah. And it's much more interesting. Okay. All right. Okay, I will, here's the timer's great. Okay, I'm all set. Okay. Okay, I think we're good. We're 3 minutes. Yeah.
Oh, yeah, it's.
Thanks for coming.
I took one.
Bigger.
I live in. So.
What are our times?
Oh, that was my.
It's a company.
Oh, no, yeah. Sorry, you weren't on that.
Yes. Yeah, I don't think anybody. All right, good morning, everybody. Thanks for being here and getting up bright and early to come to the household finance meetings. And a few things before we get started. First of all, I want to thank Ray and Adair for all of their work helping organize this session. We had, I think, 190, 180, something like that submissions, a lot of submissions. And they we have some great papers that we've collected, and thank you also for the discussants who are in advance, who are going to be discussing the papers. So we are looking forward to having this meeting with all of you, some new and many old familiar faces. A few things before we start. I just want to remind you about the NBER Code of Conduct, which you all know about for sure, but we want to treat people with respect, and also there's a strict code against any sort of harassment, and so I'm sure know about that, and just wanted to remind you about that. We also try to run these sessions. I mean, my experience and what we've aimed for in these sessions is to be both tough and friendly. So that's I think we've done a pretty good job. And other groups have slightly different ways of handling things. So I think I think so far we've struck a good balance in that regard of being serious and tough, but friendly at the same time. So we're going to start out on our first session, but before we do that, we want to go around the room and do introductions. And so if you can just say who you are, where you hail from. So I'm Steve Zeldish from Columbia.
Adair Morse, Berkeley.
Arvin Gupta, NYU. Neil Mahoney, Stanford.
Scott Baker, Wisconsin.
David Berger, Duke.
Erica Jiang, UCLA. Lulio Wharton.
Adam Joran, UMass.
Sina Majolo, head of the support.
Juan Marie, New York Fed.
Alessandro Bredero, Indiana University.
Tim DeSilva, Stanford.
Taha Shulman, MIT. Ray Linder, Harvard. Lost team. Graves, Harvard.
Edward Kim, Michigan.
Okay, going too fast. Oh, it's like you got to talk a little slower and a little louder.
Indira Puri, NYU.
Simon Hall, Columbia.
Brenda Pickle, UNM Chapel.
Jason Brown, Workings Institute.
Peter Maxted, Berkeley. Also Peter Anand, Chicago, Paris. Bob Hunt, Consumer Finance Institute at the Philadelphia Fed.
Diego Briones, Ohio State. Policies. Justin Katz, Boston College.
Vivian E. Boston College.
Ron Horstowski, Yale.
Jen Gale, Borstal, Arga Schreger,
Northeastern. Michael Lujan, University of Toronto.
Mark Mionis, WashU.
Mark Johnson, UAE. Jorge Punares, Harvard. Dominic Russell, Harvard. Christine Hodgins, Texas. Francisco Punta, Georgetown.
Brittany Lewis, WashU. Paulina Medina, University of Houston.
Jerome Campbell, Harvard. South Shore, Vanguard.
Kip Vanguard. Maria Serena Vanguard.
Probably, Yale.
Cairns, World Bank.
That's two questions.
National Party, University of Virginia.
Great, thank you. And our Vanguard attendees remind me that this is being supported by the Vanguard Group. We want to thank Vanguard for their support, for their ongoing support. Okay, so Ray is I'm going to pass it over to, Adair, sorry. Adair is going to run this first session, and I'll turn it over to her.
Great. Okay, thanks, Steve. All right, everyone, I guess for once in life, we're a little bit ahead, which is good for the authors. We'll add that number but among the papers. Okay, so now we have Greg and Adam. I don't know who's presenting competition with multi-dimensional pricing. The timing is 20, 10, 15.
Thank you. Excuse me. Let me start by thanking the organizers for including our paper on the program, and a special thank you to Erica for discussing it. We're very excited to hear your thoughts. This is joined with Greg Buchek, who's at Stanford, and we're discussing competition with multidimensional prices. Now, what do I mean by multidimensional prices? In many markets, consumers don't just pay a single price. They will often pay both an upfront component as well as a recurring overtime component. We see this in telecom, utilities, and software, and across many different markets. In financial markets, we see the same two-part pricing structure in everything from syndicated loans to mutual funds, and it's especially common in household finance. In both mortgages and in student loans, there's both an upfront origination fee in addition to a per period interest rate. Now, what we study in this paper is we ask, given this two-part pricing structure, how do lenders compete with each other? There's already a large empirical literature that studies the role of market power and the rise of concentration, but those are all markets with a single price. Once there are multiple prices, where do firms place their markups? That's the question that we're going to tackle today. We're going to do that in three parts. First, we're going to offer a simple theoretical insight, which is that two different mechanisms, gains of trade and prepayment risk, determine the optimal allocation of markups. Gains from trades will favor markups in recurring payments, whereas prepayment risk will favor markups in the upfront fees. Second, we're going to test the theory's predictions using data from the US mortgage markets. And we're going to find, in line with the model, that when prepayment risk falls, the effect of market concentration shifts from fees to rates. Finally, we're going to ask, does this matter for optimal policy? So one way to illustrate this effect is, if you look on the left, I've plotted for standard prepayable 30-year mortgages the effects of moving from the markets with below median market concentration on the left to markets on the right with above median market concentration. And what you see is there's a big difference in the amount of fees that lenders pay across markets with different market concentration. That's the red bar. But there's almost no effect on interest rates. That's on the left. On the right, I then compare these standard prepayable mortgages with mortgages that have a prepayment penalty. So obviously there's a lot of selection, and we're going to get into that. But as a first order, these mortgages are mortgages that prepay at much slower speeds. And what you see in this market is that when you compare loans across market concentration, now there's no variation in the fees that they pay, but there's a large variation in the interest rates that they pay. In higher concentration markets, borrowers pay higher interest rates. Right, so then the third part of the paper, we ask, what's the policy relevance of this? We build and calibrate a model of the US market. We use this model to ask if policy regulators cap either rates or fees, what might happen. So interest rate caps is a common policy in many markets, but we find that rate caps can actually reduce borrower welfare because it shifts markups towards the more socially inefficient fees. Lou has a great paper that shows that if fees are less salient, when we incorporate that model, we actually find that the effects are exacerbated. And finally, we then ask, okay, the way that the Fed regulates markets in the US is that they look at deposit-based, rate-focused mergers, and we're going to argue that they miss a lot of the actual market power in mortgages. All right, so here's the outline of my talk. I'm going to get into very briefly the theoretical model, talk through the empirical analysis. That's going to be the bulk of my talk. And at the end, talk about policy counterfactuals and implications for regulations. So the theory. Here's the theory in just one single slide. If you have a model where there's a contract where there's two different prices, a borrower pays an upfront fee at origination and an interest rate paid over time until the borrower refinances. Two different things are important. One is a higher interest rate will make it more likely that the borrower refinances. This is almost mechanical and also very statistically true in the data. Then second, if you have imperfectly competitive lenders, so there are some lenders that have a degree of market power, they set optimal markups across fees and rates. then there are two opposing effects. The first effect is that borrowers and lenders differ in their discount factors. That's why borrowers are borrowers, lenders are lenders. They value cash flow at different times and differently. So because borrowers have a lower discount factor than lenders, there's gains from trade from pushing payments into the future. This is what we call the gains from trade effect, and this means that all else equal, it's better for both parties if the markups are pushed to the interest rate. But then on the other hand, I just said that a higher rate makes refinancing more likely. So if there's revenue that's pushed into backloaded interest rates, this increases the refinancing risk, and that effect will make lenders more likely to push the markups into fees. The prediction of this simple model is that if refinancing is very easy, if there's low frictions, there's high prepayment risk, then the lenders will put their markups in the upfront fees and not in rates. On the other hand, if refinancing is very costly, you're locked into a contract for a long time, the lenders will move the markups away from upfront fees and into interest rates. We formalize all of this in the paper, but essentially this one slide describes the theory. All right, then we're going to test this using data from the US mortgage markets. In this room, like almost all of you, or many of you have written papers using exactly this data, so I'm going to go through this quickly, but we use standard publicly available data from HMDA and the GSEs, and data from Black Knight as well. The main variables that we're going to look at are pricing variables that have been available since 2018, so the interest rate. And then we calculate what we call the lender fee, which is the upfront fee that accrue to the lender. We also look at, in some robustness, third-party fees that go to other parties. Our sample, or we look at both standard 30-year prepayable loans as well as loans with prepayment penalties. We do some filtering on whether or not there are discount points or lender credits. And our measure for market concentration of the standard measures the concentration ratio for CR4, which is the market share of the top 4 lenders, and the HHI. Now, to motivate our study, on the left-hand side, I've plotted a bin scatter plot of the interest rate for standard 30-year prepayable mortgages relative to the market concentration last year. So on the left-hand side, panel A, you can see that there's essentially no relationships necessarily between the interest rate and market concentration. This result is studied a lot, so this is essentially the result that previous papers and policymakers have used to argue that there's no role for local competition because there's no correlation between how concentrated a market is and the interest rate that borrowers pay on standard loans. On the right-hand side, on the other hand, I look at the exact same sample, and instead of looking at interest rates, I ask, how does market concentration correlate with the upfront fees that borrower pays? And here we see a stark positive relationship. In more concentrated markets on the right, borrowers pay higher upfront fees. All right, now, there's a number of empirical challenges. All of the standard ones that you would say, your estimates are biased, they're unobservable costs that co-move with concentration. You might have low market cost lenders that expand, that would bias the estimates down. There might be costly friction that deter entry that would bias it up. So take that into account. In addition to all of the standard sort of omitted variable challenges, there's an additional challenge, which is the model talks about markups and pricing power. We don't observe markups or pricing power. What we observe is market concentration. And market concentration, even though across many different models is positively correlated with markups, there's essentially no deep effect of an increase in HHI on prices. There's a large sort of literature on IO that goes into this, but the the short takeaway is that this matters for the type of instruments that you use if you want to instrument for market concentration. You can think about there's two different channels that affect concentration, entry and exit, and technology shocks. And what we need is we need instruments that affect entry and exit, not instruments that affect technology to get at markups. Third challenge is, I mentioned this before, there's obviously a large selection into prepayment penalties, so prepayment risk is non-random. What do? We have three different sources of exogenous reduced form variation. We look at incidental bank mergers, we look at lenders that failed after the crisis, and then we use the New York mortgage recording tax as an exogenous source in prepayment risk. Let me get into that. So our first instrument uses bank mergers as an instrument for competition in different counties, but the county itself might be a motivation for the merger, so we need to look at counties that were not likely the reason. So here's a map of the counties around us right now. In 2019, Cambridge Trust acquired Wellesley Bank, and you might assume that Cambridge Trust, which has a large market presence in Middlesex, maybe they wanted to acquire Wellesley Bank because of their market presence in Norfolk, so we can't use the increase in market concentration in Norfolk. But what we do is we say, because Cambridge Trust acquired Wellesley Bank, there's an increase in market concentration down in Plymouth County, and that's the variation that we use. Using this variation after an incidental merger, the market share of the top four lenders increases by 4 percentage points. And although the estimates are noisy, they point in the same direction as the OLS. We don't find any statistical effect on rates and a large effect on fees. Our second instrument uses failures of three different lenders during the financial crisis: Washington Mutual, Wachovia, and Countrywide. Here's a map of the counties where Greg lives, and imagine that there are two different counties, Santa Clara and Monterey. In Santa Clara, Quicken has a large market share before the crisis. In Monterey, one of these three failed lenders has a large market share. What happens is that after the crisis, because concentration and market presence is very sticky, in Monterey, there's now a lot more competition simply because one of the failed lenders was present there. We then run the same thing again. In the first stage, we find that, as predicted, higher market share of a failed lender leads to lower concentration. And as the model predicted, there's essentially no effects on rates and large effects on fees. Finally, I said that prepayment risk is not random. So what we do here is we compare mortgages originated in New York with surrounding states. In New York, many of you live there, so if you refinance the mortgage, you will know that you have to pay a surcharge for refinancing your mortgage in New York, which means that prepayment speeds in New York are much slower than in other states. One way to see this is just to regress whether or not you refinance your mortgage within the first 2 years on a state dummy, and mortgages refinance at 7 percentage points slower speeds, which is a large magnitude because the average refinancing rate within the first 2 years in our sample is 16%. Using this variation, we then see that there is a larger effect of concentration on rates in New York, and the effect on concentration is all in fees and there's no effect on fees in New York. So what we see here is that when refinancing is costly, the effect shifts into rates. All right, in my remaining 5 minutes, let's go through the policy counterfactuals. So our goal here is to evaluate, given what we've learned in reduced form, can we say anything about common policies that regulators use? There's a lot of different countries and markets that, for example, use interest rate caps. To do this, we're going to calibrate a dynamic model of the US mortgage markets here's sort of just one slide of what that model does. There's a lender's problem with n differentiated lenders compete in Bertrand. They maximize their profit, which depends on their market share. Then they set a fee markup, a interest rate markup. The fee markup they get up front. The interest rate markup they get over time. So this is discounted. And the length at which they get the interest rate depends on the probability that the borrower will prepay the loan. The probability that the borrower will prepay the loan depends on the interest rate. So P here is a function of R. The borrower on the other side exits, it has an existing interest rate that it enters with, then it considers refinancing with a certain probability. John called these wood heads. Then there's also another exit probability, maybe they default or they move. So in recursive formulation, the borrower considers not to refinance, or it considers to refinance, or it moves. So this recursive formulation will then endogenize the moving probability. Let me skip the calibration. Instead, I'll say this. Once you have these two different refinancing prepayment motives, you can get very, very close to the empirical S-curve. So this we just take right off of John's paper. Right, now, we validate the model out of sample by asking, can the model replicate the reduced form results? So we estimate that in the model, there are markups on both pricing dimensions. On the left-hand side, I've plotted different realizations of the model by refinancing cost on the x-axis and the interest rate in equilibrium on the y-axis. This line here is what's observed in the US market. And we see that a profit maximizing lender in the market in the calibrated US market will have markups on both fees and rates. Next, we then ask what happens within the model. This is not at a targeted moment if we vary lender concentration. So on the left-hand side, on the x-axis, I'm varying lender concentration. I'm asking what happens to the interest rate in either an economy with low prepayment costs, high prepayment costs, or the observed prepayment friction for 30-year mortgages in the US. So the model tells us, again, not a targeted moment, that when we vary lender concentration, there's no effect on interest rates. And on the right-hand side, I do the same thing for fees. And here we do find an effect. Right, now, what was the goal of the model? The goal of the model is to evaluate different policies. Interest rates caps are a typical policy. So here what we do, I have 4 different charts that shows you all where the x-axis are different realizations of the refinance risk. Vertical line is where the US market is. And then we ask, what's the change in interest rates or fees if you cap rates? So the intuition here is if you cap rates at a marginal cost, lenders can't put their markup into the interest rates. Total markups will rise because lenders will put more markups into fees. And fees are just not as competitive. We find that in the calibrated model, borrower welfare falls. If we then do the opposite, if we cap fees, now pricing shifts into interest rates, and interest rates are more competitive because on interest rates, you're both competing with current lenders and you're competing with future lenders. Right. Now, thank you. I have 1 minute left. What's the implications for regulation? So I showed you these 2 charts to start with. The Fed currently bases their regulation on the chart to the left. We say they should take into account the chart on the right as well. Because the Fed only takes into account interest rates, they deem US mortgage markets, quote, national in scope, unquote, which means that, for example, when Bank of America acquired Countrywide, they did not take into account that this would create a lot of local market concentration. Instead, what the Fed does is that it only looks at local HHI based on deposit shares. Now, you might ask, maybe if you look at local concentration in deposit shares, that will pick up something in mortgage markets. And this used to be the case. So in the mid-90s, on the left-hand side, I've plotted every single county in the US, what the market concentration is in deposit markets on the x-axis and mortgage markets on the y-axis. And in the mid-90s, there was a large positive correlation in markets where banks had a lot of market power in one market. In one product, they also had a lot of market power in another product. But what has happened since then? They've split up. So now there's no correlation. The correlation has been coming down. Okay, I'm out of time, so I'll conclude. Thank you very much.
Thanks, Adam. Now we have Erica Zhang to discuss.
Thanks for the opportunity to discuss this very interesting paper. Let me start with giving the background. There are many academic and policy studies on mortgage market that have focused on mortgage rates, including different type of regulatory analysis on merger and also on Basel II, et cetera, and also mortgage research that focus on rate dispersion and rate overpayment, et cetera, to measure search frictions and competitive discipline. But interest rate is not the only price if you view mortgage as a product. In fact, the other type of price is pretty large and also has been rising. Here, just one example for a typical mortgage of $300,000, the mortgage closing cost can be as high as over $6,000, and this number has been going up. Moreover, for those of you who know different types of closing costs or upfront fees, they are lender related and third party related. And this fee, the rise has been concentrated in points and also lender fees, not really third party charges. And there have been a lot of policy debates 2 years ago. So in 2024, there are a lot of discussions about mortgage closing costs viewed as junk fees, and there are concerns about whether consumers are able to shop fees. So what this paper does is, the headline finding is that rate-only evidence in this mortgage market can understate mortgage market power. And this is because markups can be hidden in upfront charges. And specifically, the economics are quite interesting for very standard prepayable mortgages. Local concentration rises upfront fees, but has little effect on interest rates. And then when we think about this pricing margin, the pricing margin actually shifts from fees to interest rates when refinancing becomes harder and prepayment risk falls. My overall assessment is I really believe in the empirical facts. The pattern is first order in the data. You can criticize here and there the identification. They actually use different instruments. So I really buy the empirical evidence. I really like the economics of the paper. So I want to comment on the economics and also my interpretation of the result. So let me start with saying this rate invariance result in one slide, just to summarize the very simple model. The simple model is so simple and powerful that it can actually deliver a lot of the economic mechanisms, and the quantitative model does a lot more, but I really just want to focus on the simple model for this discussion. So here we have lender post a single take it or leave it contract. So in the very simple model, borrowers don't do much, and I will then show you what borrowers can do that make the result hold and what actually disinvalidate the result. So here lenders post this rate menu, and then we have the payoffs for the lender and payoff of the borrower. And then there is a valuation wedge of this trade because lenders are much more patient than the borrower. So there is so-called intertemporal gain from trade, which is the term used in this paper. And then the borrower accepts the contract if the payoff to the borrower is greater than, or the cost to the borrower is below the outside option, which is the way they measure competition, they model competition in the reduced form. And then when the fee margin is slack, the lender value becomes the following. So the model would predict a very simple and powerful result, which is the rate is chosen to maximize joint gains from backloading. And then fee extracts the remaining surplus. And then concentration or competition moves fees one for one and doesn't really move the rate. Then what can borrowers do? So there are three ways market power can enter the menu, and then I just explain what borrowers can do in reality. Number one is we impose this markup on only one pricing dimension, let's say fees, which is what this paper focuses on. Then borrowers can take lender credits, right? If they really don't want the allocation between today's payment, tomorrow's payment, there is only one price of this mortgage, and borrower can decide if they want to make this price today or over time in the future. So what the borrower can do is they take lender credit, accept a higher rate, and then refinance later. And therefore, this first way to incorporate markup is skippable from borrower's perspective. And second way to incorporate markup is to have a common surcharge on the whole menu, which is basically a parallel shift of this price menu, which is a pair of rate and fee, right? So now you have a parallel shift, every point is more expensive, but keep in mind, in the second situation, the fee rate exchange or the slope of this rate menu doesn't really change. Therefore, if you think about the consequence, borrower have to pay a higher price in total, but there is no difference in the optimal allocation. They can still choose the optimal allocation between today and tomorrow. They can still keep this intertemporal gain from trade. It's just there is a transfer from the borrower to the lender. And third way is that there is a change in the menu slope. And this creates a true distortion. So now the so-called exchange rate between the fee and the future interest rate is different. Now the slope moves, and so borrowers will re-optimize. But every transaction now will occur at the wrong price. The so-called chosen contract shifts, and the joint surplus is lower. So the question I have here so far is, does concentration actually add a common surcharge, which is this paper's model, or change the price of backloading will eventually create distortion? So now I want to rederive the paper's result from the borrower side, really just insert this borrower's decision into the paper's simple model. Now a lender earning this rent by offering ISO profit contracts, and the borrower picks a point, they pick an allocation between today's price and or versus interest payment over time. And then what would happen is, basically from this very simple model, this rent drop out. Borrower really just want to decide how they want to allocate between fee today and interest rate tomorrow using this so-called lender credit, which is an instrument they can use in reality. So now slope and intercept of this price menu are pinned down by different forces. For the slope, this is owned by refinancing, which is, Adam mentioned, that if you have easy refinancing, there is an actual cost, and this actual cost is worth a little, and then there is a small credit for each basis point of interest rate, and then this fee-light contract that favor fee-light contracts, and if it's harder refi, then the opposite is preferred. And now the markup or the intercept, this is owned by competition, right? This is basically what the model says. In the paper's model, concentration can only be a common surcharge. So only the second thing can happen. So this is proposition 2.4 of the paper, rederived from the borrower side. Keep in mind now the borrower is fully rational. There is no inattention at all in this current model. And this is all back in 1971. There is a variable margin that maximizes joint surplus, and the fixed charge extracts rents. What this paper asks is actually adds two additional ingredients. Number one is there is the variable charge, which is the interest rate in this setting, actually affects future exit rather than this within contract quantity. And second is this interest rate actually is surplus creating because of the different discount factor in this setting. Lenders are much more patient than the borrower, so the optimal rate is interior rather than at cost. And refinancing friction in this case actually raise the value of backloading and shrink the set of feasible rates. And that's going to squeeze the contract toward the fee floor. And once the floor binds, the pricing margin flips from fees to rates, and the market power then must spill into the rate. So the paper actually shows that the regime switch is its own proof of the separation is conditional. And therefore, refinancing friction is one force that this paper focuses on. And the question is, what else can also switch the regime? So what else? What assumptions actually carry this separation? By separation, I mean concentration only moves fees rather than interest rate. So the separation conclusion actually rests on three restrictions. The first one is what this paper focuses on, the fee margin slack. Right? The paper examines this particular one. Remember, when fee credit margin is a lump sum transfer with room to move, and so fee is going to be the one that adjusts when competition changes. And refinancing friction make it fail and the margin flips, right? That's the key conclusion of the empirical finding. And there are two other restrictions that are very interesting and also very realistic to consider. The second one is, in this model, we need to have a fully informed borrower. If borrower is actually inattentive, for example, they choose from complete menu. In the particular model they have, borrowers choose from the complete menu, no screening, no liquidity constraints, or no manual steering. And number three, this is also assumptions concentration enters only through the outside option. It doesn't really change the relative elasticity. The cost of switching from paying today to future actually doesn't change with concentration. If either of the three fails, market power will move the manual slope, and the rate invariance is no longer the prediction. Again, it doesn't affect the headline funding of the paper. It really only affects the welfare interpretation of the result. And I want to be fair to the paper, many of the behavioral biases actually don't break their result. For example, if you have uniform inattention, it doesn't really break it. In the quantitative model, they do allow borrowers to be less attentive to fee, which you can see from different survey data. But here, if you have a constant fee weight, which basically means that now everyone is inattentive to fee compared to interest rates, and there is no changes of this inattention parameter as you change concentration. In this world, results doesn't change. So frictions that vary with market structure is what breaks it. For example, if you have market-dependent shopping, fewer rivals, so less search, and therefore this effective inattentive parameter will fall with concentration. Number two, if you have screening, heterogeneous attention or liquidity constraints, therefore lenders use manual like fee and interest rate combination to screen borrowers. All of those forces have been shown in the existing literature, et cetera, et cetera. And so the issue is not really inattention per se, right? So if you just have inattention, it's not sufficient to break the result. You need to have the relative rate fee elasticity move with market power. So what can the paper do? I think the question really boils down to whether concentration shift the manual in parallel. So they can do this estimation. They can estimate rate point schedule flexibly and test whether concentration changes its slope. And I think both outcomes are informative. If they have a parallel shift, so if market power actually change their rate fee manual in parallel, the separation holds. That means you have rational borrowers, same rate, higher fee, and the paper's maximum is sufficient. And if that's the case, then the harm is, I abuse the terminology, is redistributive. That means borrowers just pay more, but there is no allocative efficiency issue. If slope actually changes, or in other words, if you reject constant attention, then frictions that covary with market structure, that's basically a long way of saying that in the counterfactual, when you change market concentration, you also need to consider whether this attention parameter also need to change. Then you would have less intertemporal gain from trade. I think that would have more efficiency implication. Let me conclude. This paper changes how we should think about market power. Regardless of my comment, I think that finding really holds. The fee margin is real, and where market power shows up depends on refinancing friction. And the headline result is a separation theorem. This is my read of the paper. Refinancing pins payment timing, and competition pins total rent. And rate invariance is a signature of this common surcharge, not a distortion, at least from the current empirical exercise and also the theoretical exercise. But the paper does show that separation is actually conditional, and paper focuses on one friction. I think there could be just one additional test that would settle a lot. The question is of that particular test is whether concentration actually shift the rate point manual in parallel, because then regulators asking whether local market power exists should look at fees, but whether it destroys surplus or simply just a transfer between borrower and lender is unclear yet. All right, with that, thank you very much.
Thank you. Please come up. I'm just stalling while you get up there. As a norm, we don't like to respond to this discussion, but let me just say what a great way to start the day between that presentation and that discussion. So please, you can take them one-on-one until we start to need to bulk, and I'll intervene, but please go ahead, and we have 15 minutes for.
So in that case, I won't respond to the discussion.
You are not allowed to respond to the discussion. Yes, exactly. Please, questions.
Yes.
So I think in your model, the lender does not get the next fee that's paid, right? So that there's a refinancing. However, we might imagine it's market power, the lender might also be the same lender refinancing you in the next round as well. I'm wondering if that generates any other incentives to put things on the NBER.
That's a great question. You're correct in the stylized model. It does not. In the quantitative model, there's a probability that you will recapture. Now, I've looked at that. One thing that we haven't explored yet is empirically in New York. So maybe this is why you're raising this question. In New York, this refinancing extra mortgage reporting tax is actually waived if it's the same lender that refinances the loan. So that's a good comment. We should look into that.
Let me make the standard Fed disclaimer. Anything I say here is going to be negatives. The discussion of bank merger analysis, clearly this is part of it. It's actually much bigger and more complicated. Generally speaking, it's not binding, with the exception of the maximum deposit balances that lenders can get. You presented a chart with 2025 mortgages, no points. And that's just a very exceptional set of mortgages in 2025 to use. I'm assuming in the paper you could do something more general with that, but most people in 2025.
Yep, that's a good point. The charts that I showed you was averages from 2018 to 2023, and we do it for both loans without points and for loans with points. But yeah, that's something to be careful about. Peter?
You said in the voiceover, fees are not as competitive, and then the interest rates are more competitively set because the current and future lenders. Could you just expand on both of those a little bit?
Yes. What I mean by this is that when you compete on fees, you're just competing with everyone who's in this room right now. And when you're competing on rates, you're competing with everyone who's in this room right now, but there's also the risk that in the future, there might be more or less competition. The rates might go up or go down.
But couldn't the fees go up or go down?
Huh?
Couldn't the fees also go up or go down?
The fees could go up or go down, but once you paid the fee, that's sunk cost. So once you've paid the fee, that doesn't matter for any future decisions. But the interest rate is locked into your contract. So the value of the interest rate, the amount of revenue that the lender can extract from the interest rate, depends on how competitive the markets are in the future. The revenue that the lender can extract from the fee does not depend on how competitive the markets are in the future, because they take all the money and run. John?
So the discussion of the rate points menu used to take us, given the structure that we have, whereby the principal of the mortgage is fixed, and if you take points, it adjusts the rate. But that is a very weird structure that I don't know whether you can derive it in equilibrium or not, but what would be more natural would be standard textbook finance. If you need to borrow more money to cover the fee, you increase the principal balance. The fee, the rate is the rate. And I think, because we have this weird structure in the US market, which as far as I know is unique in the world, we kind of take it as given by modeling, but I think we should.
Yeah, I think that's a great point. We've obviously, our starting point was the US market. I'm biased to think that we should look at other markets, for example, the Danish market. So we're going to have a paper later that takes that. Thank you. Adair?
Strikes me that across household finance, there's a paper to be written about the different uses of fees. So in credit cards, it's used to penalize risk, to compensate for risk when borrowers get in distress. In autos, it's used to sell cars, right? It's like payments out, it's adjustment on the price. Here it's used for competition. And across, and those are just three quickly thinking of. It's an interesting bigger picture of another paper about how the fee interest rate and relating to what some of the things John was saying, right? Interesting topic in general.
I agree. Neil?
I want to give you like my 3 bullet point summary, and you can tell me whether it's right or wrong. Well,
you have a sort of single dimension of demand, but to generate this sort of differential relationships with respect to concentration, you need something that breaks that single dimension. And the way you're doing it is prepayment. But you can imagine a whole bunch of other things. Right, you show evidence for prepayment risk. New York State is the strongest example. But regardless of the source, your policy counterfactuals, if you're shifting competition onto a more competitive dimension, that's generally can be good for consumers, regardless of the different mechanisms that play. That the right distillation.
Yes, so I think your last statement is, in general, more competition is better for borrowers. I think where we started was, right now, the state of the world is that the Fed and existing papers claim that there's no local market power because interest rates are invariant to concentration. And then we say, well, fees do vary, and we sort of ask what might be driving this. I agree with both you and Adair that in other markets, credit cards and car loans, prepayment risk might not be the number one factor. In mortgage-backed securities, which is sort of the end product of the valuation of mortgages, prepayment risk is the number one factor that drives prices. So that was why it was natural. Brittany, then Sean.
Thanks, great presentation. My question follows up on Peter's question. So it sounds like when you're competing on rates, what's locked in is actually the markup if you have adjustable or fixed rate mortgages. So I was wondering how the competition on the markup changes for adjustable versus fixed rate mortgages. Is there any change there across time?
That is a great question and not something that I've looked at yet. So ARMs have been increasing as a share. ARMs were very low during our first sample period, but now that that's something we should look into. Great question, Sean.
This is super interesting, thank you. I want to quick add to your comment, which is also a household finance market outside of credit markets. This thing with pricing and fees also occurs, so we saw a very interesting paper in the corporate finance session by Matteo Benetton, Tim Quaid, and NBER, where they're looking at banks. Why are banks not passing through deposit rates when they could make more spread? And if they get people to switch, and one thing that they looked at separate data that hadn't been looked at before, which is about kind of teaser offers, where you say, oh, if you switch your direct deposit to us, you get $500 cash. And so that's like another kind of fee-like price, except in this case, consumer that seems like similar to your paper. Banks are competing on that and not competing on the thing that we've looked at in the data in the past.
And I imagine what's common across many of those markets is Lou's point from earlier that there's different salience. Like we see the interest rate, we understand what it is. The fees are buried in many fine sort of footnotes.
I did have a question. Sorry. The question is on is a separate question. Is there anything in the Fair Lending Act or related regulation, either in how it's written or how it's enforced, that could also lead to this difference where you see the banks not competing on interest rate, but competing on points, in the sense that they, they're worried that regulators will look and say, if you're offering different rates to observably similar borrowers in two different zip codes, then that would foul the regulation. But maybe points are not regulated the same way. That's the question. Or even if they are they enforced the same way?
That's a good question. That I sort of get at. Yeah. I think there are two different mechanisms that we haven't looked at yet. One is regulatory pressure. The other is the fact that the vast majority of these loans are sold into TBA mortgages. So it's just about sort of being able to deliver. Yeah. There's another question over here. Yes.
And so, thank you. I'm going to propose, following up on Bob's comment and John's, just one suggestion. The counterfactual you're running is the Fed's merger behavior wouldn't rest on that. Yes, the 1963 decision says use deposit rates. First-hand knowledge, the Fed has moved beyond that tacitly, right? So this is not, it's not going to be as strong. I think you have a much stronger policy motivation, which is Dodd-Frank actually mandated, for all the reasons you described in the paper, back exactly 16 years ago this week, that the US market not have points and fees, they'd be banned, and that everything be the rate. That provision was waived by the CFPB because the general equilibrium effects of what that would do to rates, prepayment speeds, the TBA market, and everything else was not something that we could figure out in 1 year. There was no research, there were no data with fees. So you're writing this paper, it's much, this is the beginning of a stream of evidence that would inform that decision. Because Congress basically had your intuition, which is people are sensitive to the rate, they're not sensitive to fees, we should make everything to the rate. But nobody knew following the mortgage crisis what that would actually have done. So the hidden provision of Dodd-Frank waived that.
Very interesting.
So Erica mentioned this OI result about the two-part pricing. That depends on the distortion that comes out on the variable side, but I'm wondering, that's a fully optimized model, like everyone's fully aware of the fees and pays attention to it. Whereas it seems like you have a somewhat different thing in mind. I'm just wondering how much your result depends on your kind of frictions that you have in there versus the OI result of it.
So the stylized model is similar to the OI result. It's like Disneyland. There's a two-part pricing. So in the stylized model, everyone is rational, both the lenders and the borrowers. They see everything, they understand the prepayment risk, and the qualitative result follows from that. Then when we calibrate it and we look at what happens in the US market in the full dynamic structural model, that's where we then add a small parameter as saying that borrowers are less attentive to fees. So the
Because I mean, the thing that Ron's talking about why I might want to ban these things is not come from the OI model, right? It comes from this.
Correct. Yeah, so that's right.
Trying to figure out which is more important in your mind.
So I think that there's the qualitative result, which is that prepayment risk shifts where markups are placed. That result you get with full rationality. The amount of consumer welfare that you could get from banning it obviously is a quantitative question, and I think there it's really important to add inattention.
I mean, you have 3 minutes left, so I suggest you take all the questions and then respond to what you can and or to the discussant in that full 3 minutes.
Okay,
Yeah.
There's one more then.
Curious how our interpretation or anything will all change if there's kind of the people who are more likely to uptake the high point mortgages are also differentially likely to pay off. So in other words, if you're taking a high point mortgage, if you're a type of person, you'll sell it to pay it.
Yes, so I think this is what David Sang looked at and in his job market paper as well. That's not in the model that we have right now. We don't have differential sophistication or differential, but that's something that we could add into the quantitative. Let me, in my remaining minute and a half, I want to thank Erica for a really great presentation. One thing that we've looked at that's not in the paper yet, which is sort of your point, is to what extent does concentration either rotate the menu or shift it in parallel? And this is a hard question for the following reason. The slope of the rate point menu depends on whether you're plotting points against rates, as we've done here. So in this chart, I've plotted the menu and I've varied concentration, and we sort of see a slope change as you predicted. But Paul Will and David Sang, they have this point that it's important to plot it in both dimensions. And when you plot the rate point menu as rates against points, we see much more of a parallel shift. So that's something that we should look into. Let me just sort of summarize. Thank you so much for all of the comments. There's a lot of important institutional details about the regulation that we need to get into. But yes, thank you for all the comments and questions.
Thank you. Okay, do we have a 15-minute break as we like to do at household? Take a lot of time to interact and we'll be back at 10:15. Perfect. Look at our products. Oh, right. Yeah.
Started earlier. The morning. Yeah, and then the next one is the Danish. Yeah, yours too, think about one thing.
I think
I cut it out, I cut out the sentence, so I'll send you the right end of it. I was dead.
All right,
Yeah,
get started now. Paper two, Arpit's gonna present on inflation through the mortgage market. Thanks, Arpit, you have 20.
Great, thank you so much for having us on the program. This is joint with Chris Hansman at Emory and Pierre Mobile at INSEAD. So the motivation for the paper is the large increase we've seen in the prices of houses and consumer goods. So if you go downstairs to the bar, it's like $14 now, I think, for like a wine drink ticket. And I can assure you quality is not the reason why. This increase has been seen both in the levels of prices as well as normalized for income. So things like price to income ratios and payment burdens, which we're going to think of as affordability. This has happened at the same time we've seen these unprecedented fiscal and monetary interventions. The key focus is going to be QE4, which is the Fed's purchase of over $1 trillion of agency mortgage-backed securities over the last few years. And we think that mortgages and housing is a really important part of the transmission mechanism of monetary policy. So our question is going to be to ask, how much did those interventions, particularly the unconventional monetary side, contribute to this affordability challenge we face with houses and consumer goods? This is a really hard question to tackle. The reason is that interest rates are about the most endogenous thing you can think of. And especially in this time period, we have simultaneous supply and demand side shocks. So it's going to be very challenging to figure out what was the contribution of policy towards this environment. Even if we have some cross-sectional estimates, we have to think about the problems of aggregation, right? We have to solve this well-known missing intercept problem of trying to figure out how to tackle the kind of aggregate impact of all these interventions and take into account the fact that we had both fiscal as well as monetary interventions in the time period. And finally, we want to do this to understand welfare, but that's also challenging to understand absent consideration of GE forces as well. So what we do in this paper is combine quasi-experimental variation from mortgage market segmentation that helps us think about the identification of these effects, along with a structural model, which we use for aggregation welfare. Key finding is that QE4 drove, we think, excess house price and consumer goods inflation, and the cost of these policies are really borne by young households who are finding it more challenging to access home ownership. Okay, so let's start by talking a little bit about QE. This was the program whereby the Fed purchased agency mortgage-backed securities, and the key feature of these purchases that we're going to use is that the Fed targeted conforming mortgages that are below the national loan limit. So these are the mortgages which are eligible for to-be-announced TBA pools. So what's not going to be targeted by these purchases are jumbo mortgages that are above these conforming loan limits, and actually also what are so-called super conforming loans. These are loans that are above the national conforming limit, but below the local county level limit. These are also excluded from Fed purchases. And there's been a good amount of research on the implications of these purchases for mortgage rates. So I'll show you this in a second as well, but a lot of people have looked at the implications of Fed purchases on different mortgage segments. Our key focus is going to be on how this translates to cross-sectional exposure across regions to these programs. So on the left here, you can see the conforming versus jumbo spread over this time period. The right just kind of plots the same thing, just the spread specifically. So what you can see is that before the purchase program kind of began, jumbo rates were actually slightly lower than conforming rates. And as the Fed purchases really picked up in early 2020, the spread now reverses substantially. So now conforming rates are much lower than jumbo rates in comparison. This continues for a couple of years, at which point the policy reverses. We go back to quantitative tightening, and now conforming rates are now much higher than jumbo rates as well. So we're going to use this time series variation in conforming to jumbo spreads combined with mortgage shares for our identification problem. But first, here's just a little bit of a motivation to highlight the impact of these spreads on household behavior. This follows from a lot of research other people have done. The comparison here is properties on the left and properties on the right. Every dot is a bin scatter corresponding to a property which is purchased by a loan that's either going to be below or above that national conforming loan limit. So as these spreads vary, the loans on the left are going to be treated and have lower rates compared to the houses on the right. And we're plotting is actually the house price change of the associated property from someone buying a mortgage below or above that cutoff, using a repeat sale analysis to look at the change in price for that house as the new person buys it. The takeaway here basically is that borrowers that are using conforming mortgages to buy properties in 2020 are really bidding up the prices of the houses that they're buying relative to other mortgages that are being accessed through jumbo mortgages. So this gives us, I think, a really tight local average treatment effect to tell us that there was an impact of these mortgage policies on the broader housing market. What this analysis doesn't really tell us is how this aggregates, right? Because surely people are going to respond to a rate differential this large on mortgages and move around and get different types of credit. So that aggregation is going to be a key challenge that we're going to turn to next. The way we're going to address that is through empirically through a shift share design. What this does is take those different spreads that we talked about. So we just highlighted the conforming spread as well as the jumbo spread. We're also going to incorporate the FHA loan spread as well. Ginnie main products, which FHA goes into, were also purchased to some extent by the Fed, but not nearly as much. And we're going to take these different mortgage spreads and combine them with the shares of localities, mortgage origination in each of those buckets. So we're going to look at a region, i.e. a zip code, how much of the origination share went into jumbo mortgages, conforming mortgages, and FHA mortgages. We're going to fix those in 2018. So those are going to be predetermined and those are not going to move. And so we're going to have time series variation only in these mortgage spreads over the period, starting from 2019 going on through 2024. So the variation here is going to be this shift share combination of local differential exposure to different mortgage segments combined with the time variation in mortgage spread. So what you can kind of think about this is areas that are going to be highly treated under this definition are going to be places that had a high concentration of agency conforming mortgages in 2018. These areas are going to be highly treated in 2020 because conforming mortgages are going to get a much lower interest rate. We're going to use this design, therefore, to get something that's typically very hard to do, which is some sort of cross-sectional variation to interest rates. Of course, the reason this is very challenging to do is because interest rates are, as we just saw, fairly uniform across the country. So what we're exploiting here is the fact that there's really segmentation in different types of credit, and different regions are going to be differentially exposed to that segmentation. Okay, so first thing we do here is just estimate the pass-through. How does exposure to this synthetic rate pass on to the actual local interest rate that borrowers are paying? So focus on the fourth of these bars here, sort of our preferred specification. Here we're looking at the zip level, and we're controlling for county by year fixed effect. So that's our attempt to try to soak up other controls and other things that are happening in geographic areas. So the comparison is between two zip codes that are in the same county year pair, but one zip code is more exposed to the synthetic rate instrument than another zip code because of its pre-existing segmentation in the mortgage market. So that zip code, which is more exposed, i.e. has an exposure to a lower interest rate, finds that passes on to the actual mortgage rates people are paying in the locality at a rate of about 0.73. There's almost 3/4 of pass-through of that local regional rate exposure onto the actual mortgage rate experience in that area. And so we do this aggregation exercise across different units and levels, tracts, zip codes, counties, and so forth, that we'll use going forward. We also do a IV specification. So that assumes that all of the impact of this policy goes through this mortgage rate variable. But we're going to highlight here for this talk are reduced form estimates, which take the synthetic rate and regress that directly on other outcomes. So the next thing we want to check is, does the synthetic rate, does this exposure to local segmentation also impact mortgage quantities? So here we're looking at the total amount of mortgage loans originated in census tracts. The one on the right is looking at the log number of loans originating in a tract. So here we find that if interest rates go down by 100 basis points, we see about a 13% increase in the number of purchased loans originated in a locality. So this check is nice because if interest rates were going down, that could be related to both supply and demand side effects. Here we kind of find that reductions in interest rates are passing on to increases in mortgage credit in local areas. So if we have areas that are exposed, they have lower interest rates because of QE or because of broader segmentation shifts. They have more credit origination. Now we want to ask, how does that actually pass on to other variables happening locally? So the key one for us is going to be house prices. What happens to house prices in areas that have lower rates because of this exposure to national shifts? What we find here is that semi-elasticity of about negative 0.11, meaning a 100 basis point decline in interest rates that a locality experiences is associated with about an 11% increase in house prices. So this is going to correspond to a pretty substantial cross-sectional capitalization of interest rates onto local house prices. So that's going to suggest that areas in the cross-section that experience this interest rate decline do in fact see higher house prices relative to other areas that did not have that same interest rate decline. We can even look at consumer prices. So we do that here through a regional price parity index. This is something produced by the Bureau of Economic Analysis that measures the prices paid across different regions and different categories like goods and services. And so this one is measured at a broader CBSA level. And the key finding is that areas that have 100 basis point reduction in interest rates have about 4 to 5% increase in prices. So this tells us in the cross-section, this exposure to mortgage credit and segmentation interest rate reduction does translate to increases in consumer prices that people are paying. So this provides us, we think, really nice evidence of cross-sectional exposure. But the challenge in interpreting this evidence is the aggregation problem. This is all about cross-sectional differences and comparisons, right? It's areas more exposed to the interest rate decline have higher house prices and higher inflation relative to areas that were less exposed. But we have this important aggregation problem in figuring out how does that actually translate to a nationwide effect, right? How much of these are changes that just resulting from people buying more in some areas and less in others? To address that aggregation problem, we're then going to write down a structural model. The basic idea behind the model is to try to put down all the relevant choices households are making that map on to the spatial structure we were just analyzing in the experimental part. So we're going to have households in two different areas. Here I'm just showing you households in the low-cost area first. So households have pretty standard preferences. They want to buy consumer goods and they want to buy housing, right? So they can spend money on local non-tradable goods or they can buy housing. Housing consists of three different segments for us. You can go into rental housing, you can get a starter home, or you can get a trade-up home. And the difference is that the more expensive of a housing unit you buy is going to be associated with a jumbo rate rather than a conforming rate, right? That kind of like lines up with the conforming jumbo distinction we had earlier. So households are spending money on non-tradable goods and on housing, and we have these two areas. So the difference between the two areas is just that the house price level is going to be higher in the high cost area, and hence more homes have to be financed through jumbo mortgages rather than conforming mortgages. Households can migrate between the two areas, which is one way that they're linked. We also have tradable goods that are also a bridge across the two areas because those prices are going to clear nationally. And the way we're going to use this structure is to have unconventional monetary policy lower this low interest rate relative to the high interest rate, which is therefore going to differentially impact the low-cost region relative to the high-cost region. We're going to have these non-tradable goods and housing markets clear locally while the tradable good clears nationally across both regions. So there are a couple of things to highlight here. First is we have a model that's trying to connect housing choices and consumer goods choices. These are kind of commonly modeled differently in sort of two different literatures. We're trying to capture jointly modeling them together to get at the spillovers between purchases on consumer goods because a mortgage market condition changes. We also have a optimal refinancing block here with rate lock-in, meaning households are choosing to refinance optimally. When they get a fixed rate loan, that's not going to be a state variable that we track in the future. So this is going to give us some amount of endogenous rate lock-in in our model. This is really, really hard to do, however, so we have a lot of different market clearing conditions to solve and lots of transition dynamics. I'm going to kind of go quickly through the calibration and really just talk about the piece of evidence that convinces me that there's a reasonable model. So what we do in the model is we simulate a similar interest rate shift as we did in the quasi-experimental part as an out-of-sample test, right? So the data is the number I just showed you on the empirical side. That's what we observe in the data in the cross-section for 100 basis point change in interest rates. We do the same exercise in the model where we look across the two areas and do effectively a diff and diff in the model. What does the model think should be the relative change in house prices in response to this differential in interest rates? And the model gives us a number about 12.9%. It's pretty close to what the data suggests. It's also pretty close to what you would have guessed if you just wrote down a user cost model and tried to think about the likely interest rate impacts, house price impacts of interest rate changes. So the fact that the model and the data line up in explaining the cross-section of how responsive households are to interest rate shifts makes us think that we can now apply this to think about the aggregation problem. So what we do in the model is simulate a shock that we're writing down to try to model what happened over QE4, where we're going to have a reduction in the conforming rate, spread opening up between the jumbo rate and the conforming rate. So the jumbo rate is not going to fall by as much. The risk-free rate falls as well, and we also take into account fiscal transfers. So we're trying to model the bazooka that we did over the course of the pandemic. And here's what we observe in the first period's impact on house prices and rents across the two regions. So house prices go up by about 9% in the low-cost region and about 7% or so in the high-cost region. So a couple of things to note about this. First of all, this is a smaller effect than what we got in the cross-section in response to a 100 basis point shift in rates. What that tells us is that this missing intercept problem is actually pretty substantial. It means that if you just took that cross-sectional estimate and kind of naively extrapolated from that, you would have overestimated the impact of this policy because of the general equilibrium adjustments that come from changes in consumer goods prices, migration, and so on and so forth. Once we account for those, the house price effect is not as large, but it's still pretty substantial. It's still like 8% increase in house prices, which is roughly a third of the excess house price appreciation we had over this 4-year period. We also see really interesting things on rents. So I didn't show you, but in the cross-section, we don't observe too much on rents. However, in aggregate, we actually observe a pretty substantial rental impact. So that's, again, another place where accounting for the aggregate impacts is really important relative to just looking at cross-sectional estimates. All right, we also look at consumer goods. So we get here a pretty substantial increase in consumer goods in the low-cost region, sizable impacts on tradable goods as well. So the tradable goods are this interesting bridge that kind of transmits inflation across different areas. If you aggregate all these things up into something that's sort of CPI equivalent, so take the tradable goods and non-tradable goods, the rental component, translate that into what that would imply for CPI. That's about a 4 percentage point increase in overall CPI that the model estimates as a result of these interventions, which, we do some other calculations to kind of compare that to about that sort of 19% excess increase, total increase in inflation we had, or about roughly a 12% increase in excess inflation. So this accounts for, not the majority of the inflation we had, or even the majority of the excess inflation we had, but it's a pretty substantial component can be attributed to these policy decisions. So then we think about the transmission mechanisms. How and why is this happening? So the main two we think about are cash flow and housing wealth, or kind of valuation effects. And we also kind of contrast the different policies side by side. So QE alone is doing a good amount of the increase in goods prices. So that sort of suggests that it's helpful to kind of model all these individually, but QE specifically, so unconventional monetary policy, seems to be a big driver of these consumer price responses. Really interesting one, I think, for this crowd is the comparison of the no valuation counterfactual with the baseline. Our no valuation counterfactual shuts down house price effects. So the interpretation there is that anything that we see on inflation when we shut down house prices is likely coming through cash flow effects, not wealth effects. And we observe still pretty high inflation increases in that no valuation counterfactual, which are really, and in fact, the inflation is even higher in the high cost area. So the interpretation here is that we often think of wealth effects as being like a uniform increase in consumption. What's actually going in here in the model is as house prices go up, many households, particularly renters, are saving more because they have to actually purchase houses in the future. That actually lowers their consumer demand, their inflation pressure, and hence the net effects on inflation from this housing wealth component are muted. What that leaves as the main force driving our results is therefore a cash flow effect, which comes from households that have now refinanced or otherwise bought a mortgage and have a lower liability. That flow income is what is pushing through inflation in this model. Just say a little bit about welfare. I just want to highlight this one here in particular. This is the welfare effects in the model, looking at different dimensions. So if you just did income, you would conclude this is actually a progressive thing overall. And that's mostly coming from the fiscal transfers being targeted on income. However, if you look at age, you see that the costs of this policy are really borne by younger households, which again, primarily reflects the fact that they're renters who now have to save more to buy housing. They're buying consumer goods, which are also more expensive. The people who win are the boomers who are able to sell their houses at sort of higher valuations. Of course, this has to be balanced against other possible benefits of QE, which we don't try to model here. We're just interested in the incidence of the affordability challenges. So to wrap up, we use quasi-experimental and structural methods to try to aggregate and understand the overall implications of unconventional monetary policy. We argue that they have contributed meaningfully to house price and consumer inflation, primarily through cash flow effects, and the welfare costs of these are borne particularly by younger workers. Thank you all so much. Looking forward to the comments by your discussant.
Thanks, Herbert. Nina Bornchenko, the Fed is. I discussed.
Thank you. Thanks so much for having me to discuss this paper. We are in FOMC blackout, so I do have to say the full disclosure that these are my views and not necessarily the views of the bank or of the system, and that I will refrain from commenting on monetary policy during my discussion. Okay, so I'm not going to spend a lot of time summarizing the paper. Arpit, of course, can do that much better than I. But essentially, the question that the paper is after is whether the pandemic purchases of MBS led to a meaningful part of the recent house price and consumer inflation. The idea of the paper is to use the fact that these purchases can be done for only a specific type of mortgage-backed securities, leading to a partial market segmentation. The paper uses constructs a local exposure based on 2018 shares of conforming segments of the mortgage market and essentially constructs a shift share instrument for local mortgage rates. So, and again, as we saw, there are basically three big picture findings. First, at a local level, lower rates due to either conventional or unconventional monetary policy pieces lead to higher house prices, lower unemployment, and workers reallocating into these areas with lower interest rates. In aggregate, as Arpit discussed, using the spatial general equilibrium model, that translates into MBS purchases, amplifying both house price and consumer good inflation. And basically, the punchline of the paper is that even though, of course, there are benefits to MBS purchases, maybe if we actually think about the general equilibrium price adjustments for both housing prices and consumer goods, the overall welfare effect may be negative for some groups. So I want to talk about kind of four pieces of what's going on here. The first kind of elephant in the room is why are we talking about effects of QE4 rather than the previous three purchase programs? The second, I want to talk a little bit about the magnitudes of what we're actually estimating, circle back to what the channel of MBS purchases to interest rates and house prices is supposed to be. And finally, if I have time, I want to talk a little bit about the aggregation. Okay, so the paper, again, focuses on the most recent round of purchases. And one of the reasons for that is that until 2020 to 2022, we didn't really think about, in practice, MBS purchases maybe having an effect on inflation. As we all know, the pre-pandemic inflation environment was actually characterized by lower inflation than target. And so the question then is, what is it that actually makes the QE4 asset purchase program different from the previous rounds? The paper kind of hints at thinking about QE4 as being particularly large. That's not necessarily true. So either if you think about it in terms of pure dollar volume, if you think about it in terms of pace of purchases, it's kind of similar to earlier rounds of QE. Now, one caveat is that the first couple of months of this most recent purchase program was very fast. So the first 2 months were corresponded to an overall 700 billion of the purchases. But in general, again, the overall size is kind of similar to what we have seen before. The average pace is similar to what we have seen before. And so then it's hard to argue that the difference relative to earlier programs is the QE design. And instead, we kind of have to think about what else is going on in the economy at the same time. So the natural candidate is, of course, slack in the economy. So we know that the pandemic and post-pandemic economy was characterized by a lot of supply constraints. And so if you, again, kind of think about what's happening in the most recent purchase program as not just about shifting the MBS supply, but also hitting a different part of the supply curve for, again, for goods in general, but for, let's say, construction materials in particular, then maybe the focus on QE4 specifically kind of makes sense. Now, one thing that I would urge the authors to do is think about not just differences in local exposures to QE4, but also differences in local slack. Again, we can think about differences in the unemployment gap, vacancies, et cetera, because that would actually allow them to potentially disentangle more cleanly what's coming from just lowering rates in an economy that is supply constrained versus actual effects that the paper is interested in. Now, if we kind of think about what are the overall effects, so on the left-hand chart, I have a representation of essentially what the paper is arguing in terms of the decomposition of the cumulative inflation. My colleagues have done kind of different versions of this, thinking about the contribution from aggregate demand versus sectoral supply. I think for this paper, especially, it would be good to think about how this large global import price piece, which for them winds up being the biggest part of the overall effect, interacts with US demand, which again is supposed to be feeding back into the general equilibrium effect of either the monetary policy choices or the fiscal policy choices changing the household incentives to consume different goods. Now, let's talk a little bit about the magnitude. The shift share instrument that the paper is using is kind of similar to what some other papers in the literature on the effect of MBS purchases on house prices have done. What the paper estimates is kind of a lot larger than what that prior literature has found. Again, one potential explanation is that you are hitting a supply-constrained economy, but then the implication of that is really that it's not about the purchases, but really what's happening on the supply side. And again, like just to put this into context, in terms of the model in the paper versus, again, the user cost model, yes, it's true that the implications of the model we just saw sit kind of in between the empirical estimate in the paper and what the user cost model would imply. But it is still much, much bigger than what prior empirical literature has found. And that prior empirical literature usually talks about the effects of declining interest rates or of MBS purchases on things like housing starts rather than on house prices directly. Kind of the last big picture comment that I want to make is, again, when we talk about mortgage rates, we can think about three pieces happening. One is kind of the risk-free rate, so let's call this conventional monetary policy. Then on top of that, we have an option-adjusted spread coming from the MBS market in general, and then a primary secondary rate or spread rather that reflects things like origination capacity, intermediation frictions, etc. Now, if we think about where MBS purchases, where you would expect MBS purchases to have an effect, the primary margin is going to be through the overall option adjusted spread. I have some work with a couple of my former colleagues kind of showing that that's where asset purchases actually bite. And then what the paper is talking about additionally on top of that option adjusted spread piece is the difference between interest rates on conforming and non-conforming loans. Now, a couple of things to notice. First, the option adjusted spread in the pre-period versus, again, like on average, the 2020 to 2022 period barely moved. The wedge between, the average wedge between the conforming and the non-conforming is kind of low. And so again, in terms of the overall effect that the paper estimates, the magnitude, first of all, seems kind of large and not obviously tied to the unconventional monetary policy piece versus the conventional monetary piece that comes from a lowering of interest rates. I have some other comments that I will discuss with the authors, but just to conclude, again, I think it's a very important paper because we do need to think about how things like house prices and housing market design translates into the problem faced by households more generally, and then into things like consumer goods inflation. What this paper does is kind of take an approach that has been followed in the house price literature to look at how that then translates into consumer inflation. It's a very ambitious question. It's also a hard to identify question. And so I think in my read, it's hard to think about the effect due to QE coming from the actual design of the newest round of QE relative to previous rounds. It's a little hard to think about, again, just the pure conventional monetary piece. And so to me, this is more about what happens when you do interventions in a supply-constrained economy, more so than just a pure story about monetary policy. Thank you.
Thank you. But you run the show until we get straight.
Great, yeah, I'll just thank Nina for excellent discussion. Okay, let's start, Constantine.
Yes, so very nice paper, and this is a paper that changed my prior. So what I always thought, before from graduate school, I took macro with John Taylor, and he drilled into us that QE has no effect. I mean, whether people think that or not. And I always thought that fit the time series, and that we didn't see a lot of inflation after the great financial crisis. So I was wondering, have you thought about applying the model to other QE periods, and would the counterfactual there be large deflation during those other periods?
Yeah, this gets at a great comment by our discussant, which is like, why is QE different in this time period than not? I think her suggestion that it's about the kind of the level of the economy that we're already on makes a lot of sense to me. Let me show you one other result here that also kind of connects to that. which I think also partly explain what's going on here. So either way, it'll block something. Anyway, so if you're spread plot here, start with the gray one. That's the OAS, the option adjusted spread. That's what Nina told you should have the the brunt of MBS. And so you see that this was starting to get a little bit elevated. The Fed kind of intervenes, and you do see that OAS going down in the aftermath of the policy, right? So that sort of is one signature that when you look at the prices of mortgage-backed securities and black out the OAS, you see some kind of QE effect, and then it kind of rises a little bit after the quantitative tightening. The one on the top is the primary secondary spread. So that's asking whether the Fed purchases actually translate into rates that borrowers experience. So I think that's one thing that is different in this round compared to others as well, which is that there was an initial high spike in the spread, meaning that the OAS is reflecting capital market conditions, but borrowers aren't actually benefiting. Over time, you see that primary secondary spread actually goes down pretty substantially, back to kind of pre-pandemic levels. And that's associated with the third line here, which is employment in the mortgage industry. That really ramps up enormously. So on top of all the global macro effects, I think another effect that is different across the rounds is that in response to this latest round, we just expanded the mortgage sector capacity such that purchases could actually translate to rates that borrowers experience at a faster rate than in previous rounds.
You have a lot of hands.
Okay, sorry. Let me just collect a bunch of questions then.
So even in critical design and find there, I think policy is forced. So how would you thought about that?
Yep.
Are you able to, in the model, shut down the effect that refines in the mortgage rate lock-in, or increase the mortgage rate lock-in, and then see how much the inflation effect occurs when there's more or less lock-in at this time period? To build on Nina's point that this might be, the effect of QE in this period might be specific to the state of the economy.
You can answer some. You don't have that. I mean, we still have 12 minutes.
Okay.
Yeah. I just was trying to keep you from doing that.
Okay. Find the right balance. We haven't thought about get. We'll have to think about how to add that. It's already a pretty complicated model. I'll have to think about how to incorporate that. We have thought about a little bit your question though about the lock-in. So one of the things we get from this, I didn't highlight a ton, but in the transition dynamics, we see persistent inflation even after normalization of the economy by the Fed, meaning that the locked-in rates by borrowers are persistently adding to higher house prices and higher consumer inflation. And I think it's a great suggestion to think about what tweaks we have to do the model to shut that force down. But we kind of did it this way to kind of include the lock-in force that Lou and others had talked about. Go to Lou.
I have a kind of omitted variable bias story is very much in line with what Nina said. So basically, if you take exposures in 2018 for jumbo loans, conforming loan limits went up by 30% over that time period by the time QE hits. And there was a lot of that, I feel like, is jumbo that's refinancing back into the conforming market. And so part of what you're picking up is likely a large kind of credit quantity story, given the capacity constraints that were so important. That would give you an omitted kind of an upward bias in what you asked.
Could you comment a little bit about this conventional monetary policy happening at the same time? We have all of those papers on bank balance sheet channels and deposit channels, et cetera, that would affect bank capacity to, accommodate more jumbo rate. And also during this period, I feel like that's also when conventional monetary policy took place.
Yeah, just on those points, we try to do that in the model. So we have this kind of decomposition that sort of shuts down separately different channels, like how much of it is mortgage spread, how much of it is unconventional, et cetera. So we use that decomposition, and what we got out of it again is it does seem like the QE specific part is sort of driving a substantial amount of the model effect quantitatively. But I agree that the combination of all these forces makes it challenging to kind of think about on this issue of are there specific issues with the shares. One thing I think we tried there is we did allow the shares to change dynamically. So there you have a different identification problem, but it maybe shuts down that particular one. And I think we had similar effects with that one as well. Yeah, David.
Very interesting paper. I think it might be useful, at least for me, to connect to some there's kind of two macro literatures this kind of speaks to. One, there's one sort of about the result on inflation, CPI inflation. They estimate, Not Science and estimate sort of regional, Phillips curves and find them pretty flat, but they've gone up. I'm curious if your numbers kind of match that. And then the other one is on this role of like the pandemic work from home moving regionally and driving house prices. You know, John Mondragon and others have worked on, and Hannes Whelan have worked on this. Like, wonder if you tried like say controlling for, I don't know, like work from home interactive with time or pre-existing moving rates and by time or something like that. Because I mean, your instrument is sort of has a flavor of cheap places because it's like the conforming jumbo.
Yeah. I mean, so one thing we get is, I don't think I have it here. Maybe I have it here. Oh, we do. Yeah. So this is sort of in the flavor of that a little bit. So we have this for inflation and then here for like employment as well. So this is like sort of in the spirit of these like local Phillips curves. This is sort of like varying local exposure to interest rates. And you can just see like the bin scatter, it is moving around local unemployment and local inflation. It'd be interesting to maybe benchmark the magnitudes and see like whether the local Phillips curves kind of line up. With the work from home stuff, I'm very sympathetic to that story as well. But the kind of empirical challenge there is that it sort of mostly in our design gets soaked up by the county by year fixed effect. So we have this kind of like relatively granular set of controls to try to soak up stuff like that. But I take the point. I think we do more to find like more local variation in work from home that's like sub county year and see what we would do with that. Yeah.
So your answer to David confused me because I thought about you as connecting changes in local rates to local inflation.
Yeah.
But then you said that the design is county by year fixed effects, but
Yes.
inflation's measured at a higher level of inflation than county by year. So
yeah, so we use different levels of aggregation for different tests. So what we're doing here is looking at county level outcomes. Sorry, if we look at like this one here, like unemployment is measured at the county level, and we're kind of like residual, like we're I think in this one, I think this label's off. We're residualizing at like the state by year level. So we like residualize at like one level up of aggregation. So if we're looking at counties, we'll residualize by like state by year, or most of our stuff is zip. We'll do like county by year for those.
for inflation, it's at a regional level.
Inflation that has to be done at like a CBSA level, yeah.
And so then David's concerns would still develop with those.
Yeah, for the inflation one, yeah, that's right.
I might have this backwards, but and I'm confused by some charts, but I would have expected the action be in prices to be non-tradables and in particular non-tradable services.
Yeah.
But not all of your charts show that. There's a lot of action in goods.
Yeah.
It's not where I would expect to find.
Oh yeah.
No, go ahead.
Okay, yeah, no, that's a great point. And I think what's happening there is all the craziness of the pandemic period, which is to say like services are sort of shut down in operations. And so I think you can kind of think of this being as a high shadow price of like service operation. That's hard for us to kind of measure exactly.
You have 5 minutes. You have probably 6 or 7 questions.
Okay, let me just like take a couple then, yeah.
Yeah.
Because we show that the identification in such cases either comes from exogenality of shares or exogenality of shares.
Yes.
So in your case, you don't have a lot of shares. So it might actually, either way, have you thought about that? Have you thought about thinking through whether or not which angle of it is that exogenality of shares or random trends in shares that might actually be driving identification here?
Yeah, let me just take a couple questions, yeah.
Any question about affordability? So affordability as something like the monthly mortgage payment to buy a house. And you cut mortgage rates to improve affordability. Of course, then there's a general equilibrium offset. Prices go up. But it's very hard generally to get offset to overwhelm the original bearish effect. So how is that possible in your model?
Okay, so this maybe relates to
You've still got
okay,
5 or 6.
okay. Yes,
So-
let's go to Sasha.
Sorry, John, but.
Extent to which there was this broader like moving shock for people. Like I would consider adding like a moving kind of taste shock for people like that kind of sort part of it that John already realized paper probably a good place to help clear things on that. And another point on aggregation. So something I think find helpful would be seeing like the mapping from the durable targeted moments to the different aggregation elasticities that you get because it can be kind of like boxy and it would help understand, through that result to understand that mapping. I hope it said that.
Okay, great.
Sam.
somewhat related, your motivating figure of the discount fleet, I think is like really, really helpful. And, I'm wondering if there's anything in the instrument that could be, exploiting that discount really more precisely. Kind of what you're doing now, it picks up wealth levels, potential exposure to other things as well. So.
Steve.
Yeah, so one is that I had the same question as John, so if you have a second, I'd be curious to hear it. And then second is, in the spirit of what Nina suggested, looking at other QE episodes, can you look at also the quantitative tightening episode, the unwinding of this, and see if you get similar effects?
Anyone else? Oh, good. So you have 2.5.
Oh, okay, fantastic.
There you
So just on this, let's start with this last point about whether the size of the, let's call it the GE offset with prices is enough to offset the initial impact you would have expected. That's exactly why we get inflation in the model, right? Is that the increase in house prices, though substantial, is not enough for the households in the model to completely overwhelm their payments. Obviously, you have the in-place households as well for whom this is just like a windfall. That's where the inflationary pressures are coming from. But this relates also to the point the discussion brought up, which is like, why are these cross-sectional, these kind of capitalization effects so large relative to other things? I think there are 2 points there. One is convexity, right? We're lowering interest rates at a point where interest rates are already pretty low. I think we expect to see higher house price effects in that world. I think the second thing is that there's an interesting comparison between a cross-sectional capitalization or cap rate effect and what we typically measure and observe, which is in the time series. That's kind of exactly what the model kind of gets at too. Basically, in order for this sort of cap rate expression to hold in the time series, you sort of need people to trade off between buying and owning as interest rates change in order to equate, user costs with changes in house prices. That's hard. There are a lot of frictions around that. But in order for this cross-sectional thing to work, all you need is people to move across places to spatially arbitrage local differences in interest rates. I think that second part is actually much easier than the time series part. And I think that's exactly why our empirical estimates are all about this like cross-sectional variation in local interest rates onto local house prices actually at this higher magnitude compared to like traditional time series estimates. And even our model finds that. Our model also finds that there's a higher cross-regional sensitivity to interest rates, and with the aggregate time series effect, which is like more comparable, I think, to other papers, is like much smaller in comparison. Let me just stop there and thank everyone for all the comments. We'll follow up with you and other things. Thank you so much.
Okay, thanks, Arbit. All right, again, we have a break and we'll be back at 11:15. Yes, they're not really houses. That's a good start, yeah.
The spread. That's insane. No, I'm.
Yeah. The next big mechanism is probably. You can see how the. Yeah, I said. I wanted to see the bigger. Thank you for including one. I think we get really accepted. I mean, we expected the maps would be one. Well, it's hard to get into this when I think about it.
All right, so the final third of our morning papers and the mortgage market. It's such a nice session because we're not just talking about the mortgage market, but we're talking about the real economy effects, household finance. Beautiful combination. So, all right, David's going to present on the Danish fix to the lock-in problem.
Yes, well, thank you so much to the organizers for having us. This is joint with Jae-hoon, who's also at Duke, Julie and Maria are at CBS, and Fabrice, who's in the room, and at Baruch College. Adam said in the first session he wanted to have more work on non-American mortgage markets, and so I hope y'all are as pumped as he is. We're going to learn all about the Danish mortgage market, how beautiful it is. All right, so everyone in the room kind of knows this, but you know, the US fixed rate mortgage is like the benchmark contract for Americans, and it creates this one side of insurance. So, you know, when rates fall, what can you do? You can refinance easily, you can extract equity, you could reduce payments. Many of us have worked on that. However, we're now aware that when rates rise, households are kind of locked in. So why? Because if you move, you have to prepay at par. And so even though you might have embedded capital gains, you know, I'm locked in, hopefully many of you are too, at a low rate. I can't move anywhere, accept any job offers because I would have to, like, you know, to buy the same valued house, it'd be very expensive. That's sort of the lock-in. And, you know, Lou and Julia have worked on this and have shown that it really substantially has moved, like, decreased moving rates. So, you know, 100 basis point change in the coupon gap or decline has affected moving rates by roughly 25 to 50% relative to the average. And what this means is, you know, significant labor misallocation rates are still quite high. Frozen housing markets, and a large amount of foregone gains that consumers could use for household insurance. So the idea of this paper is, can we solve this? And if so, how? So the thesis of this paper is that, of course, you know, we could solve this by moving to adjustable rate mortgages. But we can also solve it even within a fixed rate contract. So it's not the contract per se that matters. It's this requirement that when you move or prepay, you have to pay at par. So I'm going to argue that there is a contract fix possible without moving to ARMs, right? Because you know, I think there is some value to this fixed rate insurance. So the nice thing, the way to think about this is that the Danish mortgage market has a contract that is very similar to this benchmark contract we have in the US. So it's not exactly identical. There are differences. I'll happy to talk about that in the Q&A. But for the purchase, the basic is, you know, it's 30 years, fixed rates, prepayable. But the key difference is you have this one additional right, which is that you can repurchase your debt at the minimum of par, so in its market value. And when you're in a negative coupon gap situation, when rates, you lock in a low rate and rates go up, your asset, this liability, this bond is trading below market value. So and the market value falls. So I'll talk about that. So we have 4 questions. First, does it work? Does it mitigate mortgage lock-in? And we're going to show you that empirically and in the model, yes, Danish households move freely even when rates are below their mortgage coupons. So I'll show you that. Second question is, does this affect refinances? In the US, as we know, we have an S curve for prepayment. So basically, when you have a situation when the option is out of the money, no one refinances. That's actually not true in Denmark. I'll show you it's driven primarily, we think, by tax incentives or maybe differential interest rate expectations. So sorry about that. I think the most interesting part of the paper is this, which is we're going to have a simple equilibrium model to ask, imagine we could do this in the US. Okay, how much would it cost? And the answer is going to be on average, and I think Lou's discussion is going to be a little bit about this, is like 20 bips on average, 20 basis points on average. And interestingly, so not that big, and I'll talk about why later. And the key thing is also it's going to be basically state dependent, so quite high when rates are low. Why? Because that's when the option is likely to bind. When rates go up, that's when their people are locked in. But very near zero in high rate environments. So when affordability is most binding, it's not very costly. And then finally, if I have time, which I doubt given the 20 minutes, we can talk about how does this work versus portability, assumability, and so forth. I'm going to argue that it is I think better, but we can have that conversation then. Okay, so for the sake of this talk, I want to argue that Danish fixed rate mortgages are nearly identical, and identical in the key ways that are relevant for this question, to US fixed rate mortgages. So what do I mean by that? They're 30 years fixed rates. They're fully amortizing. They're freely prepayable at par, and there's deep capital markets. Now, so this table, which I don't really want to go through, talks a bit about different, there is some credit risk, there's some differences, but the key aspects I don't want to focus on is that A, Denmark, as far as I know, is the only other country other than the US where this is widely available. Two, investors bear prepayment risk and essentially no credit risk because of the way that we've set things up. And then the key structural difference is this buyback right. Okay, so I want to argue that Denmark is the counterfactual US for this talk. Right. So let's think about it. So there's roughly two prepayment routes. There's par prepay when the option is in the money. That's when I have a 5% rate, rates go to 2%. I refinance, you prepay at par. That's just like the US. Denmark's just like that. The difference is buyback. So you have the option to buy and I'll walk this in a second, matching covered bond at the market price, deliver it, and your loan is canceled. So I'll give you a simple example in a second. So what this means is when rates fall, you prepay a par, you refinance in the lower rate. That's just like the US. When rates go up, what you do is you can now buy back your debt at a discounted price, the market price, and you can either keep the gain, spend it, or move into the equivalently value home when you have basically more equity in your house, but at a higher coupon, and it kind of nets out. And I'll walk through a calculation in a second. And you'll do this at an observable liquid market price. So let me give a simple example. I'll spend some time walking through this to kind of show how it provides some insurance or some value to one borrower. So imagine I think a reasonable situation, given what we saw in recent history. You have a hypothetical Danish borrower. It's October 2022. When they bought their house, they borrowed a million kroner at 2%. Then the market rises to 5%. I'll show you some time series. This is reasonable. You can do some simple bond math to say that this, if you think of your mortgage as a bond-like instrument, this makes the bond fall by 25% or just 75. So the first column kind of shows this at origination. Here's someone with an 80% LTV, so they have a $1,250,000 house. Okay, you can see the pre-tax payment, it's around $3,700, and the initial after-tax payment is around, $31.46. So the first thing I want to think about is what happens when rates rise? So in Denmark now, the market value of your $1 million debt, you have this liability, is not 1 million kroner, it's 750,000 kroner. Because again, your mortgage is just a bond-like asset, instrument, and when rates high, who wants a 2% yielding bond when you can have a 5% one, right? So what you can do is you can go to whatever Danish bank you work with and say, I want to, buy back my debt at this price. And you can retire 1 million kroner debt at its market price. So not at 1 million, at 750,000. So what does this mean? So let's say this person said, I want to buy the same valued house, like next door. Okay, so the house value is the same across this example, but now I'm going to put a bit more equity in. So instead of borrowing the 1 million kroner, I put the 750,000. Okay, so I just took all the 250K embedded gain I got and put it into the new mortgage. But now the coupon is a bit higher, it's 5%. You can do the simple math and find that the pre-tax payment is now 4,000. Okay, so the key first thing is ignore taxes, compare 4,000 with the 3,700 essentially. It's not that different, okay? So the point is, from a pre-tax perspective, we've already mitigated, the buyback itself has already mitigated a lot of the lock-in, all right? Second thing, now compared to a US borrower, so rather than prices going up, say 9% in the 4,000 example, now they go up almost 45%. That's the US problem. It's much more expensive to move into the same valued home now than before, okay? The final thing is, what about the refinancing and taxes? Now think about a post-tax example, right, in Denmark and in the United States. So there's two features of the contract in Denmark that I'll talk about later, which is that one, this capital gain, the 250,000, is tax-free. You don't pay taxes on it. So we'll have to explore the variation in that. Moreover, there's a mortgage interest deduction, and Danish levels of income taxation are a bit higher, so it's quite valuable there. So, and our calibration will be 33% versus the average 22% in the US. And so if you compare this sort of 31 to 29, you can actually see you can lower your after-tax payment by doing this. Because why? Because there's this more, interest is more of the value of the cost of the mortgage at 5% than 2%. So that's what you can get the refinancing boom. It's really the taxes, but the buyback, I'm going to argue, is crucial. The buyback alone is crucial for the moving results. Okay, so that's what I said. All right. So same valued house in the US. Even if rates go from 5%, the Danish person is only paying 4,000. The American is paying a 45% increase, 5,400. Okay. So let's look at the shock. So I would argue the aggregate shocks are pretty comparable. Left-hand panel shows 30-year FRM rates in Denmark. Like the US, they fell for many years, and then there was a sharp increase in 2021, 2022 from, around 1% mortgage yields to about 5%. On the right-hand side is the market prices in the covered bond market. You can see they're all around 100. That's par. Why? Because most people basically had, mortgage rates have been falling over time, so they were always kind of in the money. And then when the rates went up a lot, the market prices plummet. And you can see they go, they vary depending on what, mortgage coupon you had before. So they fall the most if you had one of these lucky people with a 0.5% mortgage rate, okay? And less otherwise. And so, but the point is, this is the time when there's a large embedded capital gain. You can retire your debt for somewhere between 65 and 80 cents on the dollar or on the kroner. Okay. So what is the data set? We're going to have administrative Danish household data from 2010 to 2024. It's roughly 3 million households a year, around 1,500 homeowners. We know everything about the mortgage. We can connect it to this covered bond. So we can track the core to the covered bond it's traveling with. So what are we going to work with? This literature, loose, very great paper. They work with the coupon gap measure. That's what I worked with in the past in the US. We're going to do something a bit different. All the results replicate with the coupon gap. We think the yield gap which is essentially the instrument that she uses, is the better measure for this. It's basically the market yield at householdized time. So it's using basically household vintage variation minus the current market yield. Right? And so again, if it's positive, you should refinance down. That's just like in the US. When it's negative, that's when you would have lock-in. You'll see people buying back. And essentially, so this removes basically all sort of identification concerns. Hopefully that this idea that, sophisticated people move differently and select in the lower coupons and so forth, because we're not using anything household specific, only household time specific. Okay. So the first thing is no controls, just to kind of show you this is Denmark. This is in coupon gap space because I want to be able to compare to lose results. The black line is the US. This is her very famous picture. As you see, as you move from sort of deep out of the money, these are people. What does a -3 means? It means people who have, rates that are 3 percentage points below the current market. They only move at around 5% per year. Then if you go to say 3, they're moving at like 8% per year. That's the lock-in. And then the dashed line is Denmark. Same space, and you see it's basically much, much flatter. That's the thing. So now I'm gonna try to show you some stuff to argue that that's kind of holds up to more empirical scrutiny. Okay, so what do? So first, let's briefly talk about refinancing. We're gonna we try to be as close as possible to the Fonseca-Lew JF paper specifications. I'm not gonna talk about all the details, you can read them. So what do we see? This is the Danish S-curve. So the right-hand side is just like the US. When things are in the money, people are more likely to prepay, and then it kind of settles off. In the paper you can read, we do with household fixed effects. A lot of this is just burnout. This is heterogeneity. Once you have household fixed effects, it goes away. The key is the left-hand side. That's the discounted buybacks. You can see in the US, this would basically be 0. My own work, many other people have shown this. Here you see people are prepaying at a pretty significant rate. Not as high on the other side, but much more. In the US, there's none of this. Now let's get to the thing we actually really care about, which is the moving part. So this is the same result with moving. First note, these are monthly propensities. And this is just like the last graph, and the level is much lower, just like in the US. So first thing, when you have a positive gap, just like the US, there's kind of an mild upward slope. Why is that? I mean, if you can, move and lower your interest rate, your mortgage rate, that sounds great. Just like US, and then eventually kind of asymptotes. The key though is the left-hand side is basically essentially flat. In the US, this is very steep, as we saw. Here, it's basically flat, and this is going to be the buyback rate. I'm going to show you in a structural model, but that it's really the buyback that is driving it. I wish there was formal, heterogeneity in tax rates to really get it in Denmark. There just aren't. So I have to use the model to kind of really tell you it's just the buyback. Okay. Then we do some other formal estimates where we estimate sort of quasi-linear specifications similar to what the literature has done. It all kind of finds things. The key result is basically it's always at this slope, no matter the controls, is pretty close to zero or even negative, and much less than Denmark. Okay, so what are the takeaways? One, people actually buy back this. And I think this is like, you might ask, why do we have to do this? Well, my own work has shown, and our own work has shown that people are very inattentive. This is a very sophisticated thing. And the fact that people are actually doing it I think we need to show it, all right? So people do it, even for refinancing. And that it does seem to affect moving rates. They're really flat in this negative gap. So it really does ameliorate some of this lock-in. So we have sort of three questions for the model. The first is, can it reproduce these results? The answer is going to be yes. Why do people refinance from a 2% mortgage to a much higher coupon mortgage? The answer is going to be taxes, or differential interest rate expectations. And then the more interesting part is, what would it cost to add this to US? So I'll focus on that part. So this is the model, the paper is for Brees. It's got some beautiful continuous time, but I'm gonna just keep it as simple as possible. So this is basically all you need. Got some risk neutral households. They have two reasons they can, there's refinancing costs and moving opportunities. Different from loose paper, they arrive as independent Poisson processes. So people have inattention, and then they decide if they want to move, and if they move, there are both moving costs, or if they want to refinance, or refinancing costs. Okay, so there's inattention and fixed costs. You can have a buyback option, so you can prepay at the minimum of par in the market. There's going to be a mortgage deductibility at rate theta I. The gains on discounted purchases are taxed at theta G. And then there's going to be competitive lenders. Okay, so what we're going to do, and that's the calibration is a little bit involved, but the main parts that are relevant for this is basically we do a Danish and US calibration. So they differ in the taxes. You see in Denmark, higher levels of taxation for itemization. They don't tax the capital gain. Here, I'm assuming it's 15% capital taxation. We could go higher. That doesn't kill the result. And, lower taxation, like lower income tax levels in the US. But the key, what we're going to do is basically match that moving hazard in both the US and Denmark. Okay, so in particular, we're going to match these moving costs to match at a zero yield, what is the average moving rate, and in the positive slope. And then we're going to run the counterfactual. Okay. So the first thing is, so this is the model now. The buyback means there's basically a model with two triggers. If you get too far away, you want to refinance. If it gets too far below, you want to buy back. That's what the left-hand side said. The right-hand side shows this is Denmark. You can match the refinancing behavior. Okay, so the right-hand side is just like the US. I'll show you later. The combination of taxes and buybacks kind of gives you the left. The red dashed line is the moving, and you can see that it's kind of flat on the left-hand side and upward sloping, and then eventually asymptotes. Okay, but I think the more interesting part is the US. I'll spend more time on this. So this is the US counterfactual. So here is basically we take our US calibration, we calibrate to US interest rates, and we just add the buyback option, and then we remove stuff. Okay, so I'll focus on the moving because it's more interesting. The blue is like no buyback in market. We kill that. And you get basically, by definition, for calibration, the Fonseca-Lu line. It's very flat, okay? Now let's add just the buyback, but no itemization, no, you have to pay taxes on the gains. That's the purple. So you can see the difference if we just added the purple. So imagine a world where we got rid of total itemization, which is kind of the world that we're moving to, because we keep making the standard deduction more and more important. That's kind of the purple line. So that alone would do quite a bit. Then if you add itemization on top of it, then you get to the green dash. It's kind of already flat, right? And then making the gains taxable or not, that adds a little bit, but that's less relevant. And I think that's important from an implementation perspective, because that actually those details matter, might have to get involved Congress. Anything that involves Congress obviously makes it basically impossible to do. Okay. The right-hand side shows the hazard, and what you can see, the left story there is there, the taxability of the gains matters quite a bit. That's the kind of the faint red dots. Okay, so what this means is if we went to a buyback, basically buyback alone removes lock-in, adding itemization helps it. To get the refinancing, we'd probably have to have capital gains exemption. Okay, but my reading in the world is that we don't actually need more refinancing, so this doesn't seem that bad a result. Okay, so to this last question, what would happen to rates? We find they go up about 20 bips. You can change what really matters is this moving rate. Okay, so what's driving that is what's the loss of moving to a buyback? Right now, if I moved, like took a job somewhere and sold my house at a loss, the lender is getting back prepaid at par for an asset that's worth less, for a liability that's worth less than that. Okay, so if you get rid of the buyback, they lose that windfall. Why is it only 20 basis points? Well, it's because these are infrequent. Many people, the whole point of lock-in is that people are not moving in this state. Okay, and so it doesn't happen that much, so it doesn't have to be priced that much. You can do a bunch of robustness. Again, all that really matters is like if you want to if you think tons of people are going to move there, then that's when that would happen. Just some interesting results. This is the state-dependent result. It can be as high as 50 basis points if you're originating debt, mortgages, and 1% interest rate. Again, that makes sense because in that world, rates are likely to go up. So this is likely to be very binding. If rates are high, it's basically zero. All right. And then if you said, an interesting question might be, what if we just wanted to have no change in rates at origination? How much would we have to raise? What we could do is say, let's cap prepayment at like par plus a premium. Okay. And then you would have to basically, the premium had to be 2%. So we would cut down on some inefficient potential refinancing, give households a little bit more insurance and not that much cost. And so basically you would have more insurance, mobility unchanged, and I think a better world. All right, so in my last minute, I'll just say the common alternatives. So I think it's realistic, maybe we should move. There are strong reasons maybe we should have more adjustable rate debt. I think that's less likely to happen in the US. The other alternatives are typically viewed as assumability, meaning someone else can take over my mortgage, or it's portability, I take the mortgage with me. I'll just first say by revealed preference, I think assumability just doesn't work. FHA loans are assumable. Even in the time of massive lock-in, roughly 0.05% of FHA loans were assumed. I think if you think harder about it, you realize why. Most moves are up the life cycle, down the life cycle. They're just cause a lot of problems there, okay? Similarly, in Denmark, loans are assumable and you have the buyback. And buybacks are like just way more people, by 40 to 1, use buybacks, not assumability. So that just says by revealed preference, they're better. Portability, I think, does a little bit of it, but it's, think about Canada, but it's blended. It doesn't work that well. And the final thing is that what do we know how to do in the United States? We know how to forecast prepayment. This is just more prepayment. So at the end of the day is I think Denmark has a contract that's the counterfactual US. It would really help ameliorate lock-in, and we could do it even without changing the tax code. So thanks, and I look forward to the comments.
Great. Thank you. We have Lulu.
All right, thank you so much for asking me to discuss this wonderful paper. Mortgage lock-in came into focus as part of the rate rises of 2022. We've now got census data that is showing us that it led to an unprecedented more than 20% decline in homeowners' mobility as opposed to renters' mobility. And so that suggests there are some significant effects on possibly labor mobility for this group. And at the same time, it seemed to have had some large immediate effects on housing markets. So just for scale, I'm plotting you the kind of peak to trough decline in US housing market transactions as part of the Great Financial Crisis. So that started in 2006, overlaying it with the period since 2022. So you see a similar kind of level and then a decline down by 40%. And kind of after the Great Financial Crisis, there was kind of a recovery after 5 years, and that remains to be seen for this episode. Now, what's going on? David already explained it. US fixed rate mortgages have this kind of asymmetric contractual feature whereby if rate gaps are positive, so meaning current market rates are much lower than what you've got locked in, you want to refinance, that's fine. You can refinance without having to distort your moving behavior. On the other side, however, when market rates are much higher than the rate that you want to lock in, you ideally want to move and kind of, kind of realize your NPV positive moving opportunities without having to refinance, but that is not available to you. And so you're distorting your moving behavior down as rate gaps are becoming more negative. Contrast that with Denmark, where basically you see you're basically shifting the kind of curve that's going down up. And so basically Danes seem to be able to pursue the NPV positive mobility opportunities without being distorted by whatever rate they've got locked in. So this is exactly where this paper steps in. It provides basically, it evaluates the Danish style buyback options in the US context using some Danish administrative data and an equilibrium model of mortgage pricing. It shows that Danish households indeed buy back mortgages at a discount to par. So many households do this during the 2022 episode. They realize capital gains to some extent, and there's no lock-in. They actually also show that a counterfactual buyback option in the US would be relatively cheap, about 20 basis points, which is much below what they estimate for households' willingness to pay. And they provide some discussion on kind of the practical issues for implementation. So my discussion is going to focus on this maybe surprising result, providing some intuition for why the buyback option is actually relatively cheap. Once we've kind of convinced ourselves of that, what would it actually take to introduce it? And lastly, offer some more big picture thoughts on the macro finance of household finance. So how do buybacks work in Denmark? Just, in pictures, Danish FRMs are backed one-to-one by a covered bond. So the kind of payments pass through all the way to the covered bond investors. And as rates rise, so yields go up, right? Remember from your bond math classes, prices are going to price the discount that you have locked in low coupons relative to market rates. And so the price is going to go down, for instance, from 100 to 80. And what Danes can do is they can buy back the bond in the market, redeem their loan, and kind of cash in the 20% gain. So they can cash in the value of the lower rate, and so they don't have to distort their mobility behavior for them. Contrast that with the US. So same rate rise, same discount, but the US fixed rate mortgage has to be prepaid at par. So what does that mean? Households only benefit from the lower rate when they can basically stay put and kind of pay the lower rate. They cannot monetize the kind of market value relative to par drop in the value of their debt. And so the first order, as David explained, the first order response to that is that households are going to move less. Right, so that's their kind of behavioral, kind of the behavioral distortion. Is that households don't want to do that. They want to keep the value of the lower rate. Now, the households that do move, right? Some households are still going to move. The curve goes down, but it does not go to zero. They're going to basically give investors a windfall. They're prepaying something that's worth 80 in the market, and they're prepaying at 100. So basically, they're transferring investors a windfall at par. And so the intuition for pricing the buyback option is basically answering the question, how much would we have to compensate investors at origination for losing the expected windfalls by movers? Okay, so to give you an example, so this is relatively abstract, right? So to give you an example, so this is the history of US mortgage rates. There's kind of ups and downs. Suppose we're in 1977, so basically in expectation, we're going to be pretty locked in. What would it take to kind of back of the envelope simulate the buyback cost? We would have to take into account kind of the rate gaps, so they're going to be negative, right? So it means we're going to be locked in based off the interest rate path rates going much higher than what we've got locked in. We're going to need to keep track of the discounted surviving loan balance, and then the windfall flow plotted in the bottom panel here is going to be some function, I'm simplifying here, of whatever loan balance is surviving times whoever is moving, given the rate gap, times the price discount that you're realizing relative to the par price. And so the present value here in this example is something like 210 basis points spread over an effective coupon paying life of about 6 years. So you get an estimate of 35 basis points. And you can do that just for fun, doing that on the US history of mortgage rates. And you see there are these kind of pockets of lock-in rates basically going up a lot, but there are also some periods where there's effectively no buyback costs. Now, of course, in order to price the cost to the investor ex ante, we don't do that on realized outcomes. We're going to simulate a long run average of the distribution of the interest rate process. And so I did that using 2 different calibrations. And you get a very similar picture. And what's actually quite striking is that when you take the average over these simulations, that's something like 19 to 22 basis points relative to the 20 basis points that they have in their baseline. So I can replicate these results. That's very good. It does suggest suggests that maybe the equilibrium effects of the model are maybe not first order, which I don't capture here. The other observation is that, as David mentioned, the spreads are high when rates are low, right? That's the most likely time period when you're going to be locked in. And so that's good responding to affordability concerns if you were to kind of put that spread in at origination. Another thing that I do want to highlight here is that, of course, everything is risk neutral in the model. And so what could be a concern for risk-averse investors, they may care about the bad paths more. So the paths where interest rates really go up and you basically face really large buyback premia. So there may be risk premia that Nina, for instance, has documented in her work on prepayment. Okay, so there's basically reasons maybe, and I want to come up with a list. Could these estimates be higher? So first of all, comment number one, kind of building intuition for why the buyback is relatively cheap, contrasting it to some of David's other work. The reason is, first of all, this kind of first order response of the causal mobility reduction. So households are kind of avoiding to move, and that gain, that kind of foregone surplus, is not captured by the investors. Like they don't benefit. If anything, it's kind of more damaging for them because that extends duration of already below market loans. And secondly, these mobility shocks are idiosyncratic. They happen in a particular state of the world, but they're not strategically distorted. Okay, so that I think that's the kind of intuition for why these estimates are relatively low. Now, of course, the natural question is, can we push these to be harder? What's the kind of range that we should credibly think about? So, for instance, there's actually quite a lot of selection in Danish markets, kind of contrary to popular belief. About half of Danish mortgage borrowers are actually ARM, adjustable rate mortgage borrowers who actually move quite a lot more compared to fixed rate mortgage borrowers. That does not matter for the calibration of the paper. It may matter for the actual implementation in the US context. And one, I try to come up with a list, here's the things in red are basically all these types of points, but basically, for instance, suppose loan balances, what could move against the investor, right? Well, what could make it more expensive for the investor to be on the other side of this? Well, if, for instance, loan balances and moving propensities are positively correlated, then you would get that the windfall that you would be giving up is larger than what you would do. And I did a simulation here where you can get a few basis points out of that. If you accumulate those, I think that gives you a more reasonable range of plausible estimates, and hopefully these are useful suggestions and easy for the authors to implement. Now, okay, so buybacks are possibly relatively cheap. So what would it take to actually introduce buybacks in the US? There's a bit of a puzzle why they actually don't exist. And so potential explanations could be that in the US, we have these MBS pools. That's quite different from a covered bond pool. We can't buy back a specific bond. And because they're basically large liquid public pools, and originators can choose which loans they put in these pools. So there's a lot of adverse selection in these markets, and the pricing basically reflects that. And so if we were to introduce that in the US, the pricing would have to basically come up with a way, given that there is this degree of selection, the kind of underlying moving propensities that I spoke about. It would require coordination by agencies, so no single bank would probably be able to just kind of do that by themselves. Taxes, we would probably need Congress to reform taxes. And maybe most importantly, in the US, mortgage loans are not marked to market. So half of mortgage loans are held to maturity or are on balance sheet loans. And so buying back the loan, the MBS or the covered bond at market prices would basically crystallize those losses. And so I'll talk about that a little bit more. And lastly, kind of to clarify and kind of, I'm all on board with kind of having a broader debate on the ex-ante design. So but that's kind of on a blank slate. How would we design mortgages for the future? And so that's kind of a solution for future US mortgage lock-in. Right now, there's a current stock of mortgages outstanding that is locked in. And that would likely be a lot more painful. So it would probably require coordinated loan modification. I did hear about kind of synthetic buyback solutions, so happy to talk about that more. It sounds a little bit like regulatory arbitrage to me, but some interesting market solutions. My last minute, I want to take a step back and kind of, we're in a household finance conference right now. So we typically think about designing contracts optimally to improve households' welfare. And in this case, this is mortgage debt. So this is kind of, in some sense, the mortgage choice is like a risk management tool or insurance decision. Now, of course, there's somebody on the other side holding this instrument insuring the household. And if we give households ever more features, somebody on the other side will have to hold that risk. And so I want to, and in this case, buybacks would basically feed mark-to-market losses much more directly into bank capital constraints exactly when rates rise. That may raise the volatility of a fixed rate mortgage system. On the other hand, it does reduce a little bit this effective duration extension that's happening from people not moving and kind of not prepaying. And so this is kind of like a call and a little bit of a kind of a hat tip reference to some of my own work that is hoping to study household behavior and financial intermediaries jointly, and to show that mortgage contract design basically, for instance, decides who in the economy, households or intermediaries, is bearing interest rate risk and what the financial stability concerns of a given mortgage design is. And this is relevant in this Danish context where pension and insurance funds are actually, I looked this up, marking to market both their assets and liabilities. And so the last picture that I have here is, in the US, 60% of mortgages are actually held by banks. So that's MBS as well as loans and portfolio. Whereas in Denmark, 60% of fixed rate mortgages are actually held by insurance and pension funds. And so that system jointly seems to work better together. So to conclude, this is an excellent paper. It connects proof of concept in Denmark with a pressing US mortgage design issue and offers credible quantitative estimates. Buybacks seem relatively cheap, want to see a range and a little bit more robustness on that, but I think it's broadly credible. There are institutional frictions that matter for implementation. But as always, I learned a lot from reading the paper and look forward to future versions, and I'll leave you with that. Thank you.
Questions for David?
Okay, I won't respond to say that discussion was excellent. Thank you. Harpreet?
So you model your buyback as the minimum, right, of par value and market value. I'm wondering if you just have tried modeling only market value, right? So that's comparable to how defeasance was in CMBS, for instance. So that would also probably limit the wedge, but offer like a much bigger affordability discount to all households that are not paying.
We haven't done that, but it's interesting to think about. Yeah.
Great paper on bias. I think Denmark is a great counterfactual for the US. One, I think you're underestimating how cheap this up will be because, as I was thinking about, you're not modeling the OAS spreads, and because there's less convexity on the downside, that's one of the main reasons why covered bond rates in Denmark are low. That's number one. Number two, in general, Danish moving rates are much less sensitive to monetary incentives because Denmark is so small. There's essentially just 2 or 3 labor markets, and if you get fired or if you move to another job, that doesn't require you something to think about.
Pause there for a second. I was speaking for my spouse would say the US is a good counterfactual for Denmark. Oh, no, right. Right. Sorry.
I appreciate it. Helpful.
When adding optionality, it's really important to think about who exercises that optionality. In the US, there's a large cross-subsidy between those that are sophisticated and not. And in Denmark, that cross-subsidy is even larger. So just thinking about the welfare benefits would accrue to those who both refi and buyback, who are likely wealthier, etc.
Okay, so can I respond a little bit? Yeah, so that's interesting. Okay, thank you for that. Very interesting questions. It's interesting for you to say that you think that Danish households are less responsive to financial incentives in the United States, because actually when you estimate those like S curves for refinance, they're actually way more likely to refinance and than sure, because of Copenhagen. Yeah, so we've thought about trying to do a comparison. We wish we could do it like compared to the greater New York area or something like that, or metro areas. I agree with that because that's a fair point. On the sophistication point, I take your point. I've worked on this. I agree. There's lots of the current mortgage system currently has lots of cross subsidization from sophisticated borrowers to not, and the buyback is a sophisticated instrument. I will say, I guess what I would say is I take your point. I don't know of any evidence that says it's like more severe in Denmark. I'd love to hear about that. But I would say relative to the other options that people have talked about, assumability and portability, our point is once I started thinking through, those would also privilege sophisticated borrowers too. I mean, imagine a world where I'm choosing who gets to take over my mortgage. How is that going to be? And who, I mean, that just sounds like a logistical nightmare, so I think that all the other possible solutions also have this issue. But I take your point that it's a real something that we should think through.
But I was wondering, you could
talk a little bit about the cash out refi in your model? Because once you give people the option to decide the option, you also let people doing some cash out refi, because they can repay at a lower price and then extract equity, and that will depend on how much home equity they have first place. So we're capturing that actual from the model.
Yeah, so in the model, we're not capturing that. We have other models which tried to do that. It's a good question. I mean, in practice, we've actually looked in Denmark empirically, what are people doing when they buy back? And it's half of repaying higher interest bank debt. So like repaying debt, and about a 20% doing cash out refinancing. You might actually think that might be higher in the United States. So yeah, that's something we should think about more in the future, but it's not in the current model. Paul?
Bank account is amazing. So what's the other side? So like just steel man patent. Is it just a pure patent patents that we talked about in this? Is there any motivations on mastering what?
Okay. Why? Well, yeah, I mean, I think, so what are we considering? So, no, this is a great point. I think the stillman is, so in Denmark, in the cover bond market, there's an observable market price. What would the market price be in the US? And right now we're considering, and I think all the concerns, looming up, like, why are we not seeing this? The adverse selection and the administrative coordination are huge. We're thinking about doing it all at once. Like, I don't have anything to say, and I think we need more work on like product adoption. We don't, to my mind, it's actually surprising we see so little product adoption. I have other papers arguing about auto refining mortgages and thinking about that. But I think the main one is this market price. What would it be? We have a very liquid TBA market, and would we mark things to market and not, and would we change accounting rules? Those are the kind of the devil of the detail stuff that I have less expertise in them. Steve?
Just on a related point, and you've worked on, why don't we have mortgages that just automatically adjust down, but don't adjust up, right? And would that be a competitive?
So that's a great question. I have a paper that's thought about that. So that would be great, but that would remove a lot of the cross subsidization that I was worried about. Like, so right now, in this other paper I have, I use the example of Joe Vavra, my co-author, who is very sophisticated, has refinanced 6 times, and my mother, who, has better things to do than talk to mortgage brokers. But there's a massive cross subsidization from my mother to Joe. The issue that I think there's 2 reasons why. I think the one reason why is that it would be quite expensive. We estimate in another paper that it would raise rates at origination about 100 basis points or 90 basis points, which for a lot of people are at DTI constraints would really hit them. I think the second one is, I remember talking to someone at Quicken Loans who would probably be the people, they've thought about this, but they were like, what MBS investor wants to buy MBS from an auto refining loan? So they were very concerned that like no one would actually want this product. So I think that's the answer to that question. Yeah.
How would in the model or data you see a mapping from this to house prices and that relating to the actual mobility?
I don't see any mapping. It's not in the model. That's why, and exactly. We thought about trying to do it empirically in Denmark, but there isn't, again, Denmark is a small country, the cross-sectional variation, it's hard to do, but
would that be a link in the way that would affect the fee channel? The channel with interest rates go up, ETF demand goes down.
Yeah, prices fall.
But you're gonna unstick supply.
Yeah, we would unstick supply, I guess that would be. I think prices would fall more. Yeah, I mean, and that's another thing too. I mean, this is not a macro audience, but I think this is a general point when you're thinking about the monetary transmission mechanism. Like, it's a bit of a there's a whack-a-mole problem. Like, we have this great contract in the US for households on one side, but what happened is house prices didn't move. So we kind of had that, Denmark, they have buyback, but house prices fell a lot more than the United States. So you could pick, you kind of have to pick the outcome you want. You can't solve all the problems.
You have 5 minutes.
Yes.
Yes.
Brittany, should I take all the questions?
No, you can manage it however you want.
Brittany?
You've got 5.
Thanks. So my question is, who is the investor holding these Danish loans? I was thinking maybe they are pooled like the US, but then it seems like maybe they're not pooled. And is the pooling sort of embedding more correlation in the moving shops? So it seems like if there's just banks holding mortgage loans, then let's say there's a couple of national banks, I'm not sure how banking works, and then people move, maybe they are idiosyncratic shocks to a bank holding the entire mortgage funds. However, if there's in the US pools of mortgages, and those pools of mortgages happen to have 4 loans of a certain demographic type, and then those people are more correlated in their moving behavior, maybe these aren't. idiosyncratic shocks to investors. And the second thing is, how do prepayment penalties factor in? Because it seems like prepayment penalties may be doing the opposite, in some ways of, this buyback at a discount, because you're actually charging people an extra fee to buy back or refi.
Okay, so to your first question, so banks, so to lose great word, banks don't hold the assets in Denmark. It's Danish pension funds. I mean, I think an interesting question is like, why does this structure exist only in Denmark and the US? And one answer is there's a natural buyer of kroner denominated long assets. It's the pension fund, and so that's why. The banks aren't. Banks are essentially what are called mortgage institutions, pass-through entities. I mean, literally, they get a fee for holding credit risk, but there's recourse in Denmark, so there's not much credit risk. Does that answer your first question? I hadn't thought. No, they're pooled. They're in these cohorts of 50 bit. Yeah, they're pooled. Yeah.
Down to a couple of minutes, so you wanna.
Yeah, I haven't thought about prepayment penalties, but I would actually solve a lot of the sophistication stuff that I was talking
Why
about.
don't you take all the.
Let's take all the questions. Yeah, okay.
Yeah.
Finance behavior also. Principal is for only mortgages, and they used to where you only pay the principal at the very end. That used to be a big thing in the Netherlands before it was kind of regulated out. Empirically, is that a thing in Denmark? And in the model, it seems like that could be potentially quite beneficial and would mitigate some of the benefits of the buyback option.
Any other questions? Fabrice, do you know about the interest only? Didn't they used to have a fee?
In the model, it seems like in the model that would be really beneficial potentially, because that and would mitigate some of the benefits of the private option for the people that don't know stay in the thing. I'm sure.
Yeah, I'm not sure. But I mean, what we'll say, Denmark is different. It's not like there's an arm share of 15% like in the United States. It's 50%. And people move. Some people have FRMs, they have arms. So it's people are much more willing to choose different contract choices. Yeah.
Great. I think that's.
All right. Thanks so much.
Great. And that takes us to lunch. So we have an hour. We'll be back here at 1. Lunch is down at the end.
Right.
Are you still?
Yeah, we, yeah. Always have a good. Yeah. You can tell we try to. Always do.
Yeah.
I'm good.
Yes. I mean, and it was a great. I know, well, I feel like I waited my whole life to ring the bell, so you know, so, we're just gonna be our lightning round session, so we kind of love to squeeze a few extra papers onto the program, especially ones where we request the authors to communicate their ideas concisely.
No pressure.
This session will have 13 minutes, for the presenter and then 9 minutes of discussion, so. Go ahead.
Great. So thank you very much for having our paper on the program. A starting point is that all finance decisions, including, of course, then all household finance decisions, are all decisions about allocating resources over time. So they all ultimately depend on perceived real rates, which, in this simple form of the Fisher equation I'm writing down there, do depend on subjective expectations, especially individual expectations about inflation. And so, of course, we know in theory, not only perceived rates should drive all of the decisions we are talking about, even in the conference, but also then that if there is heterogeneity in those beliefs, that should be an important source of heterogeneity in choices. Now, unfortunately, we haven't had as much evidence, direct evidence of this connection, largely because we didn't have, for many decades, direct data on expectations that we could map and connect into households' choices. And I would argue that over the last couple of years, the literature did substantial advancement in that sense. So we know now directly that whatever people think inflation will be affects their choices going forward. What the literature still doesn't really understand very much is how are those beliefs formed? Why are they heterogeneous? And why do we see some systematic differences across different types of agents? And so the first time we're doing this project is we ran what we think is for the first time a global elicitation of household consumer beliefs. So this is like 47 countries, a bit less than 50,000 households.
They cover about 90% of global GDP. So I'm showing you here in this map what are the countries that are in our sample. So what do we find? I mean, we use the first part of the paper, which I will not focus too much here, in trying to see what are like systematic universal facts about expectations that we can rely upon, given that the literature hasn't really necessarily found so much consistent evidence over the last few years. What are like the three facts that we see in the data are, universal, if you want, about beliefs. First of all, dramatic heterogeneity, both across and within countries. Second is inflation and other expectations, as I will show you later, are systematically positively biased. So here I'm showing you the distribution of inflation beliefs. On the x-axis, you have the values. You can see that this distribution actually goes to values that are substantially higher than most of the inflation rates we would expect to see in countries, certainly in the US, even during the COVID-19 bias. So this evidence in many countries has been often considered like a way to say that this data doesn't make any sense, because it doesn't make sense that people think inflation will be 60%. Now we know instead in the data that those people do make decisions based on that type of belief. So they are using at least those beliefs. And the third fact we find here that, again, I mean, it seems to be universal, is that systematically certain demographics are correlated with higher biases in subjective beliefs. Now, the one I'm showing you here is the so-called, the famous gender gap in expectations, the finding that women tend to have systematically higher inflation expectations than men. So in particular, in this graph, each of these dots that I'm showing you is a coefficient of a regression. On the left-hand side, what is the inflation expectations of the individuals in a country on whether this individual is a woman, a large set of characteristics, and so on and so forth. And so what we find is that indeed for the extremely vast majority of these countries, that difference between men and women seems to be there. The only exceptions I have there, it's for countries where inflation rates are systematically higher than normal, like 50 to 100%, Turkey, Argentina, and so on and so forth. Right, so how can we explain these facts? The only reason why we care about these facts is, can we inform then advancement in theory in trying to understand how people form beliefs? Well, we certainly know that the standard benchmark, which is a useful benchmark, obviously not particularly realistic, FIRE cannot explain these facts. It cannot explain heterogeneity in expectations, let alone a systematic bias in those beliefs. But also standard rational inattention frameworks, they could explain heterogeneity, but not really a systematic bias in beliefs. Because I mean, in those frameworks, whenever the agent obtains information, they actually form their beliefs that are in line with the actual data, with the aggregate level. So is there any way in which we can sort of leverage, if you want, the data we have to look at facts that potentially can inspire parsimonious adaptations of rational inattention? So what the literature has mostly focused on over the last few years is trying to model in some kind of mistake agents might make in processing the information they get. So they do get information, all they get the same information, but then certain agents process that information differently than others, and that leads to heterogeneity, potential biases, and so on and so forth. What we put forward based on the data that we have here is potentially taking a different route, which is not necessarily that there's mistakes or differences in processing information, but that the sources, the signals of information about the economy that agents are exposed to are systematically different and often non-representative of aggregate variables such as inflation. Now, in particular, what I will talk about in the last couple of slides is like this idea or taxonomy, if you want, of local information sources. So this would be getting information about prices and other economic characteristics from shopping activities, from utility prices, from gas stations, family and friends, and so on and so forth. Now, we can think about this local sort of economic information if you want. Ironically, the islands model by Lucas actually did say that. So people get information from their local island. But of course, in that type of model, there's noise in the signals people get, but those noises are averaging out. Whereas, as we will see later, this is not the case in reality. Now, the second set of sources are what we normally as economists think is sources of information about economic variables that people look at, which is the actual public information about, for example, the inflation rate in a country, which is known by everybody at each point in time. So what do we find? Well, when we look at first of all, what are people's perceptions of what is inflation in their country, what's been inflation in their country over the past 12 months. So here we are talking about information that is public. Everybody can say what the rate is if they look it up or if they're aware about it. So I'm regressing for each of these bars here. I'm showing you the coefficient of a regression where the perceptions of expectations over the last 12 months are regressed on a dummy variable for whether the respondent says that they're using each of these information sources and a large other rich set of covariates. And so what do we find? Well, indeed, we do find that there is systematic, dramatic heterogeneity. Based on the sources, the signals people are seeing, they actually believe even think that what has already happened is different across each others. That's what we call, if you want, in the paper, the different sources of information have different quality in the sense that they're not as representative of the aggregate variable that these people are trying to forecast. And then so when we move from the perceptions to expectations, we retrieve exactly the same pattern. So here I'm running the same type of regressions at the individual level in our setting, expectations about inflation, on what are the information sources people have and other characteristics. And we can see that systematically for those that are attending more to aggregate sources, those beliefs are lower, they are higher for the others. So we find that the same exact pattern is true not only for inflation expectations. We focus on inflation expectations not because we are, obsessed with that. It's because our models say that that's what matters. But if you look at house price expectations, interest rate expectations, same exact patterns in the data. And also, given that we have all these nice cross-country heterogeneity, if you want, I can ask the same question also country by country, similar to what I showed you before for the female regressions. So here, each of these dots you have in each of the panels is a regression of inflation expectations at the individual level for people in one country on whether they're using that source of information and other characteristics. What do we find? If you look at the last one to the top right there, government reports, for example, those that actually look at what we call as economist aggregate information form universally around the world lower inflation expectations, whereas the opposite is true for people that are attending to more local sources. Of course, there's tons of observables and unobservables that will predict sorting into sources. So what if we fix the source of information and we look at an intensive margin? So what is the extent to which people actually are exposed to different signals from the same source? So what I'm showing you here, we can do it in our data for two of these sources: exposure to grocery prices through shopping or exposure to gas prices, to the extent to which people go and buy gas at gas stations. And even at this intensive margin, we find the same correlation. So the more you are exposed to that local source, the higher are your inflation expectations. Now, after we see, these kind of correlations in the data, we can go back to the question that, so far as, if you want, has been the biggest puzzle in the literature. So why do we see that certain demographics have different inflation expectations? The famous gender gap that nobody really understands why that should arise. So we do find in the data that indeed these same demographics gap are arising. But then, contrary to what we believe the literature has thought so far, which is that those gaps are arising from different processing of the same information, what we find is that once we lock in the information sources, these different demographics are forming beliefs exactly in the same way. So just to give you an example of what I mean by that, so here I'm looking at the same set of regressions we had before. On the left-hand side, looking at people that have a college degree. On the right-hand side, people that don't have a college degree. This is in the literature one of the largest, most common ways to capture sophistication and so on and so forth. The patterns are basically identical once we fix which source of information we are getting. Of course, college degree will predict which sources of information we are looking at. So a college degree individual is more likely in our data to look at government reports. But then once that is fixed, we find the same. Even if we focus on economics degrees, so people that we only look here, people that do have college degrees, those that have a college degree in economics versus others, once we fix the source of information, we obtain the same panel. And then finally, one of the ones I want to show you for this shorter presentation, the gender gap we talked about before. That's also true for the gender gap. So, Anil Kashyap famously said once, if you don't explain to me why the gender gap arises, I don't buy the data at all, it doesn't make sense. And indeed, the gap, there's no difference between men and women as we would expect in the way they form their beliefs. It's just that they're systematically exposed to different sources. Now, very last, in the last 10 seconds probably that I have, so is there any sort of overarching characteristic, if you want, that we can see that is systematically related to sorting into information sources and explain this sorting more than demographic characteristics? Of course, in our setting, there's nothing we can do in terms of identification. So this, what I'm showing you here, is not even a fact. Is I think what Adair was telling me once in the PhD, it's factoids, because there's no identification at all or attempt to make a causal claim. But what we see in this map I'm showing you is like variation across countries in the relative extent to which people attend to local information sources instead of aggregate sources. We can see that the darker a country is here, the more people go into the local instead of aggregate sources. There's countries where this difference is starker, like Russia, but also the US and China, for example, have the same disagreement in terms of these two sources. And in spades, much more is in the paper, but I don't have time to go into the details of what else we do. The one characteristic we found that is systematically correlated with sorting into sources is the extent to which people trust the economic institutions in their country. So here I'm showing you at the same sort of country level regressions we had before. On the left-hand side, what are the beliefs, the likelihood that people sort into each of the sources that I'm showing you there. And on the right-hand side, whether they trust the economic institutions in their country, central bank and government. Not surprisingly, they'll read the government reports if they trust the government, but also this sort of dimension predicts that. So that's also my bottom line. What do we want to try to propose with this paper? First of all, the quality of the sources of information seems to be crucial and potentially an overlooked dimension in the literature so far. And second, if people don't trust the institutions that are producing aggregate information in their country, they will refuse that data. So we shouldn't be that surprised that even if we tell them what is the inflation rate, these people don't react to that information because they don't think that that piece of information is true or reliable. So thank you all very much for your attention.
Yeah, 8 minutes per question. Use it however you want.
Oh, thanks. Yeah. If there's questions, I'll take them. Yeah. Cool.
Do you think of this relating, so Pischke has this paper thinking about individual income versus aggregate income fluctuations?
Oh, yeah.
And his point was people's incomes fluctuate a lot more than aggregate income, and yet pointing to the consumption doesn't seem to move at all with aggregate income. His point was well, it doesn't matter. Your consumption is based off of your individual income, and is that sort of the story? It seems like a very related story. Is that why should I care about what the aggregate inflation is? Same story. I don't really care about the aggregate income unless it's sort of a signal of some large change. Is that kind of a related?
Yeah, totally. It's a great point. So first of all, and I didn't have time to go into that here, but so we also look at people predicting their own sort of inflation, for example, in their baskets. They are wrong even there. So when using different sources of information, they're also wrong there. So one of the reasons for that is that, for example, focusing on prices such as shopping, like grocery prices and gas, these are part of the consumption baskets of these individuals that are growing in prices faster, for example, related to electronics and others, or rents and so on and so forth, and also that are more volatile. And so what you see in the data is that people also focus more on salient sort of price changes, so larger increases than decreases. So on the one hand, if you want, you can think about what I showed you here also in terms of their personal income, they're wrong. So in terms of then what matters for the decisions, it's both, I would argue. So for some, for example, of the mortgage taking decisions we were talking about today, the aggregate rate would matter.
When you say they're wrong, you mean based off of some aggregate number that you have for that element of the factor, right? Like you don't
Oh.
actually see the consumption.
So in other work, we do see their actual consumption baskets. Yeah, so it's not here. Yeah, here you're completely correct. We don't have like the exposed baskets. In other work we had with Michael and Ulrike, we do observe from the Nielsen data their baskets directly, so we can look at that.
Find the same thing.
So there.
That's the prices of things that they're actually buying.
Yeah, so yeah, they overestimate their own inflation. So there we can compute households level inflation, and we know what their expectations about their own inflation is, as well as aggregate inflation. And even their own inflation expectation is higher than their actual household inflation, yeah.
Yeah, I'm interested in this last bullet you have there because the polarization of inflation expectations in the US is very strong. And I'm just curious what this looks like internationally. It sounds like maybe that's like another survey or something you would design.
Yeah, so it's great, and great to bring it up because in some we are running other ways of this survey, and that's exactly the part where we have been asking a bit more. And interestingly, I mean, it seems like that dimension indeed is like becoming very, very common across countries. So in most countries, there's political polarization that attacks economic institutions, and so even in these other countries, we do see that there is substantial polarization in beliefs, and that correlates with the extent to which people trust the economic institutions in their countries. Yeah, please, Taha.
How much of the debate comes from people disagreeing about past inflation versus people who agree on what inflation has been last year and disagreeing about inflation? I think that a lot of what your sources of inflation, I think, is the backward-looking. A lot of these sources of inflation speak about the past, and I'm just wondering if we should think that maybe politics or other sources will explain why people who remember the same thing.
I mean, actually, I disagree afterwards. It's a great point. So we haven't done it here, but we can actually, in these simple splits, again, there's no exogenous version here, but we can look into that. I mean, we fix the perception and check like whether there's a systematic heterogeneity. We haven't done that. We'll do it. Yeah, please.
So when you look at people who, for example, get information from utility bills, can they at least predict their utility bill?
So interestingly, no, yeah, even at least in the category. So in this other work that we have, no, so we find that they don't really. So there's always some. They don't, yeah. Well, it's also very hard to predict grocery inflation because that's very volatile.
We could either.
Yeah, I mean, it's a good question.
I have no
I
idea.
agree.
Milk is more expensive and sometimes at all. Right, seriously, right? It's really.
Yeah.
Like that's the bigger point of the question is like, is there anything we can take out? Like, are we all just making mistakes all the time? Because we're on a general upward trend, everything seems to be upward bias. We're on a general downward trend, whatever we should be down.
Yeah.
Then that's super interesting.
Yeah. Please, Shesha, yeah.
And to have the same distribution of like local versus global on all things, or is it kind of fragmented in the sense that if I were gonna buy something big, like a car or a house, I would look up official government statistics, something like that. But whereas food prices, like I would, put more emphasis on like what my friends said or what my family said. And so you can think of the distribution across different sources depending on how big.
What actually station?
Or is it just like, look, if I'm a local person, I'm getting all of my information about everything
From that source. Yeah, it's a great point. And again, so not here in this paper we have because we only have this cross section and only basically the questions I showed you. But there is other work in the literature, not by myself or any or Michael, who's my co-author here, that actually shows that typically actually people don't use different sources of information when making decisions even about big, large ticket items. Now, interestingly, also when taking a mortgage, for example, which is the choice we were discussing the whole morning, a large fraction of individuals is not informed on the aggregate inflation or aggregate interest rates levels. Of course, I mean, a different question could be, is there a role for the supply side? So maybe I don't care about knowing what the rate is because when I need a mortgage, I go to the bank and the banker will tell me all the information or they will tell me what to do and so on and so forth. Which I can't answer this data. There's any more? Okay, Sasha, please.
I'm wondering if you pointers more sources that better,
Oh, yeah.
more on that, you know, how strong that relationship.
The relationship, yeah, it's a great point also because we do have that variation because I mean, for each of the sources, people gave some kind of a Likert scale. So we do have people that tell us basically, I look at all the sources or I look at none of the sources. And so interestingly, what you find is, and for people that look at all the sources, for example, they still have upward biased beliefs. So the presence of local sources, irrespective of whether you are also claiming that you access other sources, is pushing perceptions and beliefs up in both cases. Yeah. Thank you so much. Yeah, thanks.
Next up, we will have Spencer presenting gambling for gold. So Spencer, you have 13 minutes.
Hi, everyone. My name is Spencer Kwan. I hope you can hear me well. Super excited to have the opportunity to present this paper. Thank you for having the program. Looking forward to any comments. This is joint work with Costas, Dominic, Claire, and Hyunju. Dominic and Claire are on the market and they're fantastic. So please be out on the lookout for them. Okay. So I want to start us off by just pointing out two pretty salient trends in advanced economies today. The first is that the young are miserable. You know, earlier I was hearing a lot of things about how to think about mortgage refinancing, and I was feeling very poor because I couldn't even afford a home in the first place. Housing's unaffordable. You know, we think that generally there's a fall in upward mobility, and you know, our idea of even economic success might be increasingly distorted and influenced by what we see on social media. And all things considered, this as a result means that the youth increasingly perceive conventional economic goals as simply unattainable. And that's why we're miserable. And people have sometimes referred to this as financial nihilism. In tandem, another force in advanced economies is a market rise in high-risk financial investment type behavior. So an interesting FINRA survey states that half of active US investors under the age of 35 have held cryptocurrency, 40% have traded options, 22% have even traded on margin. I don't know if you checked the news, but 1 in 30 South Koreans got margin called last week. And in general, there's an increasing concern about speculation in stocks, option prediction markets, cryptocurrency, sports betting, all of these things throughout the world. And the question we want to ask today is, well, is there a connection between these two forces? That is to say, can economic frustration and financial nihilism help explain the rise in high-risk financial behavior? And I think the point is most eloquently made by an anonymous Reddit user in 2022 who stated that I invest all my money in crypto, and I'm aware of that, which is good, but it is my only way to ever achieve my dreams and financial independence. Fortune favors the brave. And this idea has a pretty surprisingly deep intellectual root. 80 years ago, Milton Friedman and Audrey Savage wrote that, you know, an unskilled worker might jump and accept an actuarially fair gamble for the small chance that it might uplift him to some different social class. Men will and do take great risks to distinguish themselves even when they know what the risks are. So sort of the objective of this paper is to take this idea seriously, embed it in a model, and test it in as detailed of a data that we can get our hands on. So first, we develop a theory, a simple model rooted in Friedman and Savage, where the presence of hard-to-reach salient financial goals endogenously generate an appetite for gambling. And the key takeaway here is that one's risk appetite is not just intrinsic, but is to a large degree shaped by one's economic circumstances, in particular how far is one's salient goals. We then take this theory to the data where we can test it on a linked admin and survey data in Korea. And critically, we have two forms of tests. The first, most on the nose, is that hard-to-reach financial goals or the identification with these goals strongly predict the appetite for high-risk investment. But the cool thing about this data is also that we can hold fixed an individual and follow that person throughout the panel and show that shocks to one's economic circumstances, in particular changes in these distance to goals, changes one's risk appetite and within person test. And the highlight result I want to say is that for people whose dreams of attaining a house is significantly achieved through a housing lottery, shows a marked decline in crypto usage. And we also have a similar result in the other direction. And lastly, if we have time, we briefly explore, using a simple calibration, the welfare implications of gambling motives. And here we show that once you allow people to make mistakes because they have wrong beliefs about, say, cryptocurrency, the gambling motives can greatly amplify the harms or the welfare costs of over-optimism. So that's the paper in a nutshell. Obviously, this paper is motivated and is inspired by a large literature documenting economic frustration in the world, and we're really thinking about sort of the implications for the household finance, in particular risk-taking by individual investors. And in that sense, our paper also relates to a really, really cool literature on the foundations of risk-seeking motives. We take some of these ideas, formalize them into testable predictions that we show in the data. And finally, of course, our paper also relates to a large literature on retail investor behavior. I think here the point I want to make is that there's not something intrinsic about retail that we're interested in. Rather, given any person, we're really interested in showing that changes to their economic circumstances, that is to say the situation, not the person, might have a large sort of explanatory power in determining the effective risk appetite of a person. So let's dive straight into the theory. Very simple theory. It's just a standard, intertemporal model, except the only twist is that an agent can attain a quote-unquote goal, which is discrete, 0, 1, paying cost capital G. You can think of this as a home ownership or so on and so forth. And the technology that the agent has at their disposal is just a safe asset, like putting your money in a bank, or a fair gamble. So it's any gamble you can design that is constrained to be actuarially fair. And just from this very simple setup, what you can see is that the presence of a discrete salient goal locally convexifies your utility over wealth. And this is very graphically similar to what Friedman and Savage have sort of baldly stated in their paper as the, quote, typical shape of a utility function over wealth. But you can see that this is a microfoundation. So we do a couple things in the paper that we don't have quite time to go over, but the general takeaway from the theory is that one's risk appetite is significantly determined by one's economic circumstances, and this Friedman-Savage motive for gambling really appeals to people that we call are in the unhappy middle. Those that are too poor, it's not going to make a difference whether they gamble or not. Those that are too rich don't need the gamble to reach the goal. It's really the people who are in the middle who can kind of see a vision to their goals if their risky gamble pays off. Second is, given that gambling in this framework is a means to an end, there is also a notion of an optimal gamble. What gamble serves your goal the best? And the simple theory is that the farther you are away from your goals, you endogenously prefer much more right-skewed risk. And the intuition is very simple. I'm not interested in gambling unless it enables me to attain that goal. So the further it is, I really want it to matter when I win. And that's an interesting perspective on why maybe the youth avoid stocks. It's the problem with, for a desperate person, the problem with a stock is not that they're too risky, so you avoid it, but they're not risky enough. Like, what is the whole point of investing in a stock if it's just not going to get me anywhere? Okay. And then, of course, if you think about more of a dynamic version of this, shocks to one's economic circumstances and distance to goals should shape your total endogenous demand for gambling, where gambling should decrease if you attain a goal, and it should increase when the goals get farther away. Okay, so testing this, it's pretty tricky because it really requires a lot of data sort of systematically that combines one's actual gambling or risk-taking behavior with a broader picture of your economic circumstances. And we were fortunate enough to find such a data set in the Korean context, and which is, the data is great, but also it's a great context because as a Korean, and maybe to other Koreans in the room, I can attest that the youth in Korea are equally, if not more miserable, with even worse housing affordability, dropping fertility, general rise in economic discontent and unhappiness. Okay, so we can dive straight in. I have 5 minutes. All right, so just to briefly describe the data, it's a new merged data set of Korean households monthly that combines 3 data sets. The first is the credit bureau data, which contains most grown Koreans. Merged to that is the largest credit card company in Korea, so that we can see granular consumption data. And finally is the largest telecommunications company in Korea. You can think of it as Verizon, which gets us a great deal of visuals into what kind of apps and what they're paying attention to at a monthly frequency. On top of that, we also got SKT, the data vendor, to also agree to survey a small group of these people based on the admin data variables. So we have a survey linked to a 2,300 respondents, a much smaller sample, that asks about things that were not observable in this detailed admin data, such as their financial goals, their distance, and their general risk preferences and beliefs. So that's the data. So in the interest of time, I'm just going to dive straight in. what's the most on-the-nose test of our theory? Do identification with salient financial goals increase your demand for risk-taking and gambling? And we find that across all the goals, each row in this graph is a type of a goal, from homeownership to other things. We see that a stronger identification with any of these goals is typically associated with a strong increase in the tendency to buy a lot of cryptocurrency. In particular, what's also surprising to us was that we thought it was going to be a lot about housing, given the sort of narrative about these things, but it's also considering a lot of other goals, especially status-oriented ones, such as general recognition, social standing, even romantic attractiveness, which kind of surprised us, which sort of ties us closer to Friedman and Savage's original point. It's not just about housing or some intrinsic indivisible good, but some notion that we are really trying to gamble to attain some kind of a greatness recognition. In particular, one standard deviation and increase in goal importance is associated with roughly a quarter rise in the probability of holding a significant stake in cryptocurrency. And if you put everything together, so your beliefs, your goals, and your intrinsic risk preferences, we show that the goals seem to have a fairly strong predictive effect on your total holdings of cryptocurrency. And one thing that's also interesting is that it takes away the explanatory power of the risk-seeking or risk appetite measure, which is sort of consistent with our interpretation that these goals can be a significant shaper of one's effective risk appetite. Okay, so finally, if you hold fixed a goal, so we can see in our survey people who say that housing is their most important goal, you can show that the interest in cryptocurrency is hump-shaped. That's to say that it appeals most to people in the middle of the asset distribution. And again, this is sort of suggestively consistent with the theory. Too poor, you give up. Too rich, you don't need the risk. And it's really appealing to the unhappy middle. And that's an interesting contrast with stocks, which is much more monotonic across wealth in their general holdings. Okay, so far I've shown you a brief snapshot of sort of the cross-section. Now we can get really more detailed into the data using the full admin data. And there, I think the core test is we hold fixed an individual, and we can see whether shocks to one's distance to goal seem to matter for their effective risk appetite. So the simplest test of our theory is, well, if you're gambling for a goal, if you attain your goal, you should kind of stop gambling. And in particular, like in the data, one major goal is home ownership. And the beautiful thing about this data is we know pretty well when people buy a home. So and we know exactly what they're paying attention to across that time period. So just in the raw data, it looks like people definitely tend to decrease their tendency to do cryptocurrency. The thing that drops the most is their real estate app, which is obvious. But then their cryptocurrency and their stocks tend to decrease after home ownership. Of course, this is highly endogenous. People who buy a home are not similar to people who don't buy a home like me. So we exploit a lottery. In particular, there's something called the Cheongyak lottery, which is a government-sponsored lottery, which allocates oversubscribed apartments quasi-randomly among high priority applicants, which can be used as a causal shock to home ownership. And what we find among 1,300 likely winners in our data set is the following empirical result, which is that the month relative to for them realizing that they've won the lottery, they basically have a 20% drop in their typical cryptocurrency use. We have a couple of more robustness tests that I'm happy to get to if we have time, but I kind of want to just use the remaining time and also the unemployment results. We don't have time. Let's just go kind of to the final sort of reason why I think I should care about this result. So first of all of this, if you ask Milton Friedman, would say there's no problem. We're all rational. We all have correct beliefs. We might have these gambling motives. We're all adults. We gamble. No welfare cost. But we also know from the survey data and just generally that people do hold very disagreeing beliefs about cryptocurrency, and it's not so crazy to assume that some people might hold wrong beliefs about cryptocurrency and make some mistakes. And what we show in the data is that why should gambling motives matter? Well, what gambling motives do when people have wrong beliefs is that they gamble on their wrong beliefs. They're much more aggressive in investing based on their mistaken beliefs, which could result in much larger welfare losses relative to the standard benchmark. To put it in a much simpler way, we hold lots of wrong beliefs, but we're generally risk averse. So we don't get screwed all the time by doing all the wrong things from wrong beliefs. However, if we view some cryptocurrency as a means to achieve some kind of a desperate end, then we gamble. In a policy end, that means that we should be very careful about regulating these highly speculative markets, because if we don't get at the underlying cause of why people gamble, if you shut down cryptocurrency markets, they will simply substitute away to another potentially even worse speculative asset, chasing the same goals. So let me wrap up. the key idea I kind of want to say today is that the rise in sort of general economic frustration and discontent and nihilism might be linked to the rise in sort of our tendency to do high-risk financial assets, which we tested in the data. And sort of the one sentence I want to conclude on is maybe this should let us think a little more that heterogeneity in risk appetite or risk preferences should not be thought of as some God-given heterogeneous CRRA preferences that we throw in our models just without thinking, but that one's effective risk appetite is a complex object that's shaped by sort of what we think wealth will get us. How do we really think about sort of what wealth means, what we get out of wealth, our goals, our economic circumstances, a much more deep endogenous object. So with that, I thank you for your time and attention and would love to answer any questions. Yes, John.
Your theory is sort of symmetric in that you're above.
You.
No, I mean, you gamble if you're above, if you achieve the goal, small losses are a big, right? There's the non-convexity you can take advantage of from either side. And so
yes.
Taking the people who are on the left want to gamble to move up.
Right.
It's also a non-convexity from the point of the people who are already above the key.
In which case they are much more cautious. Because like, for instance, like if you say, I've just won a home, I've gotten there, and a small loss will make me lose that thing, that will generate more risk aversion. Are you talking about that version? Or is it the other version you have in mind that I still haven't achieved my goals and I got farther away from my goals?
Second version. I guess
okay.
That's specific. Maybe I'm just misinterpreting the picture you had of the theory
and
thinking about a world where small, where you can have non-convexities, both points where you approach adjustment margins. Which means that you can be gambling when you're near to moving down as well as gambling when you're near to moving up.
That's right. So I have 2 points. The first is that sort of the simplest way of microfounding this kind of thing is something like a Chetty Scheidel, like there's a discrete adjustment cost that generates the kink. One thing I kind of want to say about the exact microfoundation is if you just look at these goals, some of it do feel like adjustment cost type stuff. But a lot of the other goals, like I want to appear attractive to romantically, there does not seem to be an obvious sort of a discreteness. So in the paper, we do a lot more about potential microfoundations for this. And it really kind of gets down to sort of what is the effective utility over wealth? Is it like completely physical where there is a fixed cost, so there's a kink? Or is it psychological? Like if I think in categorical ways, like I want to be rich and successful, I have some notions of that.
These are external habits type things.
Correct. Also, another thing is, of course, where do these norms come from? Like why are these goals even generating? Exactly. And it all makes me semi-miserable, but yes, these are, yes. Stephen.
It also tied into, there's been a big increase in options trading on Robinhood. It's also the Kalshi and other prediction in sports betting. But it seems like those are not, think about sports betting, those are not going to be life-changing wins or losses. So it feels like there's got to be something else going on. Like maybe if young people are, unhappy, maybe this brings sort of a short-term rush or something. But it does seem like these other things that are going on at the same time, not necessarily consistent with this.
That's a great point, Stephen. So I think it's there's sort of 2 reads of the data. One is that gambling's fun. It just gets me out of it gives me a rush. That's why I'm doing it. Or this is distinct from this story, which is gambling can get me something. So one thing we've tried, because Peter told us to do so earlier, was that like we could sort based on people who have realistic stakes. Because we know whether it's serious money for some people or not. If it's fun, this is an awfully expensive way to have fun. Like a pint of beer, despite the inflation, is like much cheaper than saying I want to really seriously gamble and have fun. And we show that the relationship between goals and this kind of risk-seeking tendency is much more concentrated on people with larger stakes. So I'm not saying that this kind of fun, Kalshi type thing is not there in the data, but that's not explaining, especially on the larger, more serious stakes of a high-risk financial investment. Yes.
Are you able to cut your data by other measures of addictive behavior to get at the previous question?
One thing the short answer is we try, but it's not easy. There are 3 things we did. One is we do survey people for lottery tickets. And there's an interesting connection, but they seem to have a different pattern. The second is we have their location data. And there is a particular province in Korea that has casinos. But we weren't able to quite see if these are casino visitors. But if you have some ideas, I'd love to chat. Yes.
Shut up 3 minutes if you want to take a handful.
Yeah, just around the.
You got this by gender?
Yes, all men.
How is the model different from prospect theory? Then if I think I'm in the loss domain, I'm gonna be risk seeking, there's diminishing sensitivity. So the distance from the goal could be interpreted as distance from the reference point.
I love this one so much. I asked this, and then they come across to it. Yeah, so one very personal way to write this down is that our goals are reference, right? I want to be a millionaire. I am in the loss domain, and that does explain a lot. There are sort of two caveats: one nerdy and one with path. Let's start with the nerdy. The nerdy thing is I'm globally concerned versus loss domain. That means I should be risk seeking in all sort of small pet gambles as well as large gambles. And we kind of suggested evidence that the small things are it's really focused on your life. So there's a little bit of, but it's still very close. The second thing is that I did ask you to talk about the welfare. The fact that we like this result because it's really like a very active question in this literature. People also crazy beliefs, but we don't do anything with it. Here's one example where we do if you have gamble motives. And in that case, I feel like our theory is a little more neoclassical and can generate some kind of healthy losses, whereas it's public theoretic. Sort of normatively, I'm quite sure we're doing a mistake or we're doing something. Reference. But ask questions. And then I'll be
It seems like the theory predicts that as you get closer to the goal, you should kind of scale back. Like it should, I think it would be proportional. And this seems like something you might be able to test. And people are getting close to that goal where they die and get down.
Yes. So it's really going to the unhappy middle here, right? Which means that the closer you are from these goals, start doing crypto less, because you're already kind of together with what it means. That's exactly what we find suggestible. People fix those. How people who want home ownership and sort by their assets, we do get a beach for people who are rich. And that's the concept I showed you with the stock.
How do you use the service and what was like past performance of crypto in the 12 months prior? What I understand is, do people really think crypto as a high risk investment, or maybe it just went up 100% in the last 12 months, and then they seem to underestimate the risk and just think this is the way of making money?
The wonderful thing and the terrifying thing about crypto is that they move up and down so frequently, and there are several moves that cost. So in our final survey we ran, so it said not only when crypto just went up 14%, people still seem to be very similar across the funds. Another thing is we also measure the full distribution of things. So we kind of do it in a way where what's the worst we can do, what's the best we can do. And people are not exactly blind because it's very difficult to be blind to this crypto because we very high frequency of feedback. And people do seem to think quite this stuff.
So there are other financial products that also give you a small chance at a large game without risking all the capital. So an example is price-linked savings. Tony has a paper showing that in Nebraska, as price-linked savings became available, people switched out of gambling into price-linked savings. And then I have a project in Mexico where we randomize offering price-linked savings products, and we find strong evidence for non-convexities as well, where as people, we can see what their probability of winning was based on how much they saved, and then conditional on the probability of winning, the more you won, which is now exogenous, the more likely you are to pass whatever your non-convexity, your individual specific non-convexity was, so the more likely you should be to basically drain your account to now buy that good, to buy whatever is causing the non-convexity, and that's exactly what we find. So the question is, how do you think about this? Like, why crypto in particular? How do you think about the substitution between this and other products that you could be, also engage in this kind of risk-seeking behavior without risk?
I love this question. So the shortest answer is that's the best we could observe in this current data. If we have the full sort of thing, it's a really fascinating question. What is the optimal gambling village unit, right? And so what our theory shows is that the farther you are, you kind of acknowledge the sort out this skew. But if we don't have a close look at exactly what type of financial assets, we don't have evidence to test that. So please send me that picture. It seems really cool. One thing is that the government is interested in this because they're like, well, crypto's going up and it'll go down like that. But they're really fascinated in the cost substitution pattern across other assets. If people treat stocks as a similar playground for this skew, then there is a substitution. There could be some interesting patterns there that we also explore. The short answer is like if anyone has data to explore this kind of cost substitution pattern, please let me know. But also the core focus of this paper is not necessarily in the asset side, but really how shocks to one's economic circumstances change this happen.
So yeah, let's collect the rest of the questions.
And then
get a break and then over the break. Yeah, we'll come back at 2.
Hey, thank you so much for your questions.
Hi. You think the treasury issue? She's happy and it's an amazing place, so. Yeah, no, I forgot to that many shared.
She likes, well, depends on the
Yeah,
day.
no, I understand.
We'll catch up.
The best I can say is the right Kevin got the job, but that's not.
Thank you so much.
All right. So we'll move back to our 2010-15 structure for this next section. So Juan's gonna talk about credit card market power. So take it away.
Great, thank you, and thank you for having the paper here on the program. This is John Work with Kyle, who is here in the audience, and the typical disclaimer of the Federal Reserve System applies, as you heard earlier from Nina. So let me start by giving you some facts about the US credit card industry. The first one is that thanks to the advances of some technology as well as a sequence of reforms, there has been there's a higher degree of competition now relative to the past, as well as a higher degree of pass-through from the base rate to interest rate in the credit card industry. However, recent literature has shown that there still remains some widespread when observing Y14 regulatory data, and that this industry is highly concentrated. Furthermore, there is little evidence on what is the particular competitive structure in this industry, in part due to the lack of comprehensive pricing data. So in this paper, what we do is we build this new theory of national issuers of credit cards in order to derive tests for market power. In particular, we ask how does a bank A pass through rates in markets in which the bank is dominant versus in market in which the bank is small. We implement this test using origination dates from Y14 OCC datasets, so this is newly originated credit cards, in order to build high-frequency data on interest rates. And we estimate a quantitative model using differential pass-through regressions that we estimate from the data, and that way we can use our model in order to compute what are the welfare losses of oligopolistic competition. So in this paper, we built this new theory of national issuers that set interest rates across many credit card markets. In the model, optimal markups depend on two margins of market power. The first one is a lender size within a market, and the second one is whether that lender market position is nationally consequential. The model allows us to provide some tests for conduct. In particular, under perfect and monopolistic competition, we should observe a uniform pass-through from the cost of funds of the bank to the borrowing rate across markets. Under market level oligopoly, we should see that this pass-through would depend on the market level share that the lender has. So this is going to be our first test. And the second, under national level oligopoly, the pass-through would depend on the national level share that this lender has. Okay, so how big this bank-lender pair is relative to the total industry. Just to give you an example, imagine there's an unexpected 50 basis points cut on the interest rate from the Fed funds. Bank A will lower the interest rate by 30 basis points in those markets in which the bank is dominant, and by 40 basis points in the markets in which the bank is small. Our main empirical contribution in this work is to move from documenting or doing an accounting of spreads to actually testing conduct from part of these lenders. So in terms of our findings, we have origination dates, which allows us to build bank day panels of interest rates and compare rates on cohorts of newly originated credit cards on weeks before the FOMC event to cohorts of newly originated credit cards on weeks after an FOMC event. Our first test, which is at the market level, tells us that the pass-through is 17% lower for a given lender when the lender has a high market level share relative to when the same lender has a low market level share. So this allows us to reject perfect and monopolistic competition. The second test, which is at the national level, fixes the market level share and tells us that the pass-through is 20% lower if the same lender has a higher national level share, or this bank market pair is nationally important. So this allows us to reject purely market level oligopoly. In terms of welfare, once we estimate our quantitative model, in order to match these pass-through estimates, we can solve the model on national oligopoly and then under perfect competition, and we see that the interest rate falls by 2.5 percentage points, credit to income expands by 145%, and the consumption equivalent welfare is of around 0.16 to 0.45% of lifetime consumption, depending what we do with banks' profits. So the data that we use is that of OCC and Y14 data sets. These are regulatory data, includes 9 of the largest banks in the US that accounts for over 75% of the accounts in the industry. Among many variables, it allows us to get data on credit card rates, balances, limits, and origination dates from the period between 2008 through 2019. The origination dates allows us to build a daily event time panel for 15 million newly issued credit cards. And in terms of the windows, we use all originations from 3 weeks before an FOMC up to 4 weeks after an FOMC event. So another important part of our analysis is to think on what is the market definition. And for this, we rely on 3 sources. The first one is consulting reports by McKinsey that tells us that there is some targeting by behavior and demographics, including income and geography. The second one is the market and acquisition chapter by the FDIC's Credit Card Activities Manual that tells us the markets are by product line, geography, acquisition channel, and scoring. And the third one is the academic market literature that tells us that customer groups shape the credit card design, development, and distribution for part of lenders. So based on these 3 sources, we consider 2 market definitions. The first one is what we call a baseline market definition, which is the interaction between FICO, credit card, and product type, loan channel, and Ventals on income. For FICO, we consider 4 subcategories. So we have subprime, near prime, prime, and super prime. For credit card and product type, we consider whether credit card is co-branded or not, and general purpose or not. For loan channel, we think whether the credit card was pre-approved, originated through the internet, or through some other channel. And for income Ventals, these are based on the 5-digit zip code level income. So this gives us 960 possible markets. Then we also consider what we call a naive market definition, which drops the loan channel dimension and considers coursers bidding for FICO and income. So for FICO, in this case, we have subprime versus prime. And for income, this is tercels also based on the 5-digit zip code level income. And this gives us 24 possible markets. Our analysis focuses on the baseline definition of a market, but we show some robustness for the naive market definition. So I'm going to be a little bit quick on this table, but this is just some summary statistics on the borrowed traits. Panel A has a set of continuous variables. Panel B has indicator variables. What I want to highlight here is this is a large data set. It has rich heterogeneity. You can see how the dispersion of the APR is of 5 percentage points. It also has some significant right tails for some variables such as income. And if you see on panel B, you have that roughly half of the accounts are general purpose, a fourth are co-branded, and 2/3 were originated through the internet. In the paper, we also have a battery of other empirical facts. For instance, we show that the market level shares have a very fat right tail, and that the average Herfinland index across this market is of 0.47, denoting very high level of concentration. The national level shares also exhibit a very fat right tail, meaning that some of the bank market pairs are very much nationally consequential. The third fact is that banks have a large national footprint, meaning that on average, they operate in around 200 markets when we consider the baseline definition of a market. The fourth fact is just a variance decomposition, and we show here that the market level shares explain 30% of the variation in interest rates. And in the fifth fact, what we do is we consider very fine beans of borrower traits in order to construct near identical borrowers, and we find that within of these very fine beans, there is still an important dispersion on interest rate. And furthermore, that dispersion on interest rate is highly correlated with dispersion of market level shares of the lenders that serve these credit cards. So this is suggestive of there being market power. Of course, the facts 4 and 5 are correlational, and therefore we do need to provide a theory that delivers testable causal implications. So let me guide you through the empirical design and just give you the idea of how it works. In the data, most of the credit cards are indexed, so we need to think on a way on how to capture or detect market power. So our idea is to focus on spreads at issuance. Okay? So let me give you a graphical illustration. Panel A here has a bank A that is dominant in a particular market. The Y scale, that is the interest rate at origination. The X scale has different points in time, so -1, 0, and 1. Then the blue line, that is the APR at origination for each period. And the black line, that is the cost of fund of the bank. The difference between the blue and the black line, that is the spread. Now imagine that there's an unexpected rate cut from part of the FOMC that basically reduces the cost of funds of the banks. So since this bank is big in this particular market, it means that the APR will not move by much, and therefore the spreads widen. Now on panel B, I have the same bank operating in a small market. Okay? So you can see that in this case, the APR will be falling by more, and therefore spreads widen by less. Okay? So in a nutshell, when we have a negative shock, there will be a larger widening of spreads if the lender is large in this particular market, and therefore we should expect a negative loading in the regressions. In practice, the APR also reflects time-varying borrowing risk, and therefore we're going to be removing this in our empirical implementation. In terms of the roadmap, the first thing that we do is remove time-varying borrowing risk as well as time-varying funding cost from newly set APRs. And this allows us to construct spreads Y and T, which is the residualized log APR for an account N at a period T. Then we collapse these spreads to the bank market and event week cohorts. And we exploit local projections in order to ask whether the pass-through from the policy rate to APR varies with the lender's market level share, so that's our first test, and with the national importance of this bank market pair, fixing the market level shares. So this is our second test. Okay? In our empirical implementation, the identification is within banks. So we have the same issuer, same event week, and we compare large versus small positions. So the newly set APR bundles together three components. The log APR has a time-varying bank component, time-varying default risk, as well as time-varying spreads. In order to be able to capture each of these three blocks, we run a fixed effects regression that separates them. So for the time-varying bank cost, we throw in bank by time fixed effects. In order to capture time-varying default risk, we kitchen sink it with 11 credit card level controls that include verifying bins on FICO, income, credit limits, utilization rate, among other variables, okay? Also interacted by time. And for spreads or markups, we construct centiles of the market level shares and national level shares, also interacted by time. So the spreads is going to be these estimated residuals plus the share by time variation that we add back from our estimates. The other thing that we need to consider is which FOMC events to include. Okay? We need large shocks in order to detect whether the lender shares affects the pass-through. Because you can think that there can be some pricing fictions or fixed costs that basically mute the responses when the shocks are small. For that reason, we focus as our main event that of January 2008, which was the only unexpected cut in excess of 25 basis points. In the paper, we also stack FOMC events from 2008 all the way to 2019, which considers both rate hikes and rate cuts. The benefit of doing this is that we have more data and more events. The downside is that we have weaker identification when the shocks are small. Again, what we're going to be doing here is compare cohorts of newly originated credit cards on weeks before an FOMC versus newly originated credit cards on weeks after an FOMC across lender market positions. So our dependent variable is going to be the horizon H response of spreads relative to the spread 3 weeks before the FOMC event. The local projection therefore has for each horizon H an intercept, then the monetary policy shock interacted by a dummy IM that takes value 1 if the market level share of the lender in that market is above the 70th percentile distribution, then the shock interacted by a dummy IN that takes value of 1 if the lender has a high national level share defined as being on the 90th percentile of distribution. Then we also control for the spreads 3 weeks before the FOMC and by market by event fixed effects. To the extent that beta M is negative means that lenders with a high market level share will have a lower pass-through. And to the extent that beta N is less than 0 means that national important positions will also have a lower pass-through, fixing the within market level shares. So this chart on the left, what shows is the results from the local projections for the market level regressions. On the Y scale, we have the estimate of beta. On the X scale, what we have is the horizon is the FOMC event. The FOMC event is the week 0, the vertical line. So if you and different markers are just the estimates of the beta. So if you take, for instance, the horizon H equal -1, that takes the cohort of credit cards that were originated 1 week before the FOMC. If you take the H equal 1, that is the cohorts of credit cards that were originated 1 week after the FOMC. The light area, that is the 90% confidence interval. The darker area is the 68% confidence interval. You can see that before the FOMC event, there is no differential pass-through, while after the FOMC event, this beta M, the market level beta, is negative and statistically significant. This translates into the pass-through being 17% lower when the market level share for a lender is high, relative when the same lender has a low market level share in some other market. The dashed lines here basically show a robustness analysis that we do in the paper in which we consider a partial residualization, a more parsimonious residualization. You can see the results hold. And the solid red line, that is the results for the baseline definition, the naive definition of a market. Remember, in that case, we have fewer markets, 24 instead of 960. Therefore, it's a bit more erratic, the estimates, but it's still aligned with those from the baseline analysis. On the right, we show what happens as we vary the cutoff of what defines to be a high market level share, going from 60% to 90%. Just remember, in our baseline, is the cutoff is defined to be the 70th percentile distribution. Now, this panel A shows the estimates for beta n, so the national level beta. Okay, you can see that before the FOMC we have no differential effect, while after the FOMC the beta is again negative and statistically significant, and it translates to the pass-through being 20% lower when the lender has a high national level share versus when the lender has a low national level share. And on the right, again, we show what happens as we vary the definition of what is a high national level share. And you can see that results generally hold. The other thing that we need to consider is whether there are other margins of adjustment from part of the lenders. Okay? So for that, we consider, or we take balances, fees, and limits, which of course we also residualize in a similar fashion to what we did with the APR. Okay? And you can see that the estimates for this alternative margin of adjustments are economically small or statistically insignificant. The other thing that we do in the paper is we consider different samples. So our baseline analysis was January 2008, but then we also consider what happens with the big cuts in 2008, all 2008, and all events from 2008 through 2019. This table basically shows the average response in the first 4 weeks after the FOMC. You can see that results still hold, but as we start stacking, which has both positive and negative shocks, these results are quantitatively mitigated. Other things that we do is we show the results hold for the APR in levels, not only logs, and for the log effective APR, where the effective APR is just a way to control for the share of promotional balances. Results also hold if we consider different measures of monetary policy shock, and if we consider separately subprime accounts versus prime accounts, and also if you throw in geography as a definition for a market. So then we go back to our model, okay? And we feed in the observed industry structure as we observe in the data. In particular, we have 9 national lenders, 960 markets, just as we observe in the OCC dataset. And in the model, we match the distribution of banks across markets, the distribution of bank cost, as well as the market sizes. We also estimate the market power in order to match the empirical evidence. In particular, we estimate the within market competition in order to target the average Herfinine index as we observe in the data. And we estimate the cross market power as well as the demand curve in order to get the same differential pass-through, the 17% and 20%, as we observe in the event studies. We also estimate the scale of credit in the model in order to get the revolving credit to GDP ratio. In terms of fitness of the model, we show that the model does a good job at matching the distribution of shares as we observed in the data. So once we have the estimated model at hand, we run some counterfactuals in which we remove each layer of market power at a time. So we go from national oligopoly to market oligopoly, etc., up to perfect competition. The punchline result here is that when we go from national oligopoly all the way to perfect competition, interest rates fall by 2.5 percentage points, the credit to GDP ratio expands by 145%, and the consumption equivalent welfare is between 0.16% to 0.45%, depending on what we do with the profits of the bank. Another thing that we would like to highlight here is that when we move from national oligopoly to market level oligopoly, the welfare gains are small. There's not much variation. We start getting more action as we move from market oligopoly to monopolistic competition and then to perfect competition. So to conclude, in this paper will be this new theory of national issuers that has testable predictions on conduct. We use origination dates in Y14 and OCC datasets, which allows us to build this high frequency data on interest rates, on newly set interest rates. We find that the pass-through around the FOMC events rejects competitive markets. Basically, we find this 70% lower pass-through in banks with a high market level share and 20% lower pass-through when the bank market pair is nationally consequential. And the estimated model shows us that when moving from oligopoly, national level oligopoly competition to perfect competition, we have big movements in the interest rate, in credit, and in welfare gains. Okay, and the takeaway here will be that the credit card market power operates in 2 levels. We have this within market variation and across national industry. Thank you.
Okay, thank you so much for inviting me to discuss this really interesting paper. So what research question is this paper asking? It's asking how competitive is the US credit card market and what would be the welfare gains of competitive reform? This is obviously a really important question. There's a lot of reason to think that the credit card market might not be fully competitive. Here's an article talking about how credit card interest rates are at record highs. The CFPB says cards have never been this expensive, right? So what is the paper going to do? It's going to think about credit card market segments as being national and defined by granular product characteristics. So things like credit score, income, card type. I really like this idea of moving away from geography as the boundary of a market and into product space as the boundary of a market. So I think that's a really nice kind of feature of this model. They're going to have households that are choosing among competing credit cards. Households are going to value some market segments more than others, like for instance, a premium card more than others. And then within a market, they're going to have idiosyncratic tastes that are symmetric across banks. So they're going to like one bank more than the other, but not for any particular reason that the bank is choosing, just because they happen to like that bank, right? On the other side, banks are going to compete for these borrowers by setting rates, and they're going to defer in their cost of lending. So in this environment, bank market share dispersion is going to reflect dispersion in efficiency, so this cost of lending. And then national market shares are also going to reflect how desirable these market segments are on average. What do? They take this framework and they're able to generate a prediction that allows them to test for conduct. So they have this prediction that under imperfect competition, markups should vary with the bank's market share and also how large that market is nationally. They're going to test this using really nice regulatory data, and they find evidence indeed for imperfect competition. So banks have a lower pass-through when they're large in a given market segment relative to when they're smaller. Then they want to quantify the extent of this market power. So in order to do this, it's not enough to know that markups kind of vary. They need to know the level of markups. To pin down that level, they're going to match market concentration. And just to recap, there is a non-zero markup even if there was no cost dispersion because of the taste dispersion. So it's costly for households to move between banks. They have some preferences. What they find is that competitive pricing would lower rates by 2.5 percentage points and expand credit substantially. So to start my discussion, I want to take a step back and talk about what is a credit card, right? So in its essence, a credit card is a line of credit that the borrower may or may not draw down on, and which also offers some transaction services like rewards and convenience, etc. So from the bank's point of view, what is the profit function that the bank is thinking about when extending a card? Well, it's this return that it may earn on the drawn balance, which is the APR minus the cost of funds, minus potentially some expected losses, plus some revenue it may be earning from the fees or interchange that that the customer is conducting on this card, minus potentially other costs, right? This paper is, of course, we always have to make some simplifying assumptions. What is the paper going to do? It's not going to think too much about this drawdown decision. So the cards are going to be fully drawn. We're also not going to think too much about losses or fees and interchange in this paper. On the demand side, what's the borrower's utility from holding a card? Well, they have this option value of the line, right? So they can draw down this credit card line. They also have non-price services, rewards and convenience of being able to use this credit card, and then some potentially expected interest costs and also fees, right? In this paper, again, we're abstracting from the drawdown decision, so the value is coming from drawn balances. And these non-price services, non-price transaction services are only going to vary at the market segment level, not at the bank level. So once you've chosen your market segment, all banks are identical. In my discussion, I just want to talk about, what do these assumptions mean for the results of the model and the paper more broadly. The first thing the paper does is it identifies market power through market share dependent pass-through. So conduct is identified by looking at how rates respond to monetary policy shocks within really granular market segments, instead of just looking at how the spreads of different cards vary in general, right? So this is a really nice identification strategy. It allows us to circumvent this pervasive problem whenever we're trying to think about market power, which is we don't need to know the magnitude of the costs. We don't have to take a stand on how costly these cards are. We're comparing a bank across its own markets, so we can difference out a bank-specific cost. And then we're comparing banks within a market, so we can difference out a market-specific cost, i.e. that some cards are more expensive than others. So what's the identifying assumption? It's that within a bank, different banks per dollar cost exposure to this monetary policy shock does not vary with its market share. That way, if we see that pass-through varies with market share, we can ascribe that to the markup rather to some sort of varying cost, right? So I wanted to think through, like, do the assumptions matter for this? And I actually find that this specification is really robust to relaxing the assumptions of the framework. So if we think about allowing drawdown, well, that's gonna, scale revenue and cost together. So the per dollar exposure will be unchanged and it should still go through. If we think about varying default cost, well, they're really granular markets classification is going to take care of this, mostly take care of these like potential differing default risk. If we think about some cards mostly getting revenue from interest versus others from things like interchange fees, again, this very granular market segment classification should take care of that. And finally, if we think of banks as providing costly quality, so that could vary the level of their costs and therefore the percentage change in costs, that might be a problem for the log specification, but they also have a level specification that seems to go through. So my takeaway is that the identification of this market, the existence of market power through pass-through is very robust to relaxing these assumptions. What does the paper do then? It's now going to go on to quantifying market power. In order to do this, we need to figure out the level of markups, which is positive, remember, even if there's no cost dispersion because of idiosyncratic household tastes. It's costly for households to move across banks. To pin down this level, they need to additionally target average market concentration. Now, this is a cross-sectional moment, so it's going to depend on getting the cost and demand sides correct, unlike the slope part. There's two key identifying assumptions. First, market shares are driven by costs rather than by non-price attributes, which might be costly to the bank. And two, tastes are symmetric across banks. So how does this matter? So what the model does is it thinks about a bank that has a large market share must be efficient. And so, it has a low cost. But imagine that a bank is large because it's offering a really valuable and costly service. Well, that means that, the rate is high because of the cost, but we would ascribe that to markup in this framework. So it's going to overstate market power because it's actually high because it's costly to provide those services. The second assumption that tastes are symmetric across banks means that if there's a lot of dispersion in market shares, that has to come from borrowers just having idiosyncratic preferences rather than certain banks being really high quality. That's going to mean the model struggles to match exactly the shape of the HHI distribution. It will match the average, for instance. My suggestion is to look at whether low-cost banks in the model have low observed costs in the data to see to what extent it's really driven by efficiency. I know the data is not perfect, but along the dimensions that you can observe. And then within a bank, within a market, do banks that have the same rate tend to have the same market share? If not, that's some evidence that there might be non-price characteristics that are important. This also matters for welfare. If quality is costly, then pricing at this marginal cost we've estimated will actually reduce the non-price quality. It will dampen welfare, so the welfare gains might be overstated. And then there's other things that the welfare calculation could think about in extensions, like optionality. We're not thinking about, these undrawn balances. How does that matter for welfare? And also, there's no default. So we think that expanding credit is always good. If some of that credit is increasing default risk, that might overstate the gains to welfare. So it would be nice to add a discussion on these dimensions. In my final couple minutes, I want to think about what is driving market power in this credit card market. So what do they find? They find that eliminating all market power lowers rates by 2.5 percentage points. So of this, 46 basis points comes from the strategic pricing because banks defer in their efficiency. So this is what the bank is controlling. And then 207 basis points is actually coming from the idiosyncratic taste dispersion. So this is just that households in this economy, for whatever reason, like one bank rather than the other. It's not something the bank can control. So I think it'd be interesting to dig into this 207 basis points a little bit more. And one other point I'd like to make is that in the model, concentration does not drive market power. Both are going to come from cost dispersion. So when the counterfactual moves to perfect competition and keeps cost dispersion the way it is, it's actually going to increase concentration in the more competitive environments. So in the presence of cost dispersion, more competition actually means that the cheap banks don't charge a markup. More and more people actually get it from the cheap banks, and they grow even larger, so concentration increases. Okay, so my suggestions are it'd be really interesting to dig into, what is this idiosyncratic taste dispersion? Is it rewards, switching costs, awareness? those things matter for understanding the welfare implications. And second, given the paper's motivation of high concentration being a problem for the credit card market, maybe a counterfactual that actually compresses the cost dispersion could be an interesting one to run because it would jointly lower concentration and market power. So just to conclude, this is a really great paper that's able to test conduct in the credit card market using pass-through, which is a really credible identification strategy, and it has really rich regulatory data to do so. It then goes on to quantify the extent of market power in the credit card market and can think about policy implications of this. It'd be really great to dig into how the level of markups are recovered, if costly products, costly quality would affect that, and second, what drives this market power. Thanks so much.
Thank you so much for the setup. So as usual, we'll have kind of 15 minutes for comments and questions, and we'll kind of limit the time allocated to responding to the discuss as to keep the general discussion.
Yeah, first thing we would like to thank very much, Nas, for an excellent discussion. Yep, I don't know if questions.
Thinking about free and put that one for the competition markets. Some lenders will pay for the markets.
Yeah, I mean, possibly yes. In our model, we are not incorporating entry and exit, so that's definitely a dimension we could incorporate into the model. That would definitely potentially affect welfare for sure. Yes.
Yeah, so I want to go back to the paper this morning about the two-part pricing, and I'm wondering if the same thing something like that could apply here. Right? So there were two degrees of ways that they got charged. Here, it's interest rates, points, right? There's annual fees associated with it. You're only looking at the interest rate. So I'm wondering if similar to what they're doing, you could somehow also look at fees and points and all.
Yes. We look at fees. I showed a table that has balances, credit limits, and fees, and we show that there's no differential pass-through on fees when focusing on FOMC events. Now, we're not saying that fees don't move, but those are likely more low-frequency movements. Yeah, that's the question. Either.
Don't say Tita.
Please, yeah.
Sure. I've always wondered, to some extent, what's the right way of thinking about competition on interest rates when you're signing up for a credit card? Because typically when you sign up for a credit card, they'll quote you a spread. That can be like a 10 percentage point wide spread. And so I'm just curious how you think about the fact that borrowers don't really know their interest rate with respect to what you're.
Yeah, so in a way, we're thinking it's on spreads, exactly, right? We actually residualize the log APR for all these characteristics, and we consider exactly spreads. And you're right, I mean, that's a margin to think on, because most of the credit cards are fixed spreads and then variable depending on the base rate. So that's what should be the dimension of.
What I'm saying is that it's a spread above the prime rate. So when you apply for a credit card, they'll say your interest rate is somewhere between 20 and 30%, and it'll tell you what it is once we pull your credit. But they don't tell you that beforehand, and so it makes, I guess, borrowers don't know their interest rate ex ante. Perfect.
Yeah, that's a fair concern. Yeah, so we'll have to think more about that. My guess is that our taste shocks sort of substitute for some of that noise. But that's also what allows us to do the high frequency identification, is that those banks give you a range and then they can adjust the spreads quickly. So something we'll have to think more about.
Back there, I guess, to move.
Question and extension. So first, is it important to you that your market definition corresponds to a consumer choice set? Often it's probably a market definition here, but I think in a setting like the consumer chooses, look like my reader paper, like maybe a dozen of these choices in all the markets, different acquisition channels, different co-branded versus not, and that's all in the same choice set. So how does that affect our interpretation? Suggestion is along the lines of Naz's third comment. I'm understanding where the market power comes from. Is very much a frontier question. This literature, and I think there are a bunch of interesting candidates out there. One you maybe shed some light on with the extent to which the information act by looking at how the lenders can cut prices by more or less and harvest different part of the risk distribution. That's hard.
I don't know if you want to answer that.
Yeah, so at least for the first part, the substitution across markets, so we've talked seriously about splitting our representative household into two pieces. Yeah, so right now, a market includes things like the FICO, and obviously it's hard to substitute across FICOs. If you think that the period is 5 years or 10 years in our model, perhaps you can go from subprime to prime, but it makes sense perhaps in a version of this, we could recalibrate and just split out the prime and the subprime markets.
Yeah, actually, on our empirical implementation, we do that. We consider only subprime and only prime accounts and results hold. So in that sense, if the FICO is a source of worry. But again, as we showed in the beginning, we base our market definition based on what the three sources were saying they should be.
Peter's been waiting.
Yes, please.
Yeah.
Sorry.
I'll see this next. So a plot that is very memorable to me from a prior paper is the Mahoney and Strobel paper where they show that realized profits for credit cards are really, really large. And so projecting from when I read that paper, I would have expected to find very different results in the context of this talk. But you don't. And so I'm curious, can you help me to think through, like, do you think that, like, basically, like, how can, do you think of that as just an ex post realization, or also that ex ante profits are relatively high in the credit card industry? And then how does that sit with the sort of relatively small markups that you find using your NFOMC?
Sure, markups
Yeah.
are small.
Yeah, 2.5 percentage points. I mean, I don't
Nobody's
remember
supposed
the
to take.
exact.
That's
Well, okay, yeah, but this is
Like, I-
expanded for but we thought, yeah, this actually lined up with their work and some of the work we did with Gadget. We think it lies somewhere between 2.5 to 3.5 percentage points based on portfolio level data, aggregate level data. Maybe Neil has some different posteriors on that, but we thought it was plausible within the range of what the literature has found.
Cool, okay. That's all.
Go ahead. Yeah.
I'm actually gonna go in a different direction and date myself by bringing up papers from the early 1980s. So we've been thinking about the connection between pass-through market power since at least a series of papers in JPE in 1981 and 1983. The first one attempting to use pass-through to think about market power in the cigarette industry. The second one by Jeremy Bulow and his co-author saying that you can't do that. And here's how I think about it. Market power is based upon the elasticity of demand, the ratio of the second derivative to the first derivative. Remember, pass-through is based upon how that markup changes. So it's the ratio of the third derivative to the second derivative. And you can make functional form assumptions which connect those two objects. But in general, there is no way to map from pass-through to market power, except if you make this specific functional form assumption. So, like, for anybody who's playing this space, go back and read those papers and think about how what you're doing connects with that assumption.
So, I mean, yeah, to respond to that, I mean, look, sometimes, yeah, we make assumptions, see how far we can go. Testing conduct is difficult to do. I would point to the court cases and the various rulings in that time period to suggest that the spreads were indicative of market power. The price fixing, the tacit collusion, I look at all of it, smells like market power. You're right. Perhaps their conduct was competitive in these demand elasticities. Don't reflect the conduct.
Not market power. I'm just saying the approach of using pass-through back out market power only works with specific functional form assumptions, and like you should just engage with like well-published work thinking through those issues.
And easy to read papers, wow, about liturgy. Number 13. Yes, you will have the moral sitting.
You're dating yourself as a young person.
See, Barry, be very angry if I didn't mention that.
Yeah. You had a question?
Actually, I just want to ask, how do you think about last comment about sectors? Because I believe that across different markets, even within the same bank, they would have different shares of sectors who actually don't borrow like this student credit cards. Think about all of us. I feel like the price is not a relevant attribute, but it is relevant for the bank. provide service to the market.
Yeah. So our model and the way we're thinking is more of revolving credit. So some estimates that we have, for instance, from the SCF says that the fraction of revolvers is around 67% when you see the cohorts of 2007 and 2009. And when you observe data from Y14 and you focus on prime accounts, the prime accounts become revolvers. Like 40% of the prime accounts that were originated become revolvers within the first 12 months. And for subprime is close to 60% of the accounts. So we're not saying, there's still a huge chunk of these new originations that actually become revolvers and for whom this APR matters.
If I understand the exercise, you're using this default regression to sort of absorb all of the incomplete information, maybe the moral hazard, based on one of the calculations. But the model is built on 100% utilization. Data says average utilization is about 25%. Do you have to rescale things when you go back to do this exercise in terms of competition?
Yeah, we think in that sense, we would need to construct a market shares based on the utilization out of the total accounts. Right?
Well, no, it's a different question, and that is, there is no way that a credit score that is built on an average utilization of 30% in data is going to look like a credit score with 100% utilization, right? And so, do you have a mismeasurement there that could affect your welfare calculation?
I don't think so, because we residualize the data from utilization rate on our utilization procedure. So that's being all absorbed. We actually have as a control variable utilization rate by time.
Yeah, I think you have like 9 banks, right? And like 14 million of probation, and the bank that are in the park is probably the average. So in your residualization, I just looked it up. I think you have bank statistics in there. But I was actually interested in that, and I think it would be nice not to immediately go to that residualization. You could do this bank by bank, because you have 49 banks, or interact with bank dummies. What I would like to know is some of the path to behavior. Maybe some banks have the same path to behavior independent of their competitive plans, where they are. And some banks act very much on their competitive position. So maybe that average behavior you observe is coming from 5 of the 9 banks. And then it would be interesting to know which ones behave more uniformly, which ones don't. If you have 9 banks.
Yeah, I mean, maybe Juan can answer this. We've requested to be able to do this bank by bank, and that request has been denied.
Yeah, it's confidential. So yeah, we're limited by confidentiality. Yeah.
But when I correct your graph, there seems to be a reversal that comes out 2 weeks and then comes back up to pass through. It's on the aggregate one. So I was wondering if there is some interesting dynamics that could exploit. So the shock is, and I understand why using the frequency, but then it could be back to not just trying to take away, but it will all lines, and then there could be some time series dynamics. Who moves first, or not? That's all the line. I don't know if you looked at this or.
Yeah, so January has its own issues because there's a sequence of FOMC events, so we don't want to look too far out into those dynamics. I mean, I think we lose identification at some point, but I think that's an interesting idea. It may tell us about adjustment costs or how long this market power they can actually exert it for before customers switch markets.
Yeah, 2 minutes and going across.
Yes, so you can.
Jonathan.
I was just trying to think through the duration of the profit stream that you're buying and how that varies with the changes in interest rates. So, right, you have this at a point where you have very little poaching going on in the future, you're buying a long duration, highly profitable asset. That makes it highly sort of profitable to get today, and so you're probably trying to steal from other people right now. And most of this is poaching, right? It's all churn.
Yep.
If it's a short duration asset, then kind of like you're not that concerned about it. And that seems like related to the interest rate movements. Should I worry about them?
Okay. Should we collect it?
Yeah, so let's.
It's a shame. I want to echo the bank fixed effect is a shame that you can't single out people, and maybe you could ask for permission to group them by the industry side. So in this space, there's a large difference between the legacy banks, Citi and Chase, where they have sticky deposits on the liability side, and on the asset side, they cross-sell auto loans and mortgages. And on the other hand, you have Chime and Synchrony that are stuff fintech that is borderline with all these things to use credit cards and all of their funding experiments. And there might be differences in passwords between those two types.
Yeah, and, oh, okay, so we'll keep collecting, yeah, if there's more comments, yeah.
Remind me the date of the main identification of the shot?
January 2008, yeah.
2008.
Yeah, yeah.
Yeah, so if you can't do, yeah, it can't be bank by bank, then at least take the 4 or 5 that are big mortgage holdings and those that don't. Right, that's a particularly fraught time, dating myself.
Yeah.
Well, thank you again for the organizers. For discussing, yeah. The table, sorry, I had to go a bit, the table, it's a good point, the fees, you asked about the fees, I totally, we are on board on that, it's just like the frequency might be different, that's why I meant to say, but we showed a table, and you see, if you're interested, I mean. Real quick, sorry. This one. That there's no, we don't find statistical significance. Going on.
Next, we will be talking about NBER and signing notices. So take it away.
All right, thank you very much. It's a pleasure to be here. Thank you for including this paper into the program. It is joint work with Leo Feller. And as many of my colleagues already highlighted, these are our words and not the Federal Reserve System or anyone affiliated with it. And in this paper, we're going to be talking about a very simple question, yet an important one. We're going to be asking what households did in response to the tariffs that were imposed last year. As I'm sure many of you know, in 2025, US imposed significant tariffs to virtually all trading partners. And the question we're asking is, what did households do? And clearly, the press news media has an idea about it. They say Americans are drawing the line on price increases. Shoppers are buying less where prices are rising fastest. I put a time stamp on it because the paper that we wrote was before that, just so you know. But definitely it was a good segue to talking about this because as many of you know, the first part of the statement, we know a bit more about. We know that tariffs are feeding into prices. There is a fairly large literature now looking at the past tariff periods into the current one that show that tariffs pass through to domestic prices. You can look at import prices, you can look at prices at the shelves. But we are much thinner on the evidence of what households do. Do they adjust quantities? Do they relocate spending? If they do so, why they are cutting back? And this is where this paper comes in. And we're trying to make a slimmer of a contribution to the literature by looking at a transaction level data from 125,000 households that we can observe for actually over 2 years, but for the 2 years that we care about. And we're going to use their tariff sentiment survey responses to see what they're doing with their spending and what kind of margins of adjustments they have. Just very quickly what we find, in case I cannot get to the end of my presentation, what we're going to find is very much in line with what the literature currently is finding for the current tariff incidents. Prices rise modestly at the shelves, around 15 to 20%, but spending falls more, 3 to 4 times more. When you look at the post-tariff period after February 2025, this basically corresponds to prices going up 1.2% and spending being down 4%. And tariffs have some costs, and these are regressive costs. The lower income you are, the more strongly you hit. Pass-through of tariffs is monotonically decreasing in income. So you're experiencing a higher price cost if you're lower income. And when we attempt to calculate some welfare costs from that, the lower income households are hit 5 to 9 times more than high income households as a share of their income, depending on your favorite measure of welfare costs. And then we bring in some survey evidence and show that there is some income hit. Clearly, prices are going up, real income comes down, and it explains some of this drop in spending. But the main mechanism that explains the bulk of this is the survey that tells us that pessimism and worry is driving this margin of adjustments by the households. All income households trade down to cheaper varieties, they trade down. And the people that are making the most adjustment is worried middle income households because they have the slack to do so. Low income households do not have much wiggle room. High income households can absorb higher costs, but middle income households that are worried are the ones that are making this adjustment, and they shift their basket towards essentials. Now I'm going to talk about the data a little. It is coming from a company called Numerator. Numerator has an online app. You can download it on your phone. It doesn't require you to be extremely tech savvy. It just requires you to have a phone with a camera. And this app is called Receipt Hog. If you or any of your friends are using it, you might tell them how their data is being used. The app has over 1 million registered users. And Numerator looks at these 1 million registered users and sees who is actually submitting most of their data. And they're collecting data in three forms. First, and this was the main bulk of the data collection back in the day, you go to Walmart, you have a $100 receipt, you take a picture of your receipt, data, the company transcribes that into a transaction level, row by row data of your spending. The second way they collect data is you link your online shopping accounts into this app, Amazon, Walmart. Last time I checked, I think 80 retailers were there. You give them consent, they get your data as you shop online. And this now is the biggest way in which they actually collect your data. And the third and a small portion of the data collection comes from you consenting the company to scrape your emails. And hence they get your data. But most of their data collection right now, over 50%, is through online means and less so from physical receipts. From this 1 million registered apps, Numerator selects a so-called static panel of 200,000 users. This is called static in their jargon. In my jargon, it's a rotating panel. People come and go to this static panel, as they call it. But these panelists are selected in a way that Numerator looks at their spending and they realize that, okay, these people must be submitting most of their spending because they're receiving rewards as a response to this submission. And they select these 200,000 panelists to be demographically and geographically representative, benchmarked to the American Community Survey every year. And in this study, I'm going to use panelists that I can observe between January 2024 to December 2025. That leaves me with a bit over 126,000 households. And I have a lot of demographic information about these panelists. I have their self-reported income, if they have kids, where they live, 5-digit postcode, their marital status, their occupation, and such. The key thing about this data is that we observe prices and quantities at the same time. It's not just a spending data that comes from a credit card or a financial aggregator. We know exactly what they bought. If they bought 2 bottles or 2 gallons of the same milk versus 1 gallon of one and the other gallon lactose-free. But when you look at the entirety of this data set, and we're roughly capturing $2 billion in spend per year in the data, 46% of that is groceries. But the remaining 54% is still health and beauty, apparel, home goods, and electronics. Just to give you a sense, the data also captures, for example, gasoline or some services, very limited amount of services, or food away from home. For the purposes of this study, I set them aside. I'm only looking at retail goods. When I started working with this data set, I've done some due diligence in looking into if the data correlates with officially published measures. It tracks Census Bureau's retail sales ex autos really well. And when you construct price indices from this data, it does a pretty good job in tracking PC and CPI deflators. And the company is also a survey company, and they ask people questions about their ideas about different types of consumer goods. But here and there, they also run surveys about economic sentiment. And when the tariff period started hitting us last year, they ran a few waves of tariff sentiment survey that I'm going to use in the study. The survey asked about tariff awareness, concerns, and what households might do as a response. Now, because we are going to talk trade, I need to take this household data and I need to somehow link that to trade data. And as I was talking to my discussant earlier, I am definitely not a trade person. I had to learn a lot. So in this data set, you see prices and quantities. That means every item has an item number and they have some classifications. So for example, this is a real example from the data, starting from the bottom. There is a health and beauty product, it's a makeup product, it's an eye makeup product, and it's a mascara. If you go up the table, you'll see grocery, beverages, tea, Earl Grey tea. These classifications are provided by Numerator. It exists for most of the products, not all. If you're missing something, for example, you might be missing the most granular category, but in a way, most of the items, you can have this kind of a classification. So we take these classifications and we link that to harmonized system codes. These are 4 digits. To also, again, to give you an idea, because I didn't know this 2 years ago, Each product is classified with a 10-digit harmonized system code. When you look at Federal Register, when tariffs are announced, you see a very long list of items that are being tariffed, and they generally go with 10-digit HS codes. I can now work with 10-digit HS codes because that's very difficult to classify all these items, so I need to make some approximation. Basically, what I come up with is for these classifications, I link numerator items in these categories into 4-digit HS codes. And that gives me a sample of roughly 5,000 panel units. And these are going to be the results that I'm going to show you in the first part before I bring in the survey results. And to be able to talk prices, I can use unit prices, yes, but they get a little choppy. And we have the privilege of having quantities. So we can as well bring that. We have prices and quantities. We calculate a Fisher price index, which is not extremely sophisticated. It's a geometric mean of Las Peres and Posh indices that takes into account the base period quantity is January 2024, and then weights all the items with the current period quantities. Now, given we made some effort to link numerator to trade data, now I need to bring in some tariff measures. I have a tariff rate that is duties paid divided by import value. Again, this is for the 4-digit HS code that basically sums over all the 10-digit HS codes. And these are realized tariff rates. This is what firms paid. When you look at a Federal Register and calculate tariff rates, it is going to be higher than what firms paid because of some delays, exemptions, carve-outs for certain sectors. But this measure basically tells me everything might be imported, or maybe nothing is imported in that HS code. But this is not the right classification. I don't have country of origin for each product, but it is not difficult to assume that furniture HS code might involve more imported categories than dairy. And hence, I need to somehow take this tariff rate and bring that to reality. And this is what I do with the import penetration measure, which is imports divided by imports plus shipments minus exports. That is basically the share of domestic consumption that is important. And that is my measure for the remainder of the paper. I am not going to spend so much time on it because I probably have only 8 minutes to walk you through the results, but the rest of the paper is not innovative in the sense that it's just differences and differences with ton of fixed effects to soak up, common macro shocks, aggregate demand contractions, unit level seasonality. I have a post dummy that is one after February 2025 to reflect the tariff period. And on the left-hand side, I have the Fisher price index for prices, real spending, which is spending deflated by the PC goods deflator, and total quantity. Just for Fisher price index, I have a slight modification in the regression because growth of prices were coming down before tariffs. And this is very similar to what Cavallo and his co-authors did. So we have a pre-trend for prices coming down beforehand. But I'm going to show you the main results with and without that trend. So the main result is when you look at the tariff rate specification, you see 15% pass-through. When you look at the tariff exposure measure, you see 20% pass-through. If your preferred specification is not the trended version of the price, then you can see the second column, price through is there, slightly lower. The main result here is that spending and quantities contract. So you see that spending decline is much more than what the prices would call for. And when you calculate this, when you look at the post-tariff period and calculate what change in tariffs, this basically to price increase is roughly around 1.2% and spending decline is around 3.7 to basically 4%. Before diving into the survey results, one last thing to show is when you look at the highlighted coefficients over there, these are passed through by income group. You'll see that lower income households, which we define as lower than 40K annual income, get hit more than other households. Middle income is 40 to 125K, high income households is 125K plus. And although this is the case, when you look at their spending, and you will have to take my word for it, spending declines are coming across groups. And these results also, everything that I've shown you, hold excluding grocery. Even if we take that huge 46% expenditure out of this regression, everything holds. Now, I have been telling you that prices are going up, spending on exposed goods falls more than 3 to 4%. Can the real income hit of tariffs explain this gap? You can do some back of the envelope calculations. You can calculate the net spending effect. Prices are going up, but spending is cut. So there is some welfare loss. The welfare cost is mainly fairly modest. It is small. It is around $3 to $12 per month for low versus high income households. But as a share of their income, it is more for low income households, around 20 basis points compared to the high income households, which is basically nothing. Yes, it explains some of the contraction in spending, but not the bulk of it. And that's where the survey comes in. The survey asks 10 questions. And when I take the survey sample of 30,000 households that were surveyed around April to June 2025, I have an intersection of 21,000 plus households. And I have their responses to following questions, which I group in 3 different buckets. First, the sentiment. They're asked about their concerns about the tariffs, the expected tariff effect on the US economy and US's economic performance next year, and recession probabilities. Not probabilities, but basically concerns. And their intentions, what they're going to do. Are they going to cut back? Are they going to delay big ticket item purchases? Are they going to substitute to US made products? Are they going to stockpile or relocate? And they're also asked about specific category concerns. Are they worried about groceries or electronics or apparel? And as a first go, from the first bulk of this table, from the sentiment, I'm going to extract the first principal component, and I'm going to call this a pessimism measure. You can call it a worry measure if you like, and that explains the majority of the variance. So the rest is, now we are in the household level. We're going to soak up all the aggregate contraction with fixed effects. And then basically this regression is going to tell us if pessimistic household relocating their basket towards essentials differentially compared to non-pessimistic households. On the left-hand side, I have the share of essentials in percentage points and also log of non-essential spending. And I basically have the sentiment measure, the first principal component, interacted with the dummy. And I have a second one that basically looks at the 2024 basket of a household and calculates the tariff exposure of households, just to be able to ensure that real income hit is not the main channel here. On the baseline, per 1 percentage point increase in this pessimism measure, you see roughly 0.2 percentage point increase in share of essentials and a decline of around 1% in the non-essential spending. When you put tariff exposure by households into the equation, the coefficients change, but not by that much. The first one is around 15 percentage points. Basically, log of non-essentials doesn't change. So basically, pessimistic households cut non-essentials. I don't have the result over here, but they defend it on the level. They defend essential spending on the level by tilting their basket towards essentials. So it's an aggregate cut, but cut driven by non-essentials. And this pessimism is forward-looking. When you look at what drives it, it basically it is driven by the concerns about recessions and US's economic performance next year. And the adjustment margin here is worried middle-income households. The others don't adjust above and beyond the aggregate contraction. And the summary of the rest of the results in just one slide. I told you basically the prices are going up modestly and everybody buys less. These were the aggregate results that I showed you. And then once we brought in the survey evidence, worried middle-income households start buying differently by tilting their basket towards essentials. And we show also in the paper that everybody, irrespective of income, they start buying cheaper. They basically buy the same quantity, but cheaper, basically by trading down. And when you look at what people thought they were going to do in response to tariff, when they say, "Oh, I'm gonna buy less big ticket items. I am going to substitute to U.S. made products, or I'm going to stockpile." The only thing that we find as a significant revealed behavior is reducing non-essentials. And the rest, if they say stockpiling, we don't find any evidence of that in the data. Or if they said that we are going to buy less imports, we have no evidence of that in the data. And this is a broad-based contraction. When we look at even low tariff exposed goods, we still see this contraction. Just one line to close this is we basically find an aggregate contraction in spending, and it is in part due to the hit to income. But mostly it is about pessimism of worry that households are talking about in this tariff period. And with that, thank you.
Thank you so much for having me to discuss it, and this was a pleasure to read this paper. So I'm not a household finance economist, I'm a trade economist. But what I think is this is a very important paper for a classic thing. It's got a fantastic data set. This is missing in a lot of cases. Trade data especially often only has prices. We often drop quantities or we impute it or something. It has all of this data. And what is it? It's a difference in difference. It's a classic difference in difference doing kind of cutting edge work, finding out a differential effect of more exposed versus less exposed products over time. It's kind of got some findings. The first one is really related to trade literature. It's got a retail pass-through of about 20%, so a 100% increase in tariffs, which is actually what was implemented in some cases, leads to a 20% increase or 10% increase in prices. But on average, it was much lower, so relative spending falls about 4%, and the elasticity is 4 times higher on the quantity margin than on the price margin, which is actually quite substantial. But there's also a regressivity finding, which is, she didn't emphasize it, but it's actually quite important in the paper. I think this has a lot of implications for a lot of how we think about it here. And the last, a survey really drives home kind of who is driving this regressivity in some sense. And I think this is kind of like the punchline figure. I wish she showed it. These corrections that she does in the paper. Now, I'm actually not going to go deep into the paper. I'm going to try to put this paper into a little bit of a bigger context because I think now tariffs, I think what Canada, we're putting another 50% tariffs on. He'll probably change his mind. But point being, we kind of need to understand what's going on. These seem to be big effects. So I'm going to put this paper into context as, does this paper let us revisit what we learned from 2018? There are a huge bunch of papers that talk about 2018. And I think this paper helps us think about that in a better context. We're going to talk a little bit about the data. I think this is important to see what we can and can't see because a lot of people are using different types of data. And I know she didn't spend a lot of time on it, but I'm going to actually talk a little bit about welfare because at the end of the day, that's actually what we care about. And I'm going to think about what elements do we need to nail welfare. I'm actually going to skip a little bit of the household stuff, mostly because I have no clue what's going on, and I apologize for that. And everything I said, actually the paper almost footnotes every single thing. I'm just going to trace everything kind of to like a logical end conclusion and see if we need to actually bring it back to the main text or leave it as a throwaway footnote. So just to kind of put everyone in perspective, let's see, what did we think happened in 2018 when Trump did his first set of China and steel tariffs? And so there's a huge host of papers out there. I'm going to pick on a few people. These people are all big, famous, tenured people, so I feel okay picking on them. So there's one set of papers that says the foreigners paid nothing. No prices changed in China. So Mary Amidi, David Weinstein, Pablo Fogelbaum, Penny Goldberg, I'm missing other famous people. They all say there's zero pass-through in producer prices at the border. There's another set of papers that look at consumer level data. So Nielsen scanner tends to be the most common, but as you point out, Numerator has some equivalent data and so do other people. And I'm saying it's zero, but it's a very low number. It's either zero or some minuscule number passed through. So who's paying? So we're supposed to now think that Walmart paid everything. Now, that's not necessarily a thing, but it seems kind of odd that there's no pass-through at the consumer level, but there's hundreds of papers saying that you've got all these firms that may pass through stuff on, may over or under pass through depending on demand elasticity, but it's kind of weird that this residual seems to be adopting all of it. We're now slowly starting to chip away. This paper obviously does not talk about the left-hand side, but I think we should talk a little bit more about that. It's talking a lot more about the right-hand side there, right? It seems like that first wave did something, and the question is, why are results different? And we now want to think a little bit more about that. And so I'm going to first up say, the middle chunk here not being 100% is we're now moving away. I know ITI, International Trade and Investment, was last week. There was literally 5 papers in a row that said the first wave of papers needed better data. Once you use better data, things changed. And let me talk a little bit about that and how it relates to this paper. So the first thing is what producer said. I know this is not about this paper, but there's one thing that's really relevant. And there's this paper by Bornstein and Peters. It came out in the AER last year. It's actually a really nice paper, and that shows something called quantity discounts. It's cheaper to buy stuff in bulk at Costco than it is at Walgreens, a single unit. Now, this has implications because at some level, from the household's perspective, a supply curve is not flat. It says the supply curve is downward for a household. That's going to change how we think about things. And in particular, it's going to change how we think about these quantity and price regressions. Because we're now not just moving on a flat supply line. So the paper essentially assumes there's a flat supply line. You're moving along that flat supply line because of some consumer behavioral response. But no, there's actually something else going on. There's also a slope. So we need to think about levels versus slopes. And that's relevant for this paper. Everything the paper did is right. The question is, when we take this to welfare, we're going to have to reevaluate some of these points. The second thing is, getting a little bit closer to this paper, is what do we think about consumers? So there's two kind of comments. I'm going to focus on first a comment about what data we have. And there's a brand new paper by Bai and co-authors, which again was presented first time this week. So I'm not going to blame the authors for not knowing this paper. But they go back and revisit the 2018 episode. And they find something very cool, in my opinion, which is terrible for consumers, which is goods that were hit by tariffs. What ends up happening is the manufacturer pulled that UPC code from the marketplace and replaced it with an inferior product, on average being 10% smaller. The problem is this is a pure good substitution margin. This is not good for price indices. This paper uses a price index. Now, how are you going to index a new good that did not exist in the previous? There's a whole literature trying to do that, but I think that paper should let us engage a bit more on that margin because it's going to be something. The second point that's super cool in this type of data is something about what I'm going to call the foreign cost share. So when you buy something at Walmart that's originally made abroad, how much of that cost share is foreign versus domestic? And there's actually a really another cool paper by Flan and co-authors, actually one of your colleagues at the board, which is just looking at a single company that imports wine from abroad. But what's really cool is, this is a plot from their paper, it shows looking at a bottle of wine that costs $25, where are the different markups and costs coming in? So this is the bottle of wine pre-tariff, but the exporter only receives $5 for a bottle of wine at a retailer that sells for $25 and a restaurant that sells for $75. Okay? This is what you need to know. When you buy a bottle of wine at a restaurant that costs $75, that wine yard makes $5. Okay? But that means that, should we be thinking about this in percentages or levels? This paper is a log-log specification, broadly speaking. There's a larger literature that says we should not be using log-log specifications in this. It should be all level specifications. And this is going to matter for welfare because you can double the tariff. That's not going to pass through. And mechanically, you're going to get very low pass-throughs like you found. You found a relatively low pass-through, but you found this huge quantity response. Quantity response, this could line the two up where they're more in line once you start taking a little bit more serious that concept. And that gets to a little bit about what the data can and can't see. I'm not going to get too into this, but one thing I want to point out is tariffs are done at the HS8 level. This paper is done at the HS4 level. There are only 1,000 HS4 codes. Of those, only really about 150 to 200 are consumer product relevant. That leaves apart everything else is intermediate goods, capital goods, so forth and so on. So really, we're looking at there's really 200 observations here. So I want you to think a little bit more about weighting, what's driving the results, because this is a kind of like almost a shift share type instrument. We got to be worried a little bit about that. Again, that's a minor question. There's a huge thing about heterogeneity, but one thing that kind of struck me, I'm just going to point on this bottom bullet point is here. Why do we see this heterogeneous results? Is it because Walmart is selling goods for low income people at marginal cost? and there's lots of margin at high income goods. So this is kind of a level question, or something else going on in the marketplace. It's a little bit of a black box. You try to get it from the consumer sentiment side. I would say also look at the supply side, because this wine being marked up is for the rich consumer. So there is a little, pass through in percentage is going to be much less in wine than is going to be for a cheap $1 trinket from Walmart. So really tell us what's going on, because I think this regressivity result is something that a lot of people are going to glob onto. And other results have actually found it in the other direction in pre-tariff periods. There's a Hotman Monarch paper that actually finds it opposite. So this is actually kind of new in that sense. And so just a little bit more context here. I'm not trying to say, what's going on, but think about why results are heterogeneous. Everything's kind of done in this homogeneous set. So I'm just going to kind of like a big picture takeaway. I found this paper insightful. It kind of combined some survey data, which again, didn't talk much about, but it was a new insight that we hadn't seen in any tariff wave, because in the first tariff wave, it kind of happened as a surprise. We kind of lost the ball. We kind of knew what Trump was going to do this time. So everyone kind of was prepared, and we now have a much better pre and post period in that sense. But in terms of task, and I actually saw this in a couple places today. Levels versus dollars and percentages matters. We have to be very careful. And then we saw in the morning, two-part pricing, right? There's not the supply curves and demand curves are not necessarily in this flat sense, right? There's not a single price out there and going on. And then lastly, really think about kind of heterogeneity. What's driving these heterogeneous results? Because when you think about welfare, you want to know what's policy relevant and what's policy kind of invariant. And if this is just driven by poor people are buying goods for marginal cost from abroad, and everyone else is getting 5 million middlemen adding on value, that's going to be very different. It's like, what are we going to do? That means you have to solve all market power simultaneous to a tariff, and that's going to be a very hard policy reach and ask. But overall, I think on the bigger picture, valuable data set. It's not real time, but this is as close to real time. I'm still working on 2018 data. Some of those graphs are from my own papers. I'm just shocked that people can do things quickly because I'm really slow, but this is a really valuable thing, and it really gets at things. And it is a puzzle. Why are these price effects so small? This is kind of like the big puzzle in trade right now, and I think this is starting to unpack and just a little bit more. And then there's some minor stuff that we can talk about later. But overall, great paper, and thank you.
Sounds good. Thank you for the great discussion. Clearly more work to be done, but I'm happy to take any questions. Yeah. Go.
Let me just start with a comment. Just wanted to thank Sharat for coming from a different field and joining us with all that expertise. Related, that intermediation we heard earlier from Erica about the construction, supply chain, intermediate economy, and how that warehouse finance, how does that these markets that we don't talk about much in this room, how that affects financial conditions of households and the financial services around that. I just find it really compelling. So anything going down those suggestions for the intermediate in this work with this wonderful topic or other things, just kind of more of a comment, but thanks for bringing that up, and thank you for the thought. So sorry to take that moment. Peace out.
Thank you. Please.
So I just wanted to hear what you think about the fact that, the survey is interesting and provoking, but of course, pessimism isn't exogenous, right? So, these individuals are different for all sorts of reasons, right? Just to give you a working example for us to talk through, their political views could be different. So, maybe those people change their consumption patterns, but they would have done that anyways because of just the different environment. And so, I believe the pessimism story, but I want to know how you just think about that.
Yes, starting from the example that you gave. So I also thought maybe, some people got very frustrated due to what was going on. And then they actually thought maybe this is going to be a start of a recession. So let me go check. The only way in which I could check that is I know where people live. So I know a 5-digit postcode. And although I don't have their political affiliation information, I know what that area voted for. And I try to control that in some of the regressions. I don't find anything similar to what we're seeing in the survey results. So it is not driven by partisanship in that sense. But you're right in the sense that, you know, this was a very uncertain period. If you put yourselves back in April 2025, so from the Liberation Day to the end of April 2025, there were probably intra-daily tariff announcements, and people started becoming extremely anxious about it. I think this is what I was hoping to find when I started this. I was working with Numerator earlier. I mean, clearly a golden trophy for a researcher is a shock hits when you're working with a cool data set and you can just try to extract that from the data. This is exactly what happened. And when you look at that period, I thought people must be extremely uncertain about what is going to happen. And that must be, they might be waiting, they have been waiting for a recession in the last few years anyway. And this will definitely fuel the fire. And that's basically what they were saying in all of their results. And one thing I didn't show is the question 2 of the survey is an open response. So you can see what people are writing. And you can do some text analysis with it, but even without the text analysis, I can tell you that they were extremely doom and gloom about what was going to happen to the economy in the wake of this, and hence the results.
Question and a comment. One is, one of the reasons why Numerator matches administrative data as well as it does is because of the weighting. Paper library have weighting. Does that give you any concern when you think about doing the heterogeneity analysis across stuff? That's the question. Comment is related to what you just said about sentiment, which is usually when you think about like the Michigan survey sentiment, with the exception of autos, doesn't correlate very well with spending.
Mm-hmm.
And yet at this moment in time, you get a lot of power from the sentiment in what Numerator asks these consumers.
Indeed. So starting from the weighting, because I have household level regressions, especially on the survey part, I don't use any weights. I use weights only to aggregate things up. So when I do look at how Numerator spending tracks Census Bureau retail spending X autos, that's where I use demographic weights and other things. And this is also similar to, you can think of Numerator, if you work with Nielsen IQ data, it is similar to that. It has advantages and disadvantages, which I'm happy to talk about. But you're right in the sense that they have some benchmarking going on the background, although infrequently. But in these, I don't use any weights because I use a lot of household level and unit level fixed effects that are basically soaking everything up. And you're right in the sense that Michigan survey started diverging from sentiment. Chicago Fed colleagues have a very nice work on that. Basically, they adjust that by kind of like some other indicators so that it is actually more stable in the post-pandemic period. When we looked at Numerator panel, and there was another survey that Numerator ran, people are they were quite upset about high inflation period, and hence surveys were basically deteriorating going forward. Yeah, Raji.
Yeah, so your kind of exposure measure is a share with the share is 22, the penetration.
Yes.
Did you check whether the penetration ratio essentially remained the same? Because it does make a lot of sense that you are using a baseline penetration ratio. Does it kind of highly correlate or does it stay the same over time?
So the reason I didn't get to mention, the reason why it's fixed in 2022 is because shipment data comes from census and I don't have the shipment data, but we have exports and imports. When I started, I was not using shipments at some point. That was my oversight. When I looked at 2022 to 2024 period, it wasn't that different. With the new census data, when is that coming out? Do you know? August? Yeah.
So I think that is going to the last census data.
Yeah. Yeah, exactly. So once we get that, we might be able to see also if the composition is changing. But currently, because of an identifying assumption of tariff rate being the only time varying variable, that creature has to be fixed at a 2022 rate because of the shipments being lagged.
You could use the 2018, if it's the same data, to see whether or not there are similar patterns.
Yeah. Yeah, Sharadan, we were talking about this earlier. So numerator data is being made available for research purposes starting from 2018. So there is some variation. There is 2017, exactly. The information is a bit less. Their panel is much smaller, but there are some, things that we can trade off for longer time series, for sure. Yes, it's something that is definitely in my agenda to check. And in hindsight, maybe we know a bit more about the 2018, 2019 period than current period.
Do you think there's some potential for, well, here's the stock market went down quite a lot. And after Liberation Day, there's some degree of non-limited demand, the costs imported, unimported goods, could that point that if you come from something?
Maybe. I will tell you only maybe. The reason is because that's one thing that I didn't check. There is some limited self-reported survey information about whether or not people participate in the stock market. My gut feeling is that most of the effect is not coming from that, because it also holds for low-income households. They might still have some retirement funds, 401ks and such, and they might be cushioning against the hit to those. But because the results hold also for low-income households that don't have that much wealth accumulation to participate in the stock market, I am basically on the no side of the answer, but let me leave it as maybe, and let me go check what I can check in that. Okay. Any other questions?
I'm going to go back to Sharad's question about the big picture of this. Like what's your take on how much pass-through there is of ratio and these absorbing, given what the literature is?
Okay, so let me tell you how I feel about it. I definitely feel the same sentiment that he has. I also looked at if I could do anything on pass-through on levels. Also, Kunal Sagnani's new paper on QJE on pass-through and levels, it tells us that what I showed you for low-income households being hit higher in the percentage point level by tariffs is probably also a byproduct of that, right? They buy a $3 milk, whereas a high income household buys a $7 milk. And hence, if they go up in $1 in price, percentage point terms, low income households are hit higher. So there is definitely some room for that. That's one. So maybe 15 to 20% doesn't reflect that. But second, I think this time is a little different in the post-pandemic period, that we have just experienced a lot of high inflation. Consumers are not at the same level for absorbing pass-through to prices. And this is when you look at earning calls, when you look at some survey-based evidence from businesses, they decided to at least absorb the shock for a given period of time. Who knows what that given period is? Because tariffs it was a very big uncertainty period. They didn't want to increase prices so much and upset the consumer that was already scarred from a high inflation period, and then having to put the prices down if tariffs all of a sudden disappeared one day. So in that sense, for the current time period, there might be more tariffs to come. New York Fed colleagues just wrote a wonderful Liberty Street blog post about it. Small businesses saying that tariff pass-through is not over. So there might be more to come, and hence maybe we are seeing only a part of it on the shelves. But this is my feeling is that the reality is probably somewhere in between 15-20% to full pass-through. And I definitely take the point that my colleague at the board, Erin Flan, did a wonderful job at understanding different parts of intermediation and how those intermediaries absorbed or not absorbed the tariff costs, and what they see more than 1%, one full pass-through. So maybe in a couple of years' time, that will be the position in which we're going to find ourselves. But at the time being, I feel like we are mostly on the lower side of pass-through because of consumers' sentiment about high prices.
I was struck that neither you nor Arpit put up a map, right? And you're going to say I don't have enough sample to put up a map, but you could simulate out, right? And you were the same, right? And so it's kind of struck me whether that, the question is, the politics of that is obviously there with your affiliation, so on and so on. But it is an interesting thing to know the incidence of these things in general, and so just food for thought. Yes,
Indeed.
right, yeah.
Awesome. So we'll be back in 15 minutes for our last.
Thank you.
I had it like through twice. I had it.
But now we have like. Come back.
Scares there. Jackie. No problem. Hey.
Didn't go talking about the financial advice. There was, yeah. John's the word that over there. So we got our last session of the day. So very excited about students over presenting AI financial. 20 minutes.
Great, thanks for having us. This is joint with Taha, who's at MIT, Weldon, who's an awesome second-year PhD student at MIT, and then Matthew, who was a pre-doc at MIT, and I tried really hard to come to Stanford, but unfortunately he's going to Harvard instead, so whatever, no hard feelings. Okay, so the starting point for this paper is, as I'm sure we're all on board with, large language models are transforming many aspects of our lives, and one of them is our ability to access information and advice. Now, financial advice is one leading example of that. So some recent industry surveys suggest that over 50% of households are turning to large language models to ask questions about their financial situation and how they can make better decisions. And what's pretty striking about that is that it probably already exceeds the fractions of households that turn to human financial advisors. Now, the promise here is that LLMs have the potential, and I want to emphasize the word potential in that statement, to improve financial decisions by providing people access to a source of advice that has three things that other forms of advice don't jointly have. The first is that they can potentially be very low cost and widely accessible, unlike traditional forms of human advisors. The second is that they can potentially be quite high quality in the sense that they're not subject to conflicts of interest and the misconduct that many of the people in this room have worked on in the context of human advisors. And then third, relative to other forms of automated financial advice, large language models by their nature have the ability to potentially have the soft skills that people seem to value. However, ultimately, the impact of this advice is going to depend on two things. First, what advice LLMs actually give, and then second, how people change their behavior in response to their advice, the advice that they get. And this paper is going to be about the first of these two things. So in particular, we're asking the question, what financial advice do large language models give? This may seem like a very straightforward question to answer, but it's not for several reasons. So the first is that evaluating financial advice is by its nature something you can't do in a static experimental context. The impact of saving more today or investing in one asset versus another has dynamic impacts that accumulate over the life cycle that we need to keep track of. And so the way we're going to deal with that challenge is to leverage the structure of a life cycle model to simulate the long run effects of financial advice. The second and more important challenge in the context of large language models is that the answer that you get depends on the question you ask. So I can't just go to a large language model and say, how should I invest my assets, and then write a paper about that? Because the way that I ask the question as a finance professor and the context that I provide could be quite different from the way households actually ask questions. And so the way that we deal with this challenge is to conduct a survey in which we actually elicit human written prompts that people write and use those to simulate the quality of advice that people are actually getting. Now, when we study this advice, one of the things that we find is that it varies quite a bit across individuals. And so the second question we're going to ask is, where does this variation come from? And when we do that, we run into a third challenge, which is that large language models are by their nature very complex, and they may respond to many different aspects of the prompts that people are writing. And so what we do to determine how much of the variation in advice is coming from the model itself versus what people write, is we introduce kind of a novel experimental design in which we randomize features of the prompt to identify how much of the advice is coming from characteristics of the model versus what people write. And so as an example of something we'll be able to say something like 2/3 of the gender difference in investment advice is coming from the fact that men and women write different prompts, while the remaining 1/3 is going to come from the fact that even conditional on the same prompt, the fact that the LLM knows that the person writing the prompt's a man or a woman causes it to give different advice. So let me talk about our methodology. So we're going to leverage the structure of a life cycle model, which starts with a set of state variables. So the model we write down is relatively straightforward. We have a set of exogenous states, things like income, employment, asset returns, and a set of endogenous states that depend on choices. So things like wealth and asset accumulation. Normally, what we would do is solve the model to get a set of policy functions, and that would give us a set of choices, and then we would use those choices to update the endogenous states and then repeat this process. The core insight of our methodology is to replace the second step by instead turning to an LLM. So what we do is we use a survey that I'm going to describe to you in a couple of minutes, where we elicit prompts that people write asking for financial advice. We then send those prompts to an LLM. We get back textual responses. We then convert those textual responses into quantitative recommendations, and those are then the choices that we use on the right-hand side here. Once we've done that, we can then repeat this procedure forward, just like we would when we're normally solving a life cycle model. So let me walk through an example just so you have an idea of how this works. Here's one simulated individual in our sample. They're 26 years old, they're employed, they have some income, and then they have the following asset allocations. We consider 4 assets: a fixed income instrument with a constant risk-free rate, a diversified stock portfolio, and then individual stocks and alternative assets like crypto. So what we're going to do is find a prompt that's written by somebody who has a similar age, the same employment status, and a similar income to this simulated individual, but in our survey. This prompt's going to be randomly drawn, and then here's an example of an actual prompt that we got in this case. So this individual says, I make $75,000. I'm looking for ways to enjoy life. How should I save my money, or how should I invest my money now that interest rates are going down? We're then going to look through the prompt and find all mentions of values of things that are our state variables. So in this case, it's income, wealth, and age. And we're going to replace those with the values that correspond to our simulated individual on the left-hand panel. Once we do that, we're going to combine the prompt into one prompt, and we're going to send it to an LLM with an API call that has a completely empty context window outside of this message, and it's going to be empty every time that we recall it. So all of these queries are going to be independent. When we do that, we're going to get back a response. Here's what the LLM said in this case. It said this long piece of text. I'm not going to read it all, but it said create a fund system, save 15 to 25% of your income, invest in low-cost index funds. That's textual advice. We want quantitative recommendations. And so the last step in our methodology is to translate that advice into quantitative recommendations. Now, there's a lot of subtleties here that we try to be very careful about in the paper that I won't bore you with the details here in the interest of 20 minutes. But this translation is done with another LLM, and we did quite a bit of work to verify that we're getting sensible things here. Once we have these choices, we can then simulate the realization of the shocks in our model, which are the labor market transitions and the asset returns. And then we can update the set of endogenous states with the choices and the realizations of the shocks and keep going. So we're going to compare the LLM advice to 2 benchmarks. One is the top, which is if you just were to solve the life cycle model. And then the second benchmark is what we call the academic prompt. And this is a prompt that we wrote. So here's the academic prompt. Basically, what we try to do in this prompt is to emphasize to the LLM that you have the duty of acting in the best interest of your clients. You're trained in household finance and kind of portfolio theory. Here are the assumptions you should make, and then we provided all the information about the individual. Okay, so let me talk about the prompts that people wrote and the baseline advice. So we got the prompts from our prolific survey. We had around 1,000 respondents. We asked them to write 3 prompts. First, describe your financial situation. Second, ask for how you would, or describe how you would ask an LLM for advice on how much to spend versus save. And then third, a prompt about asset allocation. We collected some other information as well, which I'll use when I show you results later. One thing I want to emphasize is we tried to restrict the sample to prompts that we think are reasonably high quality. So this led us to 952 prompts. We kind of made sure that these weren't detected by AI, and we also had to have a requirement that they had kind of enough specificity in order to implement our analysis. So we do a lot of textual analysis in the paper of the prompts. I don't have time to show you that, but let me just show you a few kind of stylized things that we find that give you some way to interpret some of the quantitative stuff I'll show you later. So here's a word cloud of the things that people mention in their prompts. They talk a lot about things like money, income, pay, debt, retirement, as you would expect. And as for the LLM's responses, the LLM talks a lot about saving, of course. It talks about investing. It talks about stocks. It talks about funds. One of the interesting findings that comes out of the textual analysis is the extent to which investment products are mentioned. So what I'm showing you here is a graph of the frequency with which different products are mentioned, where by product, I mean a specific ticker. In blue, you see the household prompts. You can see basically nobody mentions actual products with the exception of crypto. The LLM in red, in contrast, often mentions specific products. And this was no mean by design, given that Vanguard's sponsoring the session, but it turns out to be that Vanguard is the most mentioned product in our sample. So we don't focus a lot on this in this paper, but I think it raises some interesting questions about the nature of product competition and how product search is going to look in a world in which everything's intermediated by agents. Okay, so here's what the quantitative advice looks like. On the left, I have the income profile, which has nothing to do with the advice. That's just coming out of the model. And then in blue, I have the consumption profile that comes out of GPT 5.2. So you can see it looks pretty reasonable. It's high during working life. It has a little bit of fall during retirement. But broadly speaking, it's kind of a sensible thing. We're going to dive into the details in a little bit. Same thing with the equity share. We see equity share that rises a little bit during early life. It peaks around 80% and then it starts to fall. Now, before I go any further, you're probably thinking, this is ChatGPT 5.2. You're now like 4 models out of date. This was the latest model at the time we ran our analysis. At that same time, we also ran it using Gemini. So this is an alternative model provider. You can see that the results are very similar. And then just last week, we ran this using ChatGPT 5.6 Terra. And you can again see that the results on this are quite similar. So for the rest of the talk, I'm just going to focus on ChatGPT 5.2. But just this is a way of emphasizing that things do vary across models in principle, but we find the variations not huge. Okay, so let's turn to the 3 facts about the financial advice. Our first fact is that this advice moves people in the right direction. So here's a plot of the equity share in the middle, which I already showed you, but then the stock market participation on the left, and the fraction of households that have more than $10,000 saved up. So this would be like, do you have a buffer stock saved up? So what we see is that stock market participation rates are quite high, get close to 100%. Equity shares are quite high, and most households have at least $10,000 saved up. If you compare that to people's actual behavior, you can see that the LLM is pushing people to participate more in the stock market, higher equity shares, and build up a buffer stock. So that's kind of qualitatively all things that life cycle theory would tell us are a good idea. Our second fact, though, is that when you dive into the details a bit more, there are some subtle ways in which this advice deviates. So I'm showing you this graph again on the left, where I have the income profile and the consumption profile. And what you see as you stare at this a bit harder is that the LLM actually doesn't look like it's doing a very good job at smoothing consumption. So during working life, at all periods, consumption's below income. And then when you get to retirement, consumption falls down towards income. You can see this even more clearly if you do an event study that's kind of similar to what John Gruber did and what Pascal and Peter did in their more recent paper, where you look at what happens to consumption around an unemployment shock in the LLM advice. And what we find is that despite the fact that the LLM has built up substantial buffer stocks for people, the LLM is very hesitant to draw down the stock of assets to fund consumption during unemployment in a way that's actually quantitatively quite similar to what we see in the data. Now, part of this lack of consumption smoothing comes from the fact that the LLM relies on heuristics. So what I'm showing you here is a histogram of the savings rate that the LLM recommends. You can see there's a lot of bunching out round numbers, which is of course not something you observe in a life cycle model. But more importantly, the LLM is kind of very unwilling to disobey a very common withdrawal rule, which is to not withdraw more than 4% of the balance that you have saved up. So that's a common rule you'll see among financial advisors. What we see here is that the LLM's withdrawal is 98% of the time. We respect that rule. So this lack of willingness to withdraw shows up in kind of pretty interesting time preference parameters when you estimate the model. So what we do here is we estimate our structural model on the advice that the LLM provides. And what we find is that you need a discount factor above 1 to actually rationalize the LLM's recommendations. This is consistent with the fact that the LLM is very hesitant to draw down the stock of assets. This estimate of the preference parameter, again, pretty similar across models. As for risk aversion, we get something that's pretty reasonable, which is not surprising given the stock share that I showed you. Now, the last way in which the LLM deviates from kind of standard life cycle theory is with respect to portfolio rebalancing. So what we do here is plot on the x-axis a measure of passive portfolio drift, and on the y-axis, the actual portfolio change. So in a life cycle model, these are unrelated because you always just rebalance back to your target equity share regardless of the realization of returns. In contrast, the LLM exhibits a substantial amount of portfolio inertia. So the slope here is almost 1. This is quite a bit larger than what Calvera and co-authors found in household level data. I don't have a ton of time to talk about this, but one of the things we find is that the academic prompt, by providing all this additional information and emphasizing certain things, tends to reduce the extent to which the LLM relies on these various heuristics and kind of brings the advice closer to life cycle theory. The one exception is with respect to portfolio inertia. But on the whole, the fact that this academic prompt changes things tells you that the characteristics of the prompts are going to matter. And so that leads to our third fact, which is that the advice varies quite a bit across groups. So what we do here is we break up our prompts into prompts that were written by households that score below median in terms of financial literacy on the kind of Lusardi and Mitchell Big Five questions, and then above median financial literacy. We then have 2 sets of prompts. We're then going to simulate our methodology for the identical realization of all exogenous shocks, but drawing separately from the 2 pools of prompts. We can then ask in those 2 simulations, what is the difference in outcomes that we see? And what we find is that households that are in the simulation where we draw from low financial literacy prompts, households tend to reach age 60 with around $50,000 or 4% less wealth. Where does this come from? Well, it actually comes entirely from the equity share. So if anything, the savings rates go in the opposite direction, but the lack of wealth accumulation for low financial literacy prompts is coming from the fact that the equity share that the LLM recommends is lower. We see a similar difference on gender. So here, women retire with around $60,000 less wealth, reach age 60 with around $60,000 less wealth. All of that comes from the equity share. And so the natural question then is kind of where this is coming from. And that's where we're going to turn to next. So basically, is it the fact that these differences in outcomes across people are coming from something embedded in the model, or the fact that different people write different questions? To show you that different people are writing different questions without doing any quantitative analysis, one thing we can do is just look at what people write. What I'm showing you here is the prompts for men versus women. Among men, the most common word is wife, and among women, the most common word is husband. But setting that aside, what you see is that women are a lot more likely to talk about things like credit, loan, card, account, job, debt, while men are a lot more likely to talk about things like security, investment, tax, crypto, portfolio, et cetera. And those differences show up in the LLM's responses. So on the left, you see the LLM's responses to men, and on the right, you see to women, the LLM is a lot more likely to talk about CD, FDIC, credit unions, while on the left, there's a lot more discussion of kind of portfolio or kind of risky things. So to decompose how much this difference in prompts matters quantitatively, what we do is we consider the set of prompts that do not explicitly identify the person's gender. So not just the person saying I'm a man or a woman, but the person saying things like my wife, which implicitly identifies their gender. We throw out those prompts, and then at the beginning of the remaining prompts, we randomly insert either the words I'm a man or I'm a woman. Why is this useful? Well, it's because it allows us to run this regression. So we're going to regress an outcome of interest onto an indicator for whether or not the prompt was actually written by a woman, because we know this from our prolific survey, and a separate indicator onto whether the prompt was randomly identified as being written by a woman. So this is useful because if you think about the reference case as a male-written prompt that's identified as a man, the supply effect is going to come from looking at a prompt that is actually written by a man, but we randomize it to being stated as being written by a woman. And the demand effect is going to come from the reverse, the prompt that was actually written by a woman, but we randomized to being written by a man. And of course, the total effect is the sum. So the last thing we do is then decompose various outcomes into demand and supply. And so what the ones that I'm going to focus on for the context of this talk are the diversified equity share and the undiversified asset share. So the diversified equity share, like the normal stock share we would have in our model, the undiversified equity share would be things like crypto and individual stocks. So we see, consistent with what I showed you earlier, the total effect for women is negative. Around 2/3 of that comes from the fact that men and women write different prompts. That's the demand effect in red. The remaining 1/3 is the supply effect. In contrast, for the undiversified asset share, there is a difference. It's quite a bit smaller, but all of that comes from demand, i.e. a lot of this is coming from the fact that this includes crypto, and men are a lot more likely to talk about crypto in their prompts. We do a similar separation for racial groups. So here's black versus white. The LLM recommends that black households have a higher diversified share and a lower non-diversified share, although these are a bit smaller. Here, all of the difference is demand. And we, again, do this for Asian versus white, and we find something very similar. Almost all of this is demand. Now, before I wrap up, I just want to spend a minute talking about how we interpret these kind of supply and demand differences. So I want to emphasize that we don't want to take a stand on whether these supply-driven differences are desirable or not. So on the one hand, it could be a good thing. So to the extent that the model is doing implicit inference in the sense that maybe men and women have different risk aversion, and so you should give different advice to men and women, that would be a good thing. But alternatively, of course, this could reflect some form of algorithmic bias where you're just perpetuating stereotypes in the training data. The supply differences can also be shaped by design, right? So the lack of a race effect on the supply side could reflect training safeguards that have been emphasized a lot in the context of training these models. And then finally, the demand-driven differences, these are kind of real, and they reflect differences in what people talk about. And so in some sense, these are a good thing because they allow the model to personalize. But the one thing we want to be careful about is that there's a sense in which these demand-driven differences could perpetuate biases that people have, and maybe that's something we'd want to change with model design. Okay, so let me wrap up. 3 facts. The LLM advice moves people in the right direction, but there are some subtle departures, and this advice varies a lot across groups. The kind of 2 takeaways I want to leave you with are that it seems like, to a first pass, LLMs have the potential to improve decisions. And I do want to emphasize it's not obvious at all that this would be the case. If you think about how these models were trained, the last step is RLHF, reinforcement learning with human feedback. A lot of that is about getting the model to please humans. It's not obvious at all that that's a training step that would lead to good financial decisions. The second takeaway is that this impact is going to vary. While it's good on average, it's going to vary a lot across individuals due to demand. And I think the key question we need to ask ourselves is how these results are going to change as models evolve. Of course, we can't answer that. We showed you some evidence from more recent models. But the 3 things I want to leave you with is first that this paper kind of provides you with a scalable methodology that you can use to track the models as they inevitably start changing. The second thing is that we hope to provide some kind of diagnostic tests that are grounded in life cycle theory. A lot of the way these LLMs developed is we have benchmarks and we try to improve the model to target a benchmark. These potentially, the ones that we're putting on the table, are natural benchmarks to use for this advice context. And then finally, the demand side is probably going to be a lot more slow moving than the supply side. And so if we want to think about how this advice is going to play out, we should think about demand. So I have a picture to leave you with that, which is courtesy of ChatGPT. Thank you.
Gameplay will discuss.
All right, well, pleasure to discuss this paper. In my PhD course in household finance, I tried to hammer home to my students that they should have the ambition and the courage to work on topics that are important and interesting. And I think certainly this paper easily clears that hurdle of talking about or researching something that is interesting and important. And, I think that about 75% of the lunchtime conversations I have with my colleagues for the past year have been, how is something about AI? How is AI going to affect blank? And I would guess that probably everybody in this room has at some point consulted an LLM for medical advice. And so, I think that just the kind of the scope of, the possibility that AI is going to affect our financial behaviors is certainly something that is very much on the table. Now, because everybody is interested in AI, of course, this has already become a space where other researchers have entered. And I think that the papers to date before this current one have tried to explore the type of device that LLMs provide using prompts that researchers themselves have created. And I think that economic researchers have a little bit of a handicap in assessing how is LLM advice actually going to, at the end of the day, affect individuals, the advice that individuals get and the actual financial behaviors that they exhibit, because economists have this pathological need to make the prompts make sense and to actually provide information to the LLM so that the LLM can actually provide informed advice. So this is from a recent paper. Not to pick on these authors in particular. There's, these are I think this is kind of typical of what has been fed by researchers to LLM. So it's like, I'm male, 30 years old, live in the United States, investing for retirement over a 40-year horizon, I have a high risk tolerance, et cetera, et cetera. And so this is, very sensible prompt, providing information, coherent question. Now, the academic prompt that this research team provided, you have a persona, you have baseline assumptions that are provided. I want advice in these particular action domains. By the way, here are the definitions of the variables. Here are the laws of motion that those variables need to satisfy. Here are the budget constraints that these variables need to satisfy. Again, very, very sensible stuff. Contrast this to the actual prompt of a subject in the study. This subject was assessed to have low financial literacy. Hello, I'm in need of some financial advice. I need to invest some money into something that will make me money in the future. I have current stocks invested. However, I know very little about stocks and how and when to buy and sell and what stocks I need to buy and or avoid. Some advice would be very helpful. Thank you. Now, there's really no ex ante reason to believe that the advice that the LLM would provide in response to this kind of a prompt would have anything to, resemble at all the prompt, the advice they would provide to this prompt. And so the great advance of this paper is to really take these prompts that are user generated from a representative sample, rather than using the prompts that an economist would feed to an LLM. Now, I think at the end of the day, what we really care about is how are people's actual financial decisions and choices going to be affected by LLMs. And so I think it's helpful to sketch out the causal chain that would go from all this, content that is in the cloud somewhere in the LLM weights to the action that's taken. And so first, you need to make a decision to consult the LLM. Then there's going to be the initial prompt that you feed to the AI. Any follow-up prompts that you choose to feed to the AI, then you need to interpret what does this output that the AI has given to me actually mean in terms of a concrete action, and then you need to actually take or choose to take that action. So I want to just kind of go through each of these steps to see where the paper has made a contribution, and then I think there's just a lot more work that remains to be done, exciting work that remains to be done to understand all the steps along this causal chain that's going to eventually get us to the action that people will take. So first, on the decision to consult the AI, well, this paper by construction, the subjects are all being asked to provide a prompt to the AI. So that extensive margin decision to consult an AI, not studied at all in this paper. And we know that the decision to consult an AI is going to depend a lot on your demographic group. So one example is that women are much less likely, or not, they're significantly less likely to consult an AI than men are. So 40% of traffic to AI sites are by women, 60% by men. And so this seems to be a pretty persistent phenomenon. Conditional on deciding to consult an AI, there's the question of how often you're going to consult the AI. And so in this paper's lifecycle simulation, the agent consults the AI once a year, but you could easily imagine that some people consult the AI multiple times a day. Some people might consult the AI, once every several years. And probably that frequency is also going to vary by demographic group systematically. Given that I am consulting the AI, there's the initial prompt that I'm going to give. And I think that, in the way that the authors have constructed this survey, there's a little bit of the economist's way of thinking that is bled in that they ask the subjects to write a description of your financial situation and then ask for advice on how much to spend and then how much to invest. And, I would bet that a lot of people, ordinary people who consult the AI, would not actually write a description of their financial situation. They would just go straight to asking for the advice. So there's a little, in some sense, what is being fed to the LLM in this exercise is maybe a little bit more sensible than what people would choose organically. Now, prompting style differs a lot across people. So this is the prompt of a user who has a lot of experience with AI. And so, assume you are a CFA with 20 plus years of experience. So, this style of assuming persona, like 5 years ago, if you had said, this is how we're going to talk to our machines, it's like, yeah, that's kind of strange. But now we have this particular ritual that, when we summon the AI oracle, this is the best way to get advice. This is received wisdom among those who are in the know. Versus, hello, I'm in need of some financial advice, et cetera, et cetera, et cetera. And so these different prompting styles are going to be pretty, may elicit fairly different advice from AI. And probably within person, the prompting style is highly serially correlated. Now, in the paper's lifecycle simulation, what's happening is that as the person moves over time and as they change financial situations, the authors are drawing a random prompt from somebody who's in that bucket. And so there's some independence in prompting style that is built into the simulation, which is probably a lot more independent than what would actually happen for a real person who's consulting AI over time. And so there's probably some understatement in the inequality in outcomes that would kind of result from repeated prompting of the AI across people because there is this independence being built in to the prompting style. Now, you do the initial prompt. Now, there could be a follow-up prompt. And so I actually put in that low financial literacy individual's prompt into ChatGPT without providing the background financial advice, information. And actually, I put it on temporary mode so that ChatGPT wouldn't remember that I'm a finance professor who has consulted the AI and many things like Taylor expansions around the steady state consumption level for, now, I mean, that's kind of the separate thing. Like these AIs carry around memories of the user. And so that's not being studied in the current research design. Very difficult to study, of course, but I think that memory does significantly impact the output that you're getting from these AIs. And so that's something that should be studied, but very, very difficult to study. In any case, I fed in the low literacy individual's request for advice without the financial background, and GPT gave some advice. Then it asked some follow-up questions saying, well, would you actually provide some of this background information that would be relevant? And now I can make a choice as a user. Am I going to actually provide any of this follow-up information and continue to engage with GPT, or am I going to just stop? And that tendency to provide or do follow-up prompting and how I provide that follow-up prompting probably, again, varies significantly by demographic group. So that's something that this current study is not addressing. Next, I need to interpret what is the AI saying and how does that actually translate into a concrete action? So in this paper, the LLM's advice is passed to another LLM to extract numerical recommendations. And then, there's some choices that are being made along the way to get to the concrete advice that's fed into the lifecycle model. So monthly amounts are annualized, ranges are converted to midpoints. So the LLM might say 10 to 20%, and the authors say, okay, we're going to translate that into 15%. But it could be that when women hear 10 to 20%, they think 12%. And when men hear 10 to 20%, they think 18%, or vice versa. I mean, I don't know, but it's not unreasonable to think that the way the people interpret the advice that comes out of the LLM into concrete action could vary systematically by demographic group. And finally, you need to take an action. And, I can say from decades of researching ways to try to get people to change the behavior change is really hard. That attrition rate from your intent to treat to action, very, very, very high. And so there's going to be differences again across demographic groups probably in that translation from the intent to treat from the AI into the action taken. So that's also going to really affect how different demographic groups are affected, and also just the overall average effect of AI advice on ultimate choices that are being made. So just to summarize, I think this is a really important and exciting new area of research, but there is a lot more left to be done to get to that final answer that we all want to know, which is what is the effect on choice going to be? Understanding those steps along that endogenous causal chain of how frequently and if at all to consult AI, what style am I going to use when I prompt? Am I going to follow up prompt? How am I going to follow up prompt? How am I interpreting the AI advice? And then finally, how do I comply with AI advice? A lot of work to be done, but I think this is an important first step. Thank you.
Thank you so much, James, for such a thoughtful discussion, and completely agree. There's a lot here to be done. Build on this. Take questions.
So James talked about the interpretation of the same kind of financial advice that the AI would give. What about also just the way that the AI presents the same quantitative numbers in different ways, like referring to life cycle models or not, like the length of it, the extentness of the wording that you obviously left out from here, but that seems also very important in coming.
Yeah, but then I think that's a great idea. That's something we can do. I mean, and the example that Jim showed, coding something, a fun account, like when is it using these kind of strategies of trying to convince people with labels and fun names? I think that's a great idea.
So what James described was great. Thing about the differences that are there. I thought, since you said so many of the models are similar, it seems like you could do a lot of just trying to use one of these open weight models and think a little bit more about the uncertainty across what it's going to be predicting. And you see so much of what it's doing, you'll know what the prediction is of the next token. Like you said, there's kind of a lot of concentration on the certain types of things. This is this joke about you ask AI to tell a story, it will be in one of three settings: a lighthouse, a farm, or a village. There's a high degree of confidence, like a well-known property because of what you were talking about, Jeff. So it'd be interesting. You're going to get a lot of weight loading, maybe on certain types of recommendations, certain types of things, and you can propagate that uncertainty, similar to what Jim was talking about for ranges, but you'll know, and maybe there'll be differences in what the AI does. You might also get variations of function of like the types of prompts that you put in. There's just a lot of like things there. If you use an open weight model, now like, there's these big ones that you can use. Just see what it's going to predict.
It's a great idea.
One thing that would be helpful, either with these results or in a follow-up paper, I think, is if you would create an explicit financial benchmark. So I think you're kind of hinting at this like a little bit in the last slide, but I think something that's more explicit about like, here's a set of inputs, here's a set of outputs, here's how we would grade, for example, how any arbitrary model would perform at the task of either life cycle consumption modeling or like whatever task you think constitutes like a sufficient financial economic benchmark for us to like systematically test different models. That way it's just like a series of like input-output tests.
That's a good idea. That's kind of the direction we go in. The problem is that so we have like qualitatively the life cycle model is kind of our benchmark. To go from there to quantitative benchmark, you need to take a stance on preferences. And that's when it becomes a little bit difficult, because the same, the model doesn't tell you these broad principles. You should be diversified, participate in the market. But should your equity share be 85 or 75%, that's going to depend on preferences. And so if we don't have preferences, that's going to be hard to.
Yeah, the only other thing I'd say is that I think that's maybe a case for looking at other decisions as well. So I think consumption savings and portfolio choice decisions depend a lot on stuff that the actual number depends a lot on stuff we don't have a sharp posterior on. But things like, are you paying down the right credit card, like the high interest one as opposed to balance matching? There we have a pretty good sense of what the normative right thing is to do. So maybe the way to go is to focus on other decisions where it's more clear.
To some extent on this. Another question, one thing that's been shown, both in the field and in the lab, so there are differences in risk aversion for men and women. So if you had, similarly to this presentation, so if you had some kind of a benchmark of plug in, either field or lab estimates of risk aversion, see that give closer to optimal advice given the risk aversion.
So I guess that's true. I think it's interesting. There are differences in risk aversion between men and women. But I think in some studies, the R square of gender in explaining these differences is very low. In some studies, it's 1%. And so the idea is that as a tag, because there's so much dispersion within gender and risk aversion, to have the advice be so different based on some implicit inference about something that doesn't explain much of the variation in risk aversion may not be so good, or at least it should be explicit, that I'm giving you different advice because I think that as a man, you are more risk tolerant.
Can I jump the order? Sorry. I couldn't disagree more with that, my friend. I was gonna jump on the comment about that. You're already conditioning on me, female, saying dead and household and da. So you're already conditioning on that. And then to say, oh my goodness, it must be that women are more risk averse. Why you're giving this bad advice because the model decides whatever. I think that's the capital P pluralistic LLM. No, but they're already conditioning on that. And so to say, oh, it must be this, I think is unfair to understanding the damage done to women by that. Sorry, I'm being super feminist.
And maybe when
bad feminist, but anyway, but I just think that jumping to that interpretation is a kind of a male thing.
I mean, and
Maybe we'll be silent.
One thing I'll add to this is that we've done some work on the content of the prompt. So when people mention risk aversion or risk, you get sensible advice where you get lower risk, recommended risk aversion, higher saving, which is consistent with precautionary saving. So when people mention it, they get the advice. And so that at least that dimension would be captured by the method. It's Francesco. Yeah. Sure.
I think the advice on saving, I have the data. I mean, among the many things that comes out savings, your expected shoulder income and your expected mortality, there's no reason why the LLM have the same expectations that were in our model. So actually, a very simple thing you can do is actually ask it, say, I'm 35-year-old, my income is X. What should my expected income be age 40, 45, 60? And that's what the LLM expects and thinks. So I'll do it. That might be better, sensible.
So I'm thinking these kind of welfare considerations. Sometimes you go to a financial advisor or you go to a personal trainer because it's a commitment device, because he push you more than he should. And I'm afraid that some of this is going to be lost if we take away the human component, because the LLM is going to be more likely to recommend something that is in line with my preference more so than nudge me towards something that should be better for me.
I'll just very short answer on this, because there's one fun example where someone just says, should I buy Bitcoin or Ethereum? And the response is, yes, you could put 3 or 4% in crypto, but I would actually recommend that you invest in a diversified equity fund. And so it's actually willing to push back, which was quite surprising for us.
Want to see how the so then consider a perturbation where they give a prompt and it will make the prompt sound way worse, like add misspellings, just make the person sound like they're as uneducated as possible. And then also reverse, make them sound like they're old sophisticated, and just see whether the advice you get is way more complex in one case. To mention that 4% cutoff rule, I'm curious whether it's being essentially paternalistic there, or not complex heuristics for you to decide one, whereas that might vary.
I was wondering a little bit about, kind of related to James' discussion. Like if I think about entering those same prompts kind of into like a Reddit personal finance forum or something like that, it seems like the advice would be pretty similar. There'd be some pushback on crypto, a diversified portfolio, have a fund account for spending, things like that. And so, is it just that this is kind of displacing, AI is displacing that, or is it like all those other things that we think are kind of maybe the more interesting components about like
the follow-up, the follow-up discussion, the context that, I can load all of my transactions in there in a way I can't, in these other things, and like, kind of what's the fight of, AI versus like the average distilled wisdom of our personal finance or something.
ChatGPT talked about, or maybe they did introduce, like linking the lab. I wonder if you could kind of explore with your prompting how that actually reshapes the advice, with like some kind of like pseudo linking of actual financial, and kind of like financial data.
I think of emptying the context window of asking it for the modal response and its distribution of responses that are trained. But I'm wondering what also is valuable in exploring some of that distribution as well. Like, I think this is the right approach for the core of it, but there seems to be some information distribution that we may have.
The comment of implementation, I think that's the really interesting thing here. And so I've been playing around with some data in March. So the project I'm kind of running on the TIA data, and only half the people who start filling out the forms to get advice actually get advice. They just stop. And then half the people who get advice take the advice. And you're more likely to take advice if you're told to increase risk, if you're told to decrease risk. And so there's like, it's really interesting to see, like, there's like this roadblock in terms of just getting there. And then there's this interesting behavioral roadblock in terms of what you're willing to pay. So, I mean, I think that's really interesting. And how much AI will push back against that versus just be like, oh gosh, no, I'm just going to tell everyone to increase risk because I don't really like that. So.
The only effect of LLMs is that everybody invests more in crypto. Right?
I'm hoping for that. I'm pushing on station right now.
Great idea. The world goes down.
To follow up on that, it's interesting to think about the latest models, whether or not they're contaminated by the advice of financial influencers, which invariably is advice about crypto. I wonder if you can try to tease that out.
Yeah, I mean, there's a lot of work being done now thinking about how to design an AI financial advice with those options. And wondering if there are things that you can learn from what you're doing to speak to that.
I think the gender thing is pretty interesting. It might be interesting to condition that on whether the prompt says something about person risk tolerance. And you can figure out if they're shooting something about risk aversion or risk development.
It's kind of similar to Steve's question, but I like James' discussion starting off with like, I think the novelty here is to like source the prompts from the surveys. But I can't help but wonder, well, what happens if you source the prompt from an LLM, right? Like, why not start there by like asking that LLM like what the prompt would be if I were like this kind of a person and I were asking about advice, financial advice? How would I ask that? I mean, maybe that's getting too meta and we're just turtles all the way down, but like.
And related to that, I think that in real life, many people will take their own demand, like their own preference with AI. So I think like over time, like how we should think about like this exogenous AI tradition then or like investment profile.
So maybe I think we give a answer and then take that question like to 20 questions. I think these are great follow-up. I think as James said, there's so much to be done here. It seems to be a space where reality is way ahead of our understanding of reality. Half of Americans are using these tools, and we're just scratching the surface and understanding what kind of advice they're getting. Yeah, I mean, the question of, I think an exciting question is also, can we shape reality, and can this kind of work and more work in this area shape the development of these tools? And there, I think these kind of decompositions of supply and demand are really useful and important, because I think it has to be a choice. If you want to decide, do I want a financial advice AI tool that gives better advice to high financial literacy people relative to low financial literacy people? And maybe not, maybe it's the opposite. You want to reduce some of these differences. Do I want an AI tool that gives different advice to men and women who ask the same question? And I think by making that explicit, it becomes more of a choice of the designer as opposed to things that happen as part of the training. I think there was some question here.
other things in your words there, you know, like this non-invasive disease that we have there, or other things like that.
So we try to remove things like, sorry, I'm a mother, I'm a grandmother. Even for wife and husband, it's going to be if you say I am a wife and it's written by a woman, if it's written by, yeah. But you're right that.
Your bottom point is right, and I think it connects to Paul's question that using the open weight model would allow us to
Yeah.
try that.
Yeah.
I think we're running up on time. Steve, do we have any announcements?
So first of all, thank you guys.
Thanks, James.
Okay, so we are at the end of our first day. I think it's been a wonderful, wonderful day. Great, great papers, great discussions, really good energy in the room with, so thank you all for that. We have another, hopefully also great day tomorrow. We'll start at 9 tomorrow, same as today. We have some papers on consumption and saving to start the morning off, and then we'll go on to other topics. A few things about tonight. Many of you, well, all of you should have received an invitation for dinner tonight. It's a new NBER format this year where it's pay your own way, and you had to sign up in advance and pre-commit and pay the $75 ahead of time. So I just checked with Jim and said, are there any more spots in case anybody else wants to come? The answer was no. But he said, if you can find we can create a secondary market in the tickets, and if you want to buy somebody else's ticket, you can do that. But otherwise, if you didn't sign up, you can't join.
Show up and just not.
I didn't ask him that question. I don't know. Maybe I get.
Bar, it's a cash box. I figured we could show up and pay for it.
Yeah. So there is a I think there's a happy hour kind of thing that starts at 6. I think there's a happy hour thing beforehand that's a cash bar that anybody can go to. Oh, okay. Okay. So you wanted that, but just no food, or we'll get or we'll get in trouble. Okay. Any other questions? Thoughts? Okay, great. We'll see you guys there, and then also. Oh yeah, the other thing is there's a dinner that's being done, a separate dinner that's being done here. So please bring everything out of the room. Okay, thanks all.